Hey everybody, welcome to Saturday Morning Live. We're going to be talking about deal structuring, teaching you guys how really badass investors are out there structuring deals. More importantly, finding those deals. And then we're going to talk about how other people can participate in those deals just from a general standpoint. And we're going to have a lot of fun today. We'll be on here live for probably a good 4 or 5, maybe even 12 hours. You never know. I've got one of my best friends, one of my favorite people on the planet here, Matt Sorensen, the owner of Directed IRA, a company that we suggest you guys use if you guys are doing anything with 401ks, self-directed, Roths, backdoor Roth, anything.
Yeah.
What would you say is the number one thing people use you for?
Self-directed IRAs, pretty much using an IRA to invest in something besides the stock market.
And where should people go if they want to work with you?
DirectedIRA.com. Simple enough.
Easy. All right. So this gentleman has a lot of people in his world that invest in, actually I have probably 15 of his clients that have invested in deals with me. We're not going to be doing anything today other than educational things. I'm not pitching deals. We're not doing anything but just teaching you guys where deals come from, how they get structured, and how everybody can benefit. So I'm going to start out by doing a little bit of education. Then I'm going to pass it on to Matt to do a little bit more education on something I think everybody needs to know before they start presenting deals. They need to understand, as you educate the investor, their role, the lender, their role, and maybe a partner in the deal. They're not the same person, right?
Yeah, we're going to break that down. And I think as a lawyer, that was before I started Directed IRA and started helping people unlock the $30, $40 million in IRA accounts, I was structuring deals as a lawyer for people, small businesses, real estate deals. And when I really broke it down, I realized you're one of 3 things. When you're out raising capital, I don't care what you're doing, you need money to make a deal happen, a business deal, a real estate transaction, whatever it is. That person's either going to be a lender to me, they're going to be a partner with me, or they're going to be an investor to me. And those are different complexities, documents, requirements, language, considerations,
participation,
risk,
like
upside,
activities.
downside.
Some of these people are active. Can some of those people be active and some are passive, right?
Exactly, yeah. And we'll dig into that of what's different. And so you got to know that if you're out raising capital, and that's what I want to do is try and go over the things I've seen that people have been successful in doing that and using those different strategies. And we're going to see people that are going to go over some of these ways they're trying to raise capital in those 3 lanes.
Love it. Now, I'm going to break down 2 deals that I just raised capital for, where the deals came from. I'll even break down an address and how I monetize on these. These are recent deals that have been closed. And we'll talk about the people that participated and how they made money in those deals. And I'll ask Matt, was that a lender? Was that a partner? How are they participating? And then I'll pass it over to Matt. And then we have 6 presenters today. They're going to be presenting more along the lines of teaching. They're going to be teaching deal structure today. And these are real life deals with real life people. But none of this is investment advice. Do we have any disclaimers we want to break down today?
Yeah, so there's a little disclaimer as you logged on here today, and we want to make sure everybody understands that I might actually invest in a deal today. I'm just going to say I came here. I want to make use of my time here today. There might be a good deal I want to invest in. Might want to call out some other people to invest in a deal because I want this to be real. I'm looking at this not like theoretical. Here's how you raise capital. No, I want to go do a deal. And I'm an investor, so I want to do that. But if I invest in something, Pace invests in something, or just because someone's up here today, we're not endorsing this. We're not saying this is a great deal or investment. You got to do your own due diligence. I could make a bad call, and all investing has some risks to it. So we just want everybody to keep that in mind today is we really want to educate this, but also at the same time, make it real. And the more we can make it real, I think the more you're going to be able to learn, the better takeaways you'll have. And as you're thinking about this, if you're in this right now and you're an investor, we've invited a lot of people that have accounts at Directed, a lot of people that follow me. And I want you thinking about this like you're really going to do a deal. Don't think about hypothetical questions because we want to take some questions. Don't think about hypothetical questions that don't matter. Think about real questions. If I was going to invest in this, what am I thinking about? And I think that is really going to help everyone else who's like, how do I raise capital to get into that investor mindset and the questions and concerns they have?
Cool. I've got 2 deals I want to break down at probably about 7 minutes each. I'll have Matt ask me a few questions here and there. These are deals that we've just completed. We've just raised money for. These are real deals. One of them, I was just on a phone call with the seller that we helped out of foreclosure. It was a smaller dollar amount. Then the next one I'll talk about is a much larger dollar amount. So you guys can kind of see, point A and point Z. There's really small deals that they can pack a punch. You can make really quick money in a short period of time. And then there's other larger deals you can get your hands on where you can actually, as an investor, you can figure out how to get equity in some of these deals, which is everybody's got a little bit different goals. So we'll talk about those two deals. Now, the people that are going to be presenting today are people that are in Owners Club, people that hang out with me. They own businesses with me. In fact, they own Creative Title and Escrow, which we are in 43 states already. They own that company with me. Mm-hmm. So these are really, really smart people, higher trained. They are teaching today, which is fun. So we got to give them a little bit of love and give them some appreciation. They've been practicing all of this teaching. So great feedback, great positive vibes all day today. It's going to be a lot of fun. Now, SquadUp Summit is coming up. I want to be very shameless here and promote SquadUp Summit. We have sold 2,300 tickets already to the event. Thank you, Eric, for that. If you guys pop that up, Eric, it's perfectly fine. If it's blown out, it's fine. QR code right there, squadupsummit.com. We have sold out of the SVIP. That's an $8,000 ticket. We sold out of that completely 3 months in advance. We have VIP ticket and general admission tickets still available. The people that are coming to this event, we have Jordan Peterson, David Goggins, Dean Graziosi, Cody Sanchez, Tim Story, and some other unbelievable people in the real estate world. It is going to be epic. We spent a lot of money even on an app that allows you guys to network with each other at a much higher level. Imagine going to an event where you go into the app on your way to the event and you go, these are my intentions. And the app allows you to find other people that have similar intentions or maybe the solution to your current problem. That is what SquadUp Summit is doing, is we're elevating the entire event model so that when you go to the event, it's an investment, right? The ticket is an investment. You're saying, hey, I'm going to go there, pay for the flight. By the way, when you guys get a SquadUp Summit ticket, make sure you go into the Facebook group because then you can shack up with other people. A lot of people are collaborating on the hotel room so they can save money and they can save that money for their real estate deal. So squadupsummit.com. We are already 70% of the way selling out all the tickets and we still have 3 more months to go until the event. So last year it sold out a month in advance. Everybody was upset. People are already DMing me about the SVIP ticket. Hey, I went to buy an SVIP ticket and I can't. Guys, when we say things sell out, they sell out. Okay. All right. Effie says shack up. You know what I mean, Effie. Come on. Damn. Come on. All right. So let's talk about a deal that I just barely closed and we made $18,000 in a 40-day time frame. Let's set the tone. Eric, let's go to the iPad and I'll break down this deal. This was a deal that I got. Are you finding it on there? Okay, let me repopulate it. See if we can get that to go. Sometimes these iPads can be a little bit fickle, you know?
So let me make sure you said this is a deal that's already funded.
It's already funded.
So I can't invest in it.
You can't invest in this deal.
Okay.
I want to just talk about where some of these deals come from so people understand that. For me, when I was starting in real estate, I had a really hard time understanding real estate because I was like, where are all these deals coming from? I could not, that was my hang up. Like, where did the lead come from? How did you negotiate? Why did the seller let you make that kind of money on this deal? Why was always my big question. And so that held me back. And so when I educate and I teach about the deals I'm doing, I really like to tell everybody the backstory so they understand how they can go find these deals too, if that's what you're interested. Who in here is either, I can see the comments right now, right? We have about 700 people in Zoom and probably a couple hundred people on YouTube. Who in here is a buyer? Who in here is a warrior? Meaning I'm a warrior. I go out and I find the deals. Like I'm in the battlefield. I'm knocking the doors. I'm sending the letters. I'm on the phone. I love being a warrior. And how many people in here are private money lenders, investors, or looking to be future equity partners in big deals? Tell me what you guys are. Are you a lender? Are you a partner? Are you a what's your other one? Investor, or are you a warrior? You're the person that's out there finding the deals. Let's call that person a finder. Are you a finder? Are you a lender? Are you a partner? Or are you an investor? Dude, what a great blend. Look at this. Lender. Yeah. Your eyes are still good. You can see that far?
I can see that far. I'm only 44, so.
Okay, you're a young guy.
But can I just say what this concept of today, just so people have a little context for where we're coming from, is Pace was at my Alt Asset Summit, spoke, did a incredible job. As everybody knows, you see Pace Morby speak. But there was something special about this time. There was something very special about this time. It wasn't just the Alt Asset Summit. Pace Morby tucked in his shirt and wore a jacket.
I did wear a jacket. Did I take off my hat?
Dude, and it was a white shirt like you would wear to church.
Yeah.
Tucked in, jeans, but still. And Pace said, you know, I felt if I come to talk to you guys, all you tucked in shirt people, which is kind of my events, I'll be honest, which I love. I'm a quarter zip guy and I'm wearing slacks on a Saturday.
I wore a quarter zip today just for Matt, just FYI.
Yeah, I appreciate that. So want to make me feel at ease up here. But I wore a hat today, and this is not typical Matt Sorensen vibe, but I did wear a hat today. So I brought a hoodie too. If it gets cold, I brought a hoodie because I know I'll be here with Pace. So
yeah, we freeze out the studio down here because we have a whole bunch of, Eric, will you show the live audience real quick? There we are. There's our live audience. We have another 20 people. That's not the issue. The issue is sometimes, sorry guys, we're dealing with a screen issue. Sometimes the screen really likes to play games on us. And then for 5 months, we won't have a single issue with it. It's the funniest little thing.
But let me add on to this just while you're working on that, if you don't mind, is what happened at that event is Pace was talking. And one of the things we realized at my event, the Alternative Asset Summit, is there's a lot of people there. They don't have deals. They are not warriors. They're like, I own a business. I'm a high income earner. I've accumulated a lot of money that's invested in the stock market or stuff I really don't care about. But they want to go do investments and deals. They want to invest in real estate deals and business transactions, but they don't want to go do the work to go find the deals. They want to just be more passive, but they have money. And that's the people that are at my event. And then we get another group of people that go to events and they're like just circulating with people that do deals, that are warriors, and they don't have money, but they're warriors. And so, or this is what you call them, I guess, the warriors. So,
I mean, I came up with that 5 minutes ago.
Okay. All right. Yeah. It might stick. I don't know. Yeah. Let's say debatable. So, but the trick here, and this is why important today, is just seeing all the different types of people that shot out where they are is understanding each other. And if I'm someone that's a warrior, I want to understand what someone that's got money, how I can access that. How do I get that in the right legal way, in a highly successful way? And so we want to go through that. And then also, if you're that other person that has the money, how do you vet these deals? How do you understand them? And so that'll be part of the goal today too.
Yeah, it's interesting in our world, right? People go to our seminars, our events to learn how to find more deals and how to negotiate, how to be a good salesperson, how to do follow-up, build a CRM. How can I talk to more sellers in foreclosure? Then what happens is they get a deal under contract, whether it's an RV park, a multifamily property, a business. Matt's helped me buy multiple businesses. Their company is unbelievable. KKOS is unbelievable company. I love Mark so much. He's unbelievable. But I'm good at finding deals, right? And so people like myself come and learn from me how to find deals, structure deals, negotiate, all of those types of things. And then they hit a roadblock once they get the contract. They go, I got the contract, but what are they lacking? Money. They spend all that time and energy.
Yeah.
Guys, give it up for Scott right here. He's helping set up.
Yeah.
Get up for Scott. There it goes. There we go. Can you see it, Eric?
Troubleshooting on the fly.
How about now?
Can you see me now?
It's the weird thing with like the courts.
You came in for a second.
Okay, we should be good. Can you see it?
No.
Let me finish Pace's thought there, just because that is, these people come, they find a deal, right?
Don't touch it.
They get it under contract and they need to now fund the deal, and they have not learned how to raise capital properly, or they raise it it could be illegally raised. They waste their time and other people's time because they don't know how to do it right. And, but then we got investors that are so gun shy to do something. They want to, they just need to be led to the water. It's not that hard. And so that's my goal, is hopefully to like teach some of the people raising capital and also some of you investors to get off the freaking sidelines, to get comfortable with this, but also do it in a smart way so that you make sure that you're keeping the money you're investing in and getting a good return on it. Because, and I'll say this is just probably my first important point. I was trying to buy some time here, if that's okay. But my first important point for if you are going to invest money in a deal is that the first thing I want you to think about is the person that's going to be talking about it. And are they trying to make money from me or with me? There's a lot of people out there that are raising capital that really just want to make money off of you. They don't want to make money with you. When I look at a deal, I'm really trying to understand that. As I was a lawyer, I was looking through terms, structuring a deal every day for a client, thinking about my client's perspective and like, are they going to make money with them? Or are they just trying to make money off of them? And that's a little bit different. So if you're someone that has money, start thinking about that as you're looking at different opportunities.
Love that. Now, let's jump into the first deal that I want to talk about. I'll go quick, maybe about 7 minutes. Eric, let's go switch it up. Guys, the whiteboard, give it up for the whiteboard. Gosh, dang. We got it up and going. Okay, so here's a recent deal that we have. As a finder or a warrior, what we do is we go find sellers who are in foreclosure. Okay, that is obviously a big pain point. And we get paid in real estate as deal finders. We get paid by finding people that are in pain and alleviating that pain, much like Advil. We're basically the Advil for real estate. And I don't want to go find people that don't have headaches for me to solve. So I find sellers, or rather real estate agents that are representing sellers that are currently in foreclosure. So we find a real estate agent. His name is Devonte. And Devonte is representing a real estate agent, or I'm sorry, a seller named Joy. Now, she's in foreclosure. She is 14 months behind on her mortgage. And Devonte did not know this when he took the listing. This happens actually frequently. Think about how foreclosures are on the rise right now. So Devonte goes and lists this property. Where do we list properties, everybody? The MLS. He goes and lists this on the MLS. If I'm a buyer's agent looking at this deal in the MLS, will I know that this house is in foreclosure by looking at it on the MLS? The answer is yes. And so if I'm a buyer representing a buyer's family, right, I'm a buyer's agent, I'm going to either A, lowball because I know it is in foreclosure, or B, I'm going to offer full price. Which one is what's the answer, A or B? It's A. Always, always, always. You as the agent, the buyer's agent, you know, hey, I can see it on the MLS that this house is currently in foreclosure. This agent and the seller are on a really tight timeline. I'm going to lowball them. And so what investors like me will do is I will find these situations. Okay, here's me, paste down here, and I'll go directly to Devonte and they say, hey, Devonte, I want to make your life really easy. How about I lend money, okay, to your seller? And in this situation, we gave Joy a $40,000 loan. And that loan, I'll break down to you guys what that loan was used for. But what I can do is, number one, I can get all of her arrears caught up. How does that benefit the seller and the agent if I get all the arrears caught up, all her late payments? How does that help? Live audience, you're welcome to speak.
Stop the foreclosure.
Okay, so it stops the foreclosure. It gives them more time. It also catches up her arrears. So her credit now says she's caught up. Rather than selling the house while she's in foreclosure, which is not a good look on her credit, she gets to catch up her payments and then sell the home. What's another thing it does? Well, it gives the freaking real estate agent the ability to sell the house for a higher dollar amount because now nobody can see that the house is in foreclosure because it's not in foreclosure. Okay, so we catch up the arrears. The other thing that we do is we gave her 3 months of payments stacked, meaning that I made 3 months of payments ahead of time. The third thing we did is we gave her 3 months of living expenses. The fourth thing that we got her was a car. We bought her a little Toyota RAV4, 2012 RAV4. We paid it off cash. And we put a little bit of money in her pocket so that she could have groceries and all of those types of things. Now, how did I make money on this transaction? Well, everybody that was coming along to her was lowballing her. And they were saying, ooh, this is a great opportunity. She's in pain. She's in a tough situation. I will offer her, she owed, let's see, what she was trying to sell the property was 406. She was trying to sell the property for $406,000 on the market. She was getting offers from cash investors for $260,000. Okay, this is what wholesalers do, right? This is what fix and flippers do, is they lowball cash offer somewhere around between 50 cents on the dollar to 70 cents on the dollar. What I was able to help her do is she ended up selling the property for $415,000. And she was able to keep all of her equity, except I made a return of $18,000 for doing this deal. So we went and borrowed money from a private money lender. They brought $40,000 to the table. We just wired them $5,000 today. So I made an $18,000 fee. Here's how the deal was broken down. The profit on the deal was $18,000. I wired my private money lender a $5,000 chunk. They loaned the $40,000 on the deal. They had the money out for 40 days and they got a $5,000 return. Is that a pretty good return?
I'd take that.
That's pretty good.
It's pretty great.
I mean, if you really look at that annualized, I think that's probably somewhere around, I'd say that's probably an 80% annualized return. When you really look at that, it's really, really good return. Okay. So 80% over 40 days. I like that deal. Now, what did I make? I made more money. I took home $13,000 on this deal. Now, why do I deserve to make more money than the private money lender that brought the money to the table? I'm the action taker. I went out, I found the deal, I negotiated, I dealt with the paperwork, I dealt with structuring everything, and I took home $13,000 in a 40-day period. And my private money lender, the person that came in and goes, hey, I just want to be silent. As long as we have a lien against the property and we're protected and all the paperwork is done properly, and I'm good and happy, for me to make $5,000 over 40 days, are you kidding me? That's freaking amazing. How many people in the side chat would have done that deal with me? Give me a me or a hell no, Pace, you suck. Shave your beard, you homeless looking mother. Okay. So this is a good deal, right? You can get into smaller deals. So for those of you guys out there that don't have a tremendous amount of cash, right? Let's say you have 100 grand in your directed IRA account, right? Or even your kids. I use directed IRA for my kids' accounts. And then I have my kids lend on my deals from their accounts, or I pull the money out. They don't really physically do anything. They sit there and collect the benefits, which is nice. But you can use your directed IRA account. You can use your cash if you're a lunatic. You could pull it off a line of credit. I don't care where the money comes from, but you could have brought in $40,000 on that deal that I found. This is great. Did you give them a contract to keep the house on market? Was there a time frame? Yes. So the challenge, Jennifer Lindsay, who you have sat there and listened to my training on this multiple times, you know the answer to that. I think what she's doing, she's trying to tee up the rest of the audience that might not know the answer. The answer is yes, absolutely. Not only do I have a contract, but I have a contract that says they need to keep it on the market. If she changes her mind, I get to buy the property at a price that I get all my money back plus my return. So we structured it in a beautiful way. I don't have time to go through the structure of the paperwork on this deal. That's another conversation maybe for another day. Let's talk about another deal that I'm closing actually on Tuesday of this coming week. So a really recent deal. I do something called the wedge method. For people that are brand new, this is another really cool thing. Let's say you're somebody out there that's a finder. You want to go out and find deals because you don't have cash and you don't even know you don't know how to manage an asset. You don't know how to manage a deal. You don't have any money. You are literally like destitute on a park bench. Okay. Great. What do? What I would do is I would start with, Eric, let's go back to the whiteboard. I would start with what I call the wedge method. Okay, the wedge method allows you to go to somebody like a Matt Sorensen or somebody like me and say, hey, Pace. I can't go black. That won't show up. Okay, so let's go to Pace. You're going to come to me. Let's just say your name is Birdie. We have a Birdie in the audience here. Birdie comes to Pace and says, hey,
purple, that's good.
Hey, Pace, I have a question. What are you buying? What do you want more of? I see you buying RV parks. I see you buying multifamily. I've seen you buy a couple of businesses in the last couple of years. What are you really focusing on right now that I can go find for you? Okay. Now, the actual story of this, I shouldn't use a fake name because I actually have a real story here. Brandon Harris. Okay. Brandon Harris comes to me and he says, hey, Pace, what are you looking for? My answer about Brandon Harris, or to Brandon Harris, was, hey, Brandon. He is stronger than me, so that makes sense. Hey, Brandon, I'm looking for more RV parks that are actively cash flowing right out of the box. And he goes, where? So he says, where? I tell him Texas. I tell him Montana. I tell him a handful of states. Cool. What purchase price are you trying to stay underneath? And I go, well, I really don't care as long as it cash flows. I don't want something that's like 10 spaces because that's really hard to manage. It doesn't bring in enough cash that I can have a manager on site. And I start giving him my buy box. What Brandon does is Brandon goes out to a website called Crexy.com and he starts looking for RV parks. Very long story short, he finds an RV park in Kermit, Texas. That the seller, this is an interesting thing. You want to know the seller's pain because you want to understand why some of these sellers are selling. The seller was so afraid that Kamala Harris was going to win the election. And Kermit, Texas is a big oil town. And so he said, oh my gosh, all of the people that are living in my RV park are all oil workers. And if Kamala Harris takes office, I'm going to lose half of my clientele. I need to hurry and sell this property right away. Okay. So that's where the pain came from on the seller side. The seller says, if you buy my 45 space RV park, I'll sell it to you for $1.7 million. He wanted all cash. This is one of the only cash transactions I've done in the last 5 years. So how did we come up with that $1.7 million? And more importantly, what the heck is the wedge method? The wedge method is where I told Brandon, bring me a deal, Brandon. I will buy the deal. I will fund it 100%. I will manage the deal. And my team will take over and educate you on how to be an owner of this property, because for bringing the deal to us, we are going to give you 20% equity in that deal. It's a big deal. This property, this RV park that we are running, it brings in about $45,000 a month in income. And after expenses, management, etc., this park brings in $23,000 in net income. Okay, net. That's not net operating income. That is literally net in our pocket. We can spend that money. There are no bills after that. So if Brandon gets 20% of that deal, then Brandon is getting $4,600 a month from the cash flow because he got 20% on that deal. Now, how many people in here say the word wedge? You would want to do a wedge deal with somebody like myself? Now,
does Brandon get upside too on appreciation of the property?
Yes, he gets the appreciation. So here's what we're doing on this park, Matt. Thank you for asking that question. What we're doing on this park is we bought it. It has 45 spaces, and it comes with 2 acres that are undeveloped. What we're going to do is we're going to add another 25 spaces. And because I also don't want to have long-term exposure to the oil field, what we're going to be doing is we bought it for 1.7. We believe that after about $500,000 in additional capital invested, we'll be into it about $2.3 million. This park will be worth $3.5 million in less than 12 months. Okay. So what we'll do is we'll then turn around and sell that. What I will do, of course, is I will then 1031 my capital. I don't know what Brandon's going to do with his, but look at this. We're going to have a $1.2 million gain on this deal. Brandon will make $240,000 in 12 months on bringing me a deal. Not only that, but he also made cash flow for that full 12 months. So he brought in another, $50,000. So his net gain on this one deal in 12 months is $290,000. How much money did Brandon bring to the table? Zero. How much management did he bring to the table? Zero. How much expertise did he bring to the table? Zero. So I bring this up right before I get into how did I fund the deal, and then I'll pass it over to Matt because I want Matt to teach us the difference between investor, lender, and partner. Brandon, why the heck would I give a guy so much? That 20% seems like a lot. Well, the reality is, what do you think?
Because you can get 80. Don't be greedy. You get a good deal. A good deal's valuable. Why would I care about giving up 20%?
Right.
Now
here's the best part about it. I didn't use any of my own money. And so I've got 80% because what I bring to the table is management and underwriting and understanding the asset type and understanding what it's going to do long term. So I know where I'm bringing my value. And what I did is I said, all right, I want to close on this cash. So I went out and I raised the money from private money lenders that want a short-term loan. Okay, they'll bring cash to the table, and then what do I have to do is I have to go and refinance them with like a Marcus and Millichap or some commercial lender. So we've already been approved for our loan. We're going through, but I'm currently refinancing out the investors, the lenders, I should say, not investors, the lenders that loaned me $1.7 million plus closing costs. We're about $1.8 million loan that we're paying back. I'm paying them 12% interest. Okay, and they'll be into the deal less than 90 days. And so the people that came in, they go, hey, I'll get 12% interest. This is awesome. If I invested with that from my, if I loaned on that from my retirement account from you guys,
right?
Could I put that money back in my retirement account tax-free?
Absolutely. Like builds up, goes back in your retirement account tax-free. 12% interest is excellent return, right? Most people in their retirement accounts, that's what I've seen a lot of people here. I've got an account at direct IRA. They're wanting to connect with people, but do so at your own risk, everyone. But sorry, this is the lawyer Matt. I just have to.
I love it.
It's the lawyer Matt. He just can't help it. So, but the 12% annual rate of return is a lot better than what someone's getting in the stock market. But also what I would be looking at if I was that lender in that is, did I get a lien on the property? Did I get a deed of trust? So this is secured against the real property, which you're investing your time and money into to go and do the deal. But I'm in first position. You don't make any money until I get paid.
That is correct. And I do when people loan money to me on those types of deals, I do a personal guarantee and I have additional collateral on my other assets. Like my personal home has $2 million in equity and I can very quickly put a second lien against this equity. If somebody says, I want double security, there's all sorts of different ways to secure that person. For a 12% return, let's say you're using your retirement account, a 12% return being put back into your retirement account is like somebody else earning 18% return or 19% return outside of their retirement account because you're not paying taxes on it.
Right. It's all tax deferred. Now, this is long-term wealth building.
Right.
Let's keep in mind when you're talking about using your retirement account and investing those dollars, which there's, $40 trillion in the US in retirement accounts is where most people have investable cash.
Matt, where do I find private money lenders?
I mean, you're probably right here in the chat.
40
20
trillion.
keystrokes away, probably. Okay.
How much do you think out of that 40 trillion? I know you're making a point, but out of that 40 trillion, just to paint a picture, what do you think is being unutilized where it's just sitting there not invested in something?
Oh, sadly, trillions. I mean, probably
Trillions.
5 trillion, maybe. It's crazy. I mean, and that's a problem. People are like, where do I find a deal? They could be at TD Ameritrade or their 401k. The other outcome is they're in something they don't even know what it is. Most people, if you ask them, what's your retirement account invested in? They'll be like, a fund. What fund?
I don't know. Who's running the fund?
Yeah.
I have no idea.
What's the return it's got? And so, but what's happened is people are getting a lot more connected to their money and realizing what they can do with it, which is why we've had a ton of success in helping people unlock retirement accounts. I'll just give you an example from last month is like we opened 1,100 new accounts. 1,100 people last month alone open up a new account with us. The average amount they fund is about $125,000 into a new account with us because they're usually coming from TD Ameritrade or Fidelity. And so that's just us. We're just one company in the space, right? But most people are coming to do deals like this.
Right.
They want to find someone like Pace that has someone, and Pace trying to find someone that has a wedge deal like this, Brandon, because everyone can win in this. Pace can structure the deal, manage it. Brandon can find the deal and make money. And an investor here, which we're going to get into that, who came in as a lender structured deal, makes a great return. So it can be win-win-win.
And on top of it, like here's the thing, it depends on who the lender is, right? Some lenders want to be really passive. Other lenders, I will fly out to the property and give them a full-on property-specific education. What are we doing? Why are we doing it? Who's the contractor? Why are we doing it this way instead of that way? The lender will walk around the property with me as I make a YouTube video. They're like, dude, the money I'm going to make on understanding how you did this deal is far greater than the actual 12% you paid me. So if you are that type of lender, there's even more upside if you treat every deal like an education. If you're like some of my lenders, like, I don't care. I'm 82 years old. I just want to save 10, 12%. Don't even call me. Don't text me. I don't want to hear anything about it. Just put the money in my account. There are those people on the spectrum as well. But on the other side, maybe you're like, dude, I want to learn how to find these deals and structure these deals and be in Pace's position one day. Sometimes being the lender on a deal is the gateway to getting to that point.
Yeah. And do you mind if I break this down? Because I think this is a perfect example here to go through the lender partner investor structure. Because I want to ask you some questions on.
Of course.
On why
How many people are enjoying this so far? You guys, we're not even to the teaching moment. This is great. By the way, Matt charges me. He says we're friends, but he charges me by the hour to be here. So make sure you guys ask him a ton of questions, okay?
You said you valued my friendship, so.
I do. Charge me double, bro.
Okay. All right. Wow. Pace, your handwriting is so much better than mine.
They can read it. It's good.
I'll write your prescription.
Are you sure you're not a doctor, dude?
Yeah, I can write scripts. All right, Juris Doctor. Okay, so let's talk about lender, partner, investor, and that deal was a great one. You needed 1.7 million.
Right, 1.7 million.
So you found the deal, you underwrote it, you knew it was a good deal, you figured out a way to compensate Brandon, motivate him to go find the deal, financially reward him. But you're like, all right, let's go get $1.7 million. Now, you did the lender model here. You were willing to give up 12% interest. How long? What's the term on that?
That one's 120 days.
120 days. Okay. So
with penalties if I'm late.
Okay.
Okay. So we did 12%, 120 days, and a penalty of $250 per day if I'm late.
Okay. Did you do points or no points? Just 12% rate of return?
I did no points on this particular deal because these are lenders that I constantly am flowing their money from one deal to another deal. But I do frequently pay points to lenders. Yes.
Okay. It was secured. You gave them a deed of trust.
Correct.
Or a vendor lien. So I think what they call it in Texas or whatever the hell. It's something different, you know. Was that a vendor lien? What do you guys know what it is? What they call it?
We gave them a UCC 1 against my business as well.
Okay.
So they had they have a deed of trust against the property in first lien position.
Okay. All right. So was there any other senior debt on it?
No senior debt.
No debt. Okay. It was owned outright by the current owner. Okay. All right. So why didn't you just say, why don't you get a cash partner? Because this is the next thing. So this is the cleanest. If I'm out raising money for a deal, this is the cleanest way to do it. Just go get a private money lender. The documents are the less complex. It's a promissory note, your loan agreement. It's a deed of trust or mortgage recorded on the property, which is good for your investor, right? Because as you go out and raise money, you're saying, hey, this is a 12% return backed by real estate. Like, you're secured on the property. I don't get to make any money when I sell this thing until you get money.
Right.
Right. And so if I'm an investor, someone that's got cash, I feel good over here because typically I'm going to be secured on the property if we're talking real estate deals. So now there's some downsides here. What the downside of being a lender is
you're not getting equity in the deal.
You never make more than that.
Yeah, I mean, sometimes on a little bit maybe riskier deals or longer term, depending on, maybe you can make a little bit more. Like when I'm lending my money out, I'm lending my money out at 16 and 18%.
Yeah. So I'll do 12% rate of return, but 2 points.
Okay. Yeah. Love that.
Yeah. Because I can lend it twice a year. Typically, I'm doing 6-month loans right now for the most part. And that way I'm getting basically a 16% annual rate of return.
So the advantage is, I think, knowing who you are as the individual. Like, let's talk about the person who's funding the deal. Who are you and what do you want? Some people are like, I am building a massive directed IRA company and I don't have time to be boots on the ground and, you know, participating in anything else. Let me just give you the money passively. I don't want to be involved. And so you have to understand one of the biggest advantages of being a lender is that you're not having to get involved on a day-to-day basis at all. You kind of are disconnected from it. So that's an advantage, but also the disadvantage is you're not really going to be able to be a partner.
Yeah. Let me say one other point you mentioned there, which is, see, I do this a lot right now. I'm over in this lane here doing this 12%. Like I said, I do 2 points. And there's one primary reason I started doing this. I was investing in other deals. I was partnering in deals, and I still do at larger dollar amounts. But I realized that my return on hustle, my ROH.
Dang, bro, I got to write that down.
My return on hustle is not very high to go analyze a deal. But I can analyze a deal really fast to lend, let's say, $100,000 at 12% interest in 2 points, because I usually get them from a few different places where I'm getting my deal flow. I know I got a lien on the property. It's typically already been underwritten to be refinanced out. I know there's a little process I walk through on these deals I'm doing myself. It's very low work for me to look at and analyze a deal. So if I got to get that money back out every 3 to 6 months as these deals get paid off, I can move fast on those.
Okay, there's a really good point there. Eric, come back to us for a second. So let's say that I go to you. Yeah. Me, Pace goes to Matt. Yeah. And I say, hey, Matt, I've got a deal. I need 12% money, 2 points, 6 months. You're going to give me that.
Yeah. I imagine. Now, if you say for $25,000, I'm going to say no.
Because it's not worth your time.
It's not worth my time.
Yeah, okay, great. So this is, again, understanding your profile as a lender and who you're also lending money to. So my point is this. If I'm brand new And you have to look at my deal and go, hey, you've got this structured a little bit differently and this, that, and the other. And I think you need to do it this way. And you're actually participating a little bit more than just an average lender. Plus the borrower is a little bit riskier. I think you should be amplifying your return, right?
Sure,
and you should be amplifying your security and making sure that there's other collateral that you can go against. So some people look at Matt and go, okay, so my tried and true is 12%. No, 12% is a good measurement, a good baseline. But if you're investing with a really safe person, they've never had an issue for 50 years and they have a track record like crazy. If you go to them and go, I'll give you 6%, 16% interest, are they going to take your money? No. They have people throwing money at them at 8, 9%. I have people throwing money at me at 8, 9, and 10%.
Yeah.
Okay. So if it's a newer investor, I don't think you should be giving them necessarily 12%. I think that the additional risk profile, your additional due diligence, you got to go above and beyond. Okay. I would also argue never lend money to somebody on their first deal unless that person on their first deal is partnered with somebody who is not on their first deal. So I get people that come through if anybody ever needs money, email money@pacemorby.com. My team will go, okay, is this your first deal? I go, yeah, it is. And if you say, no, it's not, and it is your first deal, we'll find out. Believe me. Okay. It's very simple. You go, tell us the deal you were the principal of, and if you can't prove it, it's pretty simple. What we do at our lending company is I will actually find somebody in your local area that I've loaned money to, and I will say, if you go partner with that person and JV with them, then I'll give you the loan. That's my way of operating. I don't want to give somebody a loan for their first project that doesn't have good construction background, doesn't have a good contractor, doesn't have all of the things. So, and when I do lend somebody on their first deal after they've JV'd, my interest rate's like 16%, 17%, 18%, and 2 points, and a doc fee, and you got to buy me a steak dinner when I'm in town.
Outback Steakhouse.
Outback.
That counts. Okay. So, all right, here's one other thing I want to do. All those stats Pace told me about that deal, what it was worth, that extra acreage, the extra spaces they were going to put on it, the net income they're getting out of every month. I was going to document and verify that, by the way, before I lent my money over here.
Of course.
In this lending. And so in any of the structures of how you might be going into a deal with money, you want to be validating all this information and forcing that person. And this is where someone like a Pace is good at that. You're used to doing that. And honestly, you're not going to waste your time. Any good operator or person running deals is not going to waste their time if they haven't already done that for themselves. And what really, for me, when I start talking, as I was advising a lot of clients over the years, out of doing a deal, became very apparent that person really didn't think through the deal that they wanted to go put money into. And they're like, if this person really didn't think it through, why am I going to drop some money into it? So okay, that goes without saying. Okay, I want to come over here to partner though. So if you're just getting started out and you're raising money in your first deal, stick over here to lenders. The easiest way to raise it. The securities laws are the easiest. Most states have a securities law exemption when someone lends you money and you secure it against real property. Okay, so pretty clean and easy.
Here's what he means by that. Okay, that might go over some people's head. What that means is that the Securities and Exchange Commission, okay, that's the federal government, says
the SEC,
yeah, the SEC,
not the Southeastern Conference, football, very formidable foe. The Securities and Exchange Commission, they do have a criminal division that has badges and guns. So
yes, and they put people in prison for securities violations. And security violations mean you raised money illegally. And so what's great about doing these lender type of deals is that the SEC says, hey, you don't have to follow most of our rules. If you are borrowing money from somebody and you take their loan in a promissory note and a deed of trust and you secure it against the property in a form of a lien, or an operating agreement of some sort, it's a lien. They want to see a lien on the property. If you do that, most of the laws that the SEC has go out the window. You don't need them because that person is secured. When you start getting into partnerships and investors, like they're investing into a pool, things change because that individual can't necessarily have a deed of trust against the property. Like I have an apartment building that we brought in investors, 700 of them. We raised money through a fund. Am I going to put 700 deeds of trust and promissory notes on that property? No, the SEC is going to be like, dude, we see right through you. You can't do that. So that's what you mean by lending is a much easier form because there's a lot less regulation.
Yeah, but another thing you could do on the lender models, you can even put a few people on the same note and deed of trust or lien on the property. So let's say you needed $250K, and I've done this myself quite a bit where I'm investing. and two people have 125. You can put two lenders on the same note, the same deed of trust, but it gets you to the 250 because you couldn't just get it from one person. And one thing not to do is say, well, I'll put you in first and then you in second. I mean, I guess you could, but if I'm the lender, I'm like, if I'm in second, it's not 12%.
It's 14, 16, 18.
It's 18 maybe, depending on the deal and how much equity's there. But so I can keep my cost of capital low if I put them all in the same position. They know they've got enough equity in the deal. If they can look at the values, make sure you've underwritten it properly. But no way you can combine a few people. Now, you're not talking like 5 or 10 people on the same note. We're talking a few, definitely less than 5. Okay. So why didn't you want to have partners in that? To be like cash partners, because you can have people come in and say, Pace, you're still going to run the deal. Yeah. You've got management. You've got that. You've done this before. I don't want to do that. I've got some capital. I want to be a cash partner.
Yeah. So in our community, we call these pimps. Okay. PMPs, private money partners. They become a partner. They have equity in the deal. They bring capital to the deal. PMP versus PML, right? PML is a private money lender. That would be a lender as Matt's first category. Private money partner, somebody bringing their private capital to the deal to become a partner. When I first started out raising capital for single family deals, I had no background. I had no track record. And so I had to give up a lot of equity on my deals in order to make it attractive to somebody to give me money. So my first 5 sub-2 deals I ever did, I needed to borrow $30,000, $40,000. Nobody would give me the money. So I said, well, what if I make you my 50-50 partner on the equity, the cash flow, the upside, you get half of the tax depreciation. I'll give you literally half of everything. Yeah. Dude, it was like I was getting poured with money. People were like, I will do all of that. But as you get bigger and better and your brand and you get recognized as somebody who doesn't screw people over, you now start going over to the lender side of things a little bit more frequently because I don't have to give up any equity in the deal, right? My team, I have employees, Molly and other people on my team, they get equity in my deals. And so every time I give up equity to a private money partner or a pimp, I'm giving away Molly's potential equity and Bo's potential equity in those deals. And so I hold that really, really holy. And I just have more options. When I was newer, I didn't have as many options. And so going the partner route was honestly one of the best things that ever happened to me.
Yeah. So it enabled you to do deals, but now you're like the cost of that because you believe in the upside and equity. Honestly, you don't have to give it up. No. You've got good deals. You don't have to give it up. Now, I think sometimes in the business deals, I think on the real estate side from a person with money wanting to put in capital into someone else's deal is real estate's really easy and I feel safe and secure about it, so I'm good with just a 12% return and me being capped. But let's say I'm going into a business deal, okay? Yeah. We're buying a business, and I want to put cash into this. They need some money to acquire the business or to grow the business and scale it, whatever it may be. And now I'm going to put cash into that. I might want to be over here in the partner scenario. And this could be a real estate deal too. I see that it's more in real estate developments or other bigger projects where like, I want a cut of the equity. I want to be a partner in an LLC with you. And maybe your deal is I'm going to run and manage this business, but I need to raise some capital. And I've done this myself. Even some of my biggest companies, I have cash partners in them that added capital to go and fund this. So,
as a partner too, you have the ability to negotiate based on what you understand the operator it has as an ability to raise capital. So I'll give you a good example. I'm currently working with a seller who's in foreclosure, and the seller says, I want to keep my house, and what can you do for me? I told the seller's name's Justin. I'm talking to him again today at 5. On Monday this week, I said, hey, how much do you need? He says, I need 50 grand. I go, cool. I can loan you the 50 grand. It's going to be a 2-year loan. He says, what interest rate do you charge? I said, oh man, I'm probably not a good fit for you because I'm really expensive. What I was doing is I was trying to test the waters of what I could charge. I don't have my interest rates on my website. I understand the person I'm communicating with and their ability to raise capital, because if they don't have a lot of options, they're not well networked, they're going to pay a higher percentage with me because I understand where they currently are. So the seller that's in foreclosure, I go, before I even quote your interest rate, you should go talk to 5 other people and see what their interest rate is and come back to me when you realize I'm probably the best fit. He goes, well, can you give me an idea? And I'm like, it's a lot. It's going to be, you're going to gasp when I tell you. So I told him on Friday that I was 21% because I understood usury laws in his particular state, 21%. And he goes, okay, sounds good. Did he even go look at 5 other options? No. He did not even go look at 5 other options. He did not even do that. And I gauged that through my conversation. So there's negotiation tactics that we can't go through today. But as a partner, if you know that they are up against the wall and they need some money to buy this business that Matt's talking about, and you know they're not well networked, you can push for more equity. You can push for more interest. You could do even equity plus interest based on where that person is in their networking phase.
Yeah, I'll give an example on this. I have a client in California that I don't practice law anymore, represent clients, but this is a long time ago. I had this client, and he's still running these LLCs today. And he probably has about 50 LLCs. These are separate little LLCs that have about 4 or 5 people in them max. He's in there, and he's in there at 50%. Okay, he owns 50%.
If you put your finger on it, it messes it up.
Yeah, I'm just not as good as this. Okay, so he takes 50% of the person running the deal. Now, what he does is he flips properties in California. These are mostly luxury, higher-end properties. They take quite a bit of capital.
So he needs big chunks of money.
So he needs big chunks of money, and he'll raise them in 200, 300 a piece. He's getting at least $1 million in these LLCs. And so he's in California, and he'll get those people, and we'll do them in one LLC. Now, the other 50% gets divided up between the cash partners in the deal. And those cash partners have this risk return where they're like, all right, we get paid back first. Mm-hmm. Our cash gets paid back first before you make any money, deal maker guy. But then what happens is we all split 50% of the profits with you.
On top of getting my principal back.
On top of getting your principal back. And that just gets allocated based on how much of the total cash they put in that was needed in that LLC. Now, what happened is he did these. He wanted to come over here, what we're going to talk about, and do a fund. Mm. And before he did the fund, he said, I'm going to do this little partnership LLCs because I don't think for doing a luxury home in California, I don't think it makes sense to do a whole freaking fund and all the costs and complexity over here. And I can execute on this and keep my investors happy and make a lot of money and do a lot of deals. He also is the GC, so he's making money in a couple spots.
Yeah.
All right. So what he does is when that deal closes, they sell that house. What do you think those cash partners say to him?
When they close,
they make money.
I know exactly what they say. They say,
I'm going to pay you back.
When's the next deal?
Exactly. They're like, wait, we made money on this, right? Yeah. So what the hell am I going to do with this money? I already do the next deal. Right? And so what he thought was he was going to do, which I think is kind of funny. He thought he would do about 4 or 5 of these LLCs and to get enough investors where he would eventually come and do a fund. But what happened is it just got so easy with these LLCs with enough people, they started making money and it started accumulating in there. He's taking out half the profits, by the way, but he's letting them roll back into the next house. And
it is interesting to me.
He's got like 50 of these now.
This is interesting to me because somebody from the outside would go, what's his name? Max? Oh, you're saying max 5 to 10 people. Okay, we'll just say his name's Tim.
Yeah.
Let's say his name's Max.
Yeah.
Damn, it's written on the thing. Okay. So somebody from the outside would go, especially somebody like you or me, would look at that and go, hey, Max, you're giving away a lot of capital to these people. Why wouldn't you at this point go start a fund? And I think the answer to that is the operator's busy. He also is making money. And there's nothing better than making money with other people and never having to worry about capital ever again. You give it up enough capital that you grow well beyond what you ever thought was capable. Now he can go and do big projects. He can probably go do full-on neighborhoods and developments and apartment buildings and all that kind of stuff. Because here's what happens when wealthy people make money. They tell their 15 friends, dude, check this out. I just got a 50% of this thing. How do I get in? Best way to raise capital is pay returns on the capital you've already borrowed.
Yeah. And for him, the other thing is he has less risk. Okay. This is a guy that had been beaten down by banks before, lost money, gotten chased after. These people have upside potential, but they also have risk.
Because they're only getting 50% of the net. If it loses money and the market...
They share in the loss.
Okay. All right.
Okay. So they share in the loss with him if the deals, and he's had that happen every once in a while. It happens, nobody bats 1,000. And so, whereas over here on the lender side, if I'm someone running a deal, I have to pay that lender off. And if I don't, they can still sue me.
Yeah.
You understand? Like, you sell the property for a loss. That doesn't mean you get to say, well, I don't owe you the money. That deal didn't work.
No, you owe me the money.
You owe me the money. Over here, if you're a private money partner, that deal doesn't go well and we lose money on the deal, you just lost some money. It's like you bought
partner in the
wrong
pain.
stock and it went down.
You're in the partner in the pain and the gain, my friends.
Exactly.
Yeah. What about the investor side?
Okay, so investors next, and this is where you're like, and there might be some of those types of deals today, is where it's like, all right, I want to raise money from 20, 50, 100 different people, and I need to raise millions. And I want to have full control of this. Here's the other thing over here. When you do this partner model, they are partners. They're not, you're the deal-making person running it, but they still have voting rights. If you're going to take out more debt than you thought, if you're going to sell the property for a loss, if you're going to pay yourself any additional compensation, there's a few things in there that have to be approved by everybody. So you can't just roll on your cash partners over here. They have a say and need to be involved. Again, you have day-to-day responsibility, but they need some involvement and some voting rights. And that would be in an LLC operating agreement. Over here, your investors have no say. Okay, so we're talking about raising millions over here. You're probably like dying over here with me on this board,
No,
okay.
You're doing great.
You're going to raise millions, okay? No voting rights.
If you put the problem is you're resting your finger on the screen.
I know, I like to do that.
I do too. I had to get used to it.
How do you write like this?
It's hard.
I saw you doing it. And I
think that's why my handwriting's better than yours.
Yeah. And I think it was like, third or fourth grade, I got graded on penmanship. Needs improvement. Okay, I got an N for.
I'm glad you see you've improved it. It's
improvement. Okay, so investors have no votes. Okay, you can do whatever the heck you want. They share on the upside and the downside. Now you could have a fund. By the way, we're talking about a fund over here. You're going to raise a fund. Let me say that. The fund could be an equity fund or a debt fund. Actually, you could have an equity fund where you say, "Hey, we're going to go buy a mobile home park." Okay. And I need investors to come put money in. I'm running the deal. You really don't have a say. Here's what I'm doing. Here's my deal. Yeah. Here's what I'm offering investors. Here's how you participate. And frankly, it's a way to get into bigger deals that are kind of harder to access. Like I can't maybe private money lend on a bigger deal, but I can invest here as an investor with maybe 50 other people.
Yeah, I think the biggest thing that I've learned from you on this one is like you go from lender to investor or lender partner to investor. The number one thing that determines, let's say I'm the operator, the number one thing that determines I need to go the investor route with a fund or a syndication is the amount of people I need in the deal.
Yeah.
It's because when you're doing lender, you can go somewhere around 5 people. Okay. Partner, you're 5 to 10 people, you're all in an LLC, whatever. You cannot, if you go, hey, I got to go raise $20 million to go buy this apartment building, especially when you're brand new. You might get one family office when you have credibility, write you a check for 20 million. But when you're new, you're getting investors at $100,000, $50,000, and you're getting a lot of them. So the amount of people is going to limit you. You cannot go lender or individual partner. You have to go to the fund, and that's based on the amount of people that can participate in the deal.
And so keep in mind here, you're raising millions on a specific deal, typically. This could be an individually syndicated deal where it's like, this is one value-add apartment building complex. Or you could say, this is a whole concept. I'm doing, multifamily real estate in, East Texas. I'm doing RV parks in these locations and areas. And you've got a structure that's like, if I can buy whatever fits into this structure that I've kind of represented. Now, over here in the investor model, it's going to cost you at least $25,000 in legal fees to get that set up. So if you're not raising millions either, don't even get over here.
Yeah, so let's do a little pop quiz for everybody. If I need $100,000 for a deal, whatever that deal is, should I be syndicating that through a group of investors, or should I go partnership or lender route? What's the answer? Should I go investor, or it's either A, B, C? What is it? Okay, it should be a lot of A's and a lot of B's. If you're going to go and raise $100,000 for a deal, you don't want to go spend $25,000 with a securities attorney to put a PPM together and like put a fund together. You're burning 25% of the money you need to raise. It's stupid.
Yeah,
it's not worth it. Right now, if you're going to go raise $10 million, what's the answer? $10 million, what's the answer? A, B, or C? immediately. So what happens is when there's some deals coming up here for Matt and I to look at today, based on the dollar amount that they say they need, I'm immediately going to go up fund or partnership or lender. Like I will know right out of the gate based on the dollar amount they need to raise. Do you, surface level, you tell me a dollar amount, I go, oh yeah, you need a fund. Okay. So as you guys are listening to the presentations today, do the same thing in your mind as you're taking notes. Go, oh, this person, Matt, is actually the first person that's coming up here. Matt's going to come up here and he's going to say, this is how much money I need for a deal like this. And you're going to immediately go, oh yeah, should be a lender or a partner, or dang, bro, you need $7 million. You're going to go through a syndication or a fund.
All right. Lender, partner, investor, choose your warrior.
Poison?
What is it? Choose your
operator. We'll use it operator.
Okay. Yeah. Your avatar. I don't know.
Poison. Choose your poison.
Yeah.
How about that?
Yeah. That's a little nice. But I think if you focus in on how you're raising, the documents. So by the way, pretty inexpensive to do this. You can work with a title company, get some docs you can reuse over and over again on this lender model. Partner's a little more unique because you might change it up. People might have different things that they want in it. But that might cost you thousands. We're talking hundreds, thousands, tens of thousands between lender, partner.
Here's a hack around that. Okay, this is a really good hack. I've had some of my sellers that I'm doing deals with pay my fee to your law office.
Yeah.
Okay. So what I did a deal last year. I bought a home from a seller who was in foreclosure. I bought the home from him and I turned around and leased it back to him. Okay. And he has 2 years to buy it back from me. Okay. So we call this the blow method. Okay. Buy and then release the property back to him and give him an option to buy. So BLO. I buy it, I lease it back to him, and I give him an option to buy it back to him. BLO. So those attorney's docs that I went through, we had my team kind of basically run over them, and then we passed them to an attorney. But I told the seller, I said, if I'm going to stop this, I'm going to help you out. I just want to let you know you're going to pay for my transaction coordination fee. You're going to pay for my attorney to review all the documents. Before we get the deal done, you're going to have to pay for these things. I'm not coming out of pocket to pay for this. My profit is my profit. I'm not going to do my profit and then have to have all my fees come out of that. It's going to be my profit plus my fees. So for those of you guys out there going and raising capital, just know that if you're the operator like me, don't worry about the cost of these things. Get an attorney, get a transaction coordinator, and just have your seller or the other party you're buying the deal from pay for those fees. It's pretty simple.
And like over here, if I'm a private money lender lending money on a deal and I feel like I need a BPO or an appraisal, or I need some type of underwriting done or some documentation to feel good about the value, well, what does the freaking bank do? WWBD, what would the bank do? Not a good way to live your life. But when you're investing, okay, it's a good thing. Think about that. The bank's going to think, all right, what's this property worth? We're going to go get an appraisal. Who pays for the appraisal when you get a loan from a bank? The borrower. The borrower. The bank doesn't pay for that. You pay for that borrower. So if I'm a private money lender, I'm going to say, go get me an appraisal. Now I might not require an appraisal, but I want some indication of value. Maybe it's a BPO. There's other things you can get. I might have some type of credit. I'm going to look into their credit worthiness. I'm going to look into their track record, like Pace said. Is this their first deal or not? If it is their first deal, they're working with someone that knows what the heck they're doing. But that's what the bank's doing. When you lend money, they pull your credit history to say, when this person has borrowed money before, have they paid it off? That's essentially all it is, right? That's what your credit history is. And so think of those things and feel okay if you're someone with the cash to require that person needing it to validate this and provide information to you and put the cost on them.
You know what's so fun about being your friend? Is you know your shit.
Oh, thank you.
Bro, you're so good.
I appreciate that. Well, I'm just so excited to be here, Pace.
I'm excited to be here too, man. It's so fun to be able to do deals with people that, like, you've gone on a completely different journey than me.
Yeah.
And then for you to be on a path, you've been collecting resources and relationships, and you've done thousands of mergers, acquisitions, all sorts of things for other clients. What's great is when I go to your company and I go, hey, Matt, I'm buying the company, The Plant Guy, or I'm buying the Perfect Clean, or I'm whatever I'm doing. You come with a collective group of information from other deals that you've structured. Go, oh, I like this. Do it this way, this way, this way. We did it for this person this other way. I don't have that information. So what's great about leveraging a much more intelligent, experienced person on a very specific path than myself is that I get to borrow 25 years of experience plus his entire law office's experience on one deal. And I have the person I'm buying the deal from, the seller, or I have my borrower pay for those fees. It is, what I'm trying to tell you is if you do it right, Matt and his entire team is completely free. If you do it, if you structure it that way.
Yeah.
Awesome.
Can I say one last thing?
Hell yeah.
Okay, let me say one last thing on this. All of these areas here, you need to have legal advice. Go get your own legal advice. You can use our law firm. That's fine, but we're busy. I'm not just not meant to solicitate that. But just like go get the right legal counsel and structuring. But if your deal is good, the cost of that legal service is baked into whatever you're doing.
Yeah.
If you're doing a fund and it's cost you $25,000 to get the fund doc set up, that's reimbursed to you when you raise the capital.
Correct.
And if your deal is good, you're going to raise the capital. The problem is not the cost of the lawyers and the documents and all the stuff you got to do. The problem is the deal good or not? If the deal's good or not, it's going to pay for that and you're going to raise the capital.
That's an entire YouTube video by itself.
Yeah.
It's a really good point. Like Ashley Delani, she's down here. I just called her seller for her. She had, she's buying a dog grooming business up in Flagstaff for about $4 million. She went and got it.
Wow, that's a pretty, they must groom a lot of
They're
dogs.
making a ton of money. They bring in like 300 grand a month.
Love that.
And it's dog boarding too. It's a whole bunch of stuff.
Okay, yeah.
So they do, in their good months, they do 300,000. In their bad months, they do like 120,000. So it's a multi-million-dollar business. They've got the market cornered in Flagstaff. So Ashley goes and structures this as a cash purchase, and then she goes to apply for an SBA loan. The SBA is like, yeah, we're gonna like take all your children and all your this. She's like, I don't got no children. Okay, great. So she comes to me and she says she's on a Subto family night, and which is a Zoom we do every week. And she says, Pace, I don't know how to fix this problem. I go, easy, get me on the phone with the seller. I'll restructure that $4 million deal. I'll unravel the cash transaction and I'll reset it up as a creative finance deal, which we did. Okay, so the deal's phenomenal. She's gonna walk into the deal, instead of having to put $3 million down, she's gonna buy a $4 million business and only have to put $200 or even $100,000 down is where we currently are. And she's able to take over everything else on seller finance, which is awesome.
Love that.
It was a great call. Did anybody watch this call the other night? Where were y'all? Who was on that? Who was on that call the other night? Give me. Okay, cool. So now, guess what my next step is? My next step, Ashley's like, oh my gosh, you restructured the whole deal. What do I do now? I go, call Matt's office, get Mark, Scotty, and she goes, Scotty Pippen.
Yeah. It's Mark Fetzer, by the way.
Mark Fetzer, he's Scotty Pippen over there. This is Michael Jordan, but Mark is Scotty Pippen.
I'm playing baseball right now. So.
Oh yeah, you're retired. You're over. What is it? Chicago
White Sox.
White Sox. So our next step is to now go to the attorney, and like what most people do is they go, what about the cost of the attorney? I'm like, dude, you're going to go get a private money lender or a private money partner on this deal because she only needs $100,000, maybe $200,000 for this particular deal. That you just need to fund the legal fees into the raise. That's it. That's where the money comes from. So structure a good deal, and you'll be able to get your attorney's fees based on your raise or the way the deal is structured. Okay. Yeah. Amazing.
Perfect.
We got 800 people in the live Zoom today. I don't know how many people we have on YouTube. 265 people. Do not give them the Zoom link. Everybody in the Zoom is in our private community. Everybody out there on YouTube, if you are in our private community, Subto, Gator, Top Tier TC, please go into one of the Facebook groups and jump into the Zoom. The Zoom is where people are popping off, networking with each other, having a good time. What do you say we get into some teaching moments, some stuff? So here's the people that put this together, okay? Birdie, Luz. Can we show the audience, Eric, please? Birdie and Luz, will you stand up real quick so people know? We got a blonde and a brunette right here. We got Luz on the left and Birdie on the right. They put this all together working with Matt's office to coordinate all of this and have a bunch of fun. You have also, from my understanding, helped educate the people who are presenting and are teaching today get ready for this. Is that correct?
Yes.
Okay, how much time are we giving them today to teach us about their deal?
They are getting 5 to 10 minutes max, and then answers and question time for you.
Okay, cool. So they'll present what they currently have or teach about the deal that they have. And then Matt will ask questions as if Matt's a lender, a pimp, or an investor.
Mm-hmm.
Okay. You look like
a strong pimp game.
I know you do, bro. I know you do. Okay, so everybody in the side audience, please give it up for Birdie and Luz. They put a lot of work into this. They put
seriously.
a couple of months of work into this. We love them so much. We appreciate them. We also have Sam on the team that put a lot of work into this. Sam, we can't see you. You need to walk over here. You got a dope jacket. We need to see that. Sam, we love you. We appreciate all the work you put into this. Who's our first speaker?
Wait, we got Jared Ortiz, my guy.
Jared Ortiz.
My chief of staff, Jared. He's in the chat too.
Hey, Jared, come up here real fast. Everybody needs to see the mullet, dude. Come up here real fast.
Jared was bugging, losing Birdie on, New Year's Eve and stuff.
Stand up there in the presentation box.
He was great.
Jay.
Wow.
And here, I want to say this with Jared too.
Step over to your left.
Okay, how old are you, Jared?
26.
Jared's 26. He's already self-directed his IRA. He's done some private money lending out of it.
Yep.
Okay. And he wants to invest in a deal today too. So
Got paid off a bit early on my last one. So
okay, he got paid off. So he's like, I got a little bit of money I want to throw in a deal if something looks good.
What kind of money you feel comfortable throwing into a deal?
right now I've got 15 in an IRA LLC.
Hell yeah, bro. I could take every penny of that.
Cool.
Better be good.
I love that.
right.
What do we call this haircut, by the way? Turn to the left and the right. So
We
people
call
can
that
see.
haircut a mistake.
Yeah.
I think Jared knows I love him. He's, by the way, he is so incredible. I just am lucky to have him.
26,
But-
dude. You were 20 years ahead of me. Like, congrats, man.
Thank you.
On being a badass. Like, your parents just raised a good dude, huh?
Thank you.
They did.
Try
What
my
are mom
best.
and dad's names?
Pedro and Deborah.
Hell yeah. Shout out Pedro and Deborah.
And he's a Mesa boy.
Real, you're a Mesa boy
Yep.
like us.
Yeah.
Just got a house about 15 minutes away, so easy drive.
I love it, dude. Congrats.
Thank you.
Yeah.
No, sadly not.
You went and like got your credit pulled? Like people still do that nowadays?
Yep.
Okay, cool.
Yeah.
Let's see if we can.
He was looking at it doing that, but anyways.
I want to put your money to work. I'd love to have you in one of my deals.
Love it.
My team like full on educates our lenders on deals. Like they walk out of the deal going, holy crap, I know Kung Fu now. This is amazing.
I love it. Oh, this has been great. I'm learning a lot. Just
How's
in the
it been
back.
working with Birdie and Luz?
They've been great. Really helpful. I was bothering them last 3 weeks grind time.
So this wasn't just some random thing we put together. This took a lot of time to orchestrate.
Yeah, they've been working hard. They've been weekly meetings, right? With the people presenting as well, getting them prepped.
Thank you. Thank you, team. All right, let's Sam, will you come up here? Let's talk about the first speaker, please. Now, Sam, let's stand in the presenter's box so the presenter knows where to stand when they come up here.
Absolutely.
That's a little far away. I want you to walk a little further. Look to the camera. See the screen right there?
Yep.
You see how you're not centered quite yet? And I want you to step forward just a little bit too.
Oh, that looks good.
There you go. That's the spot. So every presenter needs to
right.
know that that's where they need to step, okay? Now, Sam,
Yes, sir.
the camera that you would be speaking to if you wanted to talk to the audience is where?
Right here.
There you go. So if I'm a presenter, I want to look at that camera as much as I possibly can to connect with the audience as much as I possibly can. Of course, Matt will be here to judge you. I will be here to have a little bit of fun. I learn something new every 1 minute I'm with Matt. So this will be great. All right, Sam,
Yes, sir.
what's the structure? We got 5 to 10 minutes.
We have 5 to 10 minutes, and then we will have about 30 to 40 minutes for you and Matt to go ahead and poke holes at the investment, ask questions, anything that you guys would, as an investor, ask these presenters.
Okay, cool. I'm going to act as if I'm one of the audience members, and so will Matt today. We are not giving investment advice. Just so you guys know, I'm going to say this again, because I've had people invest in deals from people that just come on my YouTube channel. I go, hey, come on my YouTube channel. We'll talk about how you did a $40,000 door knocking deal. Next thing you know, somebody calls me up and goes, hey, this guy that was on your YouTube channel, he hasn't paid me back right away. I'm like, so how is that my fault? Well, you put him on your YouTube channel. Guys, don't hold me accountable to that. Do your own due diligence. Dig deep into the deal. Have somebody look at it and verify it. If you are in the community, make sure you get your safety badge before you ever invest in anybody's deal. We have a safety merit badge that you can earn that teaches you how to safely invest in and partner with other people. So if you are in the community, do not deploy capital unless you've taken the safety badge. All right, Sam, who do we got up here? We got Matt Pochman coming up here.
We have Matt Pochman.
All right, Matt,
Come on, give it up
let's
for
get
him.
Matthew, come on up here, brother. Wow, bro, you're the handsomest Canadian I've ever seen in my life. Holy moly. Now, guys, he is a transformational speaker. He's incredibly sharp. He's got an amazing family, well-respected in our community, and he's got something he's going to teach us about today. I have no idea what the deal structure is, and so, Matt, It's all yours. Introduce yourself, whatever we want to know about you, and then jump right into the deal.
Thank you, Pace. Appreciate you. This is the best community ever, guys. Thank you so much for having me. And Matt, thanks for coming today. I'm going to tell you a little bit about me, and then we're going to dive into this awesome mobile home park deal. If you are following Pace at all or the real estate realm right now, you know that mobile home parks and RV parks are like the hot trend right now. And there's a few different reasons why, and we'll talk about that. So who am I? I am the handsome Canadian, as Pace posed.
Soon to be an American, just so you guys know.
That's right, yes.
51st state coming up soon.
That's right. Fingers crossed. Yeah. So I am a transformational coach, and but before that, backing up, I worked in law enforcement for 17 years in multiple capacities, national security, plainclothes surveillance, narcotics, and then I ended on a SWAT team. So that's my background. I bring that integrity to my investing, and now that I'm a transformational coach, I teach people how to transform and change their lives. So I bring that aspect to my investing, and it's all positivity. There's no problems. It's very solution based, right? So the way I look at real estate is, and Pace taught me this, there really is no such thing as a bad deal, and there's no such thing as a problem. You just have to be more creative. So as your only limit is your creativity. So that's who I am. I'm a dad, I'm a husband, I'm foremost a Canadian, and I absolutely love Owners Club and Subto in the community. So that's me. That's a little bit about me, but let's dive into the deal.
I love, just to give you some judgment here, I really love that you jumped into your past and you pointed the fact out that 17 years in law enforcement, okay, and ended in SWAT. Is that helpful or not helpful when you're trying to raise capital?
Super helpful.
Super helpful.
I wrote down 2 things. That was one of them. So
yeah, good.
that was big. Law enforcement.
Great way to start, brother.
Good. That adds a ton of credibility. So
Thank you. Appreciate that.
I like that.
So diving in, we got a 32 unit mobile home park here. Is the clicker working?
So let me ask this. Was this like, were you like on a horse, like a Mountie, or what were you?
No.
Canoe or, Mounties.
They are Mounties. Very good.
Okay.
Yeah. No, I never was on a horse. No.
Okay. This is like Canadian law enforcement.
Yes.
Okay.
Yeah.
All right.
Which is equivalent to the US. We have the same type of threats.
Yeah.
Yeah, you guys have all the same drug addicts, all the
same stuff.
narcotics, all the same stuff going on over there.
I was
What city
actually
was that in?
Toronto.
Oh, okay.
So I was
Big
actually
city.
protecting the nuclear facility on the SWAT team there
Very cool.
from terrorist threats. So yeah.
All right.
Oh, pointed at the computer.
Would it be better if you just used the clicker, like on the mouth? Oh, there you go. Let's do that.
Let's do that. So this is a disclosure. And again, you might want to consult your attorney for any of this. These, like Pace and Matt mentioned, are investment opportunities. So nothing is guaranteed. These are projections of returns. And if you can't afford to lose money, you should probably not be investing money, right? I think that's easily as put as it can be, but I'm not here to give advice, or especially legal advice. I'm not a lawyer. So consult your attorney before you jump into any of this. So this is just your typical disclosure. So I already touched on myself. I have a photo here of my beautiful wife, a little bit of my background, 17 years in law enforcement, where I am today in my real estate portfolio and my journey in real estate. I'm 5 years in, about $6 million in assets under management, 44 units. So that's where I'm at right now. The majority of that is multifamily, but this past year, my first Subto deal right before SquadUp.
Yes.
And now it's a co-living property. So turn it into a pad split. Super proud of that. And it's rocking and rolling and cash flowing, which is super exciting. So, but the rest of the portfolio is primarily multifamily. So this is the park right now as is. Right now, it's actually cash flowing on entry. Not a lot, but what we do typically is I look for value add assets, right? We're looking for places that are underperforming in the rents that have opportunity for us to lift. So this property has all of that. So underperforming rent means I can raise the asset, force the appreciation, and like Pace does, we can refinance into agency debt later on, which is a great model. So this park hits all of that. By the way, this park came to me through the community. This is a wholesaler within Subto. So when Pace says you can find everything you need in the community, he's totally right. So as is, we have 8 TOH, for those who aren't familiar, tenant-owned homes. So these are homes that the tenants own and they pay a lot fee. So that's important to know. So when we're talking about mobile home parks, it's going to be TOH or POH.
Isn't it crazy that nobody told you that when you were younger that you'd grow up just to rent dirt?
Yeah, that's interesting. Yeah, absolutely. I never thought of it that way. Yeah, absolutely. But it's a super exciting strategy because renting the dirt is something that people need, right? And you can actually make a lot of money off it, which is really interesting. So we have 19 park-owned homes. The reason why I really love this asset is because the previous owner bought all new homes. So all the homes that are park-owned are newer than 2020. So they're less than 5 years old. So we have very little CapEx to worry about in the next foreseeable future because the homes are in great condition. The tenant-owned homes, some of them are a bit older, but we're not worried about that. They own the home. We just charge it, like Pace said, for the dirt. So it's a great model. This particular asset, we have 32 pads, but 2 of them are oversized. So we can actually get 34. So we're going to be doing that along with raising the lot fees and the park-owned rent fees. So within the first year, because it's already cash flowing, we're going to be seeing a $17,000 lift, and that's in income net every year going up.
Your fixed costs are the same, right? You're not spending any more money, but you increase. What's cool about this deal is that if you increase the dirt rent, the lot rent on these deals, and also the park-owned rent, all of that just hits the bottom line. You're not adding another manager. You're not having to do any additional, like your fixed cost stays the same.
Yes, absolutely. And that's what's really cool about it. And that's why I love multifamily and mobile home parks fit into that, I guess, asset classes, because you can raise the rents on a great scale and really increase your bottom line for yourself and your partners and investors, which is the best. So that's where we're headed with this one. This is a deal overview, just kind of giving you guys a great big overview of what's to be expected. When we go into this deal, it's about a 5% cash on cash. By year 2, we're about 7% cash on cash return. Over a 5-year hold, we're looking at about a 12% IRR. Now, I really like that the annual cash flow is about $60,000, averaging over 5 years. That's after we've paid a 6% pref to the partners. So on this deal, I'm looking for pimps, I'm looking for PMPs, I'm looking for private money partners to come in, be on title, own the asset with me, right? We're partners in this deal, right? So this is important. The structure on how the equity and the cash flow is paid out is a waterfall structure. So 85% of the cash flow, 85% of the equity is all given to the partner who comes in with the initial capital, right? And I'm taking 15%. Now, why that's important is I'm operating, like Pace says, he's managing, he's funding, he's operating, and he's making sure that the asset is performing, right? Nobody's doing that for free. But here, they get to partake in 85%, which is really great.
That's freaking better than like 90% of deals I ever look at.
Thank you, I appreciate it. So moving ahead, this is the breakdown. I'm raising $775,000 for this deal.
Why only 775? Are you getting agency debt right out of the gate?
So great question. So this is an interesting deal. The seller, who's also an investor, he's in the mobile home park space. He is not wanting to sell. So we're doing a bond for deed for 2 years. So we're going to close hard title on the actual homes.
Okay.
And then we're going to close title in 2 years with the bond for deed on the dirt, on the land.
Love it. Okay, cool. So the seller is doing an executory contract for people in the community, which means that it's a very fancy way of saying seller finance to Matt. He doesn't want to have a tax implication, it sounds like, right out of the gate.
Correct.
And so Matt is going to the table with a good structure that helps him mitigate some of those taxes and also allow Matt to get into the deal without having to go and get agency debt. So welcome to Creative Finance. This is amazing because you don't have to go apply for that loan right out of the would
Yep.
He wants to do a 2-year balloon, you said?
2 year.
So that
1 year
would
clause.
Okay, love it. So that would give you enough time to improve the property, raise the rents,
Yes.
and then go and refinance him out within 24 months. And if you can't for whatever reason, let's say that interest rates still haven't come down to a point where you want, he'll do a 1-year extension. Now, what does that 1-year extension cost you guys?
Nothing. It's a 1-year extension clause written into the contract, the bond for deed.
I love it. Okay, cool.
Yeah. So we're only asking for 775 because we're going into a really good asset where the homes are all that are owned by the park are all under 5 years old. So we don't need a whole bunch of CapEx off the hop. What we do want to do is there are 4 pads right now that are vacant. 1 is listed already, but the 3 that are vacant, we're going to buy brand new park-owned homes. That's what the $65,000 in CapEx is for. So we're going to finance 3 brand new single wides. I've already been in touch with the manufacturer. Their build time is about 6 to 8 weeks.
Okay, cool.
Yeah.
Now, if I was an investor in this deal, just me being me, and I own mobile home parks, I would look at that and I would almost come to the table with Matt and I go, can I push on maybe the idea of not filling those lots and marketing for people to come and rent the dirt from me and put their RVs on it or whatever else?
100%.
Because, and I don't know, you would have to do the underwriting and you look at it the long term and go, okay, is it better for us to own the unit? Because what happens at my mobile home parks is that people come and bring their own units and then like 3 months later, they're gone, but they left the unit.
No way.
Yeah, they leave the unit.
That's incredible.
They come and bring in a $30,000 or $50,000 mobile home, and then 3 months, 6 months, 9 months later, we're like, hey, nobody can collect your rent. What's going on? Oh, I moved out of that last month. You can keep the house.
Wow.
So I know it's the craziest thing. It's the weirdest thing, right? It's a different demographic. It's not somebody that lives in Paradise Valley. You know what I'm saying? It's people that live in mobile homes. So I might push on that on my underwriting. If I was going to invest in this deal, I'd say, hey, Matt, show me the difference between you just renting out the dirt and show me the difference of us going and buying that park-owned home. I like the plan. I'm just saying I would probably push on that a little bit.
Well, I'm glad you brought it up, actually, because I have that underwriting because originally I underwrote it as TOH. So I originally underwrote it as the 4 vacant lots. We're just going to rent them out either as RV or tenant-owned homes, and we're just going to make money off the dirt. That's the easiest, quickest way to turn it into more cash return. But after talking to the property manager, and again, this comes down to, this is really what I base the foundation of my real estate journey on, and my business is creating authentic connections with the people. And so getting to know the property manager, she's like, we haven't had the best experience with tenant-owned homes in this area. We have a lot better experience with the park-owned homes, right? And we want to have a good park. We want to have the homes maintained. We want to have people take pride in their park, right? And it ups the tenant profile. So we do have numbers for both.
You're probably, not probably, sounds like you're 100% on the right page. I have my mobile home parks in Yuma, Arizona, where even if I put on brand new homes, the area where all the other mobile home parks are, it's bad. It's like chicken farms everywhere. It's not conducive for new mobile homes, right? It doesn't matter how nice they are. I would never attract that quality of a tenant because of the outside area. So you knowing that tells me you've done a lot of due diligence.
That leads me, that's a great segue actually. So the due diligence on this park is, it's a very small town, but it's right next to a place called Fort Valley. And Fort Valley is really key in this investment because they have a university, a hospital, and an Air Force base. And the reason why Montezuma is so sought after and this park has weekly calls to see if they have any vacancies is because everyone who lives in the Fort Valley area or works there, they can live in Montezuma for half the price. So it's a half an hour drive. So it's a commuter town, but it's surrounded by peach and tomato farms.
Wow.
And the farmers are not developing. They're leaving because of the state of the economy, they are leaving their generational farms to their children. So there's no room for anywhere to build. So this park has great land value.
For people that don't understand why mobile home parks are like the wave of the future in a lot of ways, like you've got Invitation Homes and Blackstone coming in and buying up, like they're buying mobile home manufacturing companies because they want so many of these. Why would you say the future is really bright for these types of housing?
I mean, affordable housing is something that everyone needs, right? I think with the state of the economy and interest rates and everything is just getting harder and more expensive for the next generation. So affordable housing, that's why co-living is so important right now. And it is such a big rise is because people need to make their dollar stretch and they need help in the cost of living.
Yeah, just a quick point. I had Erin Moore, who's in our community, she sent me a message this morning. She said, hey, I've got this Airbnb I want to partner with you on. I said, immediately no. She's like, you don't know the address? I go, immediately no. Why? Because I'm out on certain strategies because the economy is out on certain strategies. Do we need more Airbnbs in our marketplace? No, we don't need more. The public has spoken and Marriott Group is spending billions of dollars to lobby against certain strategies. So what I want to do as an investor or somebody that would come in and partner with somebody like Matt is I want to be getting into deals that are future-proof. Nobody's going to come along and go, man, we need less mobile home parks. In fact, it's growing tremendously. It's going to triple in the next 10 years because of its affordability. So for long-term, hey, I'm investing in a deal. There's a couple of things I like. Decent return. Okay. Is it a grand slam home run? No, but you're being conservative. Okay. So you got a good conservative return. You get an education on mobile home parks. Chances are you guys, as a group of people that are going to invest together on this deal, are going to go buy more.
Yes.
And that is a future that you could build a whole portfolio around just that one model rather than just sporadically buying, oh, today I'm doing an Airbnb and tomorrow I'm doing this. Dude, like mobile homes are future proof.
The other thing about this deal specifically is because it has such a healthy cash flow, I'm able to give 90% principal recapture at the 2-year mark. So for any investor, that's like huge. 2 years, you got almost all your money back.
That's a big deal. I mean, most people that are investing in a bigger deal like this, it takes 3 to 7 years to get their money back.
Right.
That's great.
But you're actually still partaking in the equity, even though you have 90% of your equity, 90% of your principal capital back, you're still partaking in equity and cash flow until year 5, where we have our exit, which is multiple options. We can either sell or refinance.
Okay, cool. And why is the seller selling this property in the first place? I know you're not direct to seller. You bought this from somebody inside the Subto community, which is amazing. Using your status and your leadership in the community to have people bring deals to you, that tells you that you are somebody that is trusted enough to have people bring you deals like this. Do you know why the seller is selling this property?
Yes. So because he is an investor, he is moving into a bigger mobile home park development in Florida. So he's taking his capital from this and rolling it in to a bigger, I think it's like a 3,000 unit mobile home park. Speaking of the future of affordable housing, he sees the future.
Okay, cool.
Yeah.
Got any questions?
I have a lot of questions, but I was going to wait and see if he was done.
Oh, sorry.
I've got a few more.
Damn.
So
Was that a shot?
I'm ready. No.
No, I was just, we all got our styles, but what else you got, Matt?
What else do I got? So right here just breaks down the investment return. It's basically a 1.5 equity multiplier in 5 years. If the partners at 5-year mark, we don't want to sell, we want to refinance, I'm happy to bring them in along with me to the 10-year journey, which is great for them because then they get to still gain, even though they have all their capital back, they're still getting equity and cash flow for another 5 years. So at that mark, they're looking at a 2x equity multiplier. So, yeah. Do you want me to leave that screen up just so you can have a peek
That's
at
a
it?
good one. What else? Is that it?
I've got a few more.
Okay.
Yeah.
Well, I mean, I
can come back to this screen. I think I'm way over.
Pace. Okay.
So, I mean, we've got the regular pro forma of looking at the numbers. Pace talked about his mobile home park, actually, the one you just did. Very similar numbers to this. After year 1, we're looking at $36,000 cash return. That's net income after we've paid the pref. So that's a good, healthy amount of cash flow where the partners are getting 85% of that.
Okay.
By year 2, we're looking at 50,000. And then every year after that, it goes up.
Okay, well, let me hit my questions if you don't mind.
Please.
This is awesome, by the way. Great job. I loved how you presented it. One thing I'm curious about when I'm hearing something is I always want to hear a story. Like, and I just think this is just me, but I think a lot of investors, they want to know the story. Pace's last question was really my first question that I wrote down was, why is the seller selling? Because I start thinking about where's this opportunity for you and how do I fit into that? And so sometimes it doesn't matter why the seller's selling. They just undervalue the asset and you see the value. Sometimes you're repositioning the asset and doing something differently than what they did. Sometimes they're distressed. There's a lot of different things that can be happening. But I always love the story. So that'd be one thing I kind of trying to get the story. But I want another story too about like, what's your story? Like, what are you doing?
Yeah.
Like, what do you want to do, Matt? Like, you're going to get into this mobile home park. You've done some multifamily in the past. Why aren't you doing more multifamily? Like, I want to know if I was investing, which I'm considering that, like, what are you doing?
Yeah.
I'm investing in you as much as I am that deal.
Great question.
More than I'm investing in that deal.
Yes, agreed. So I'm doing 100 million in 5 years. So I think one of the fundamental things in multifamily and mobile homes.
Okay, why are you doing both?
Because I think it's a good concept to not put all your eggs in one basket. I love the multifamily strategy because I can force appreciation and I can get big equity gains, but I love being able to get high cash flow, but also there has to be a purpose behind anything you do. And I mean, this kind of goes back to me being a coach, but anything that you can get up every day and feel like you have emotional attachment to and purpose in, for me, that's giving affordable housing. So for example, there are 4 of the 8 tenant-owned homes at this park where the tenants are elderly. And I talked to the property manager and I said, if I raise rents to the ceiling, which is market rent, because they're quite low, what's that going to do? She said, they're not going to be able to pay. And they've lived here 20 years and they're elderly. And I said, that's not who I am. So I won't do that to them. So what can they handle? So again, it's getting into business and understanding, like you said, who's the operator? What is their goal? My goal is in 5 years to accumulate $100 million in real estate. So I have a very clear vision of doing it, but what's driving it is my purpose to not displace people.
Yeah.
Right?
Yeah.
So.
Okay. I should probably, let me just ask my question because I want to come back and give some critique separately. Okay. How are you planning to take title on this property? How is this going to be an LLC is going to be on title?
Correct.
I was actually looking for my phone when Pace was asking you questions about the acquisition, but so explain to me how you're planning to take title on this and what debt's on there right now, what's getting cashed out, what's not.
Yeah, so it's 1.57 is the purchase price. There's 975 in debt.
Okay.
Right, so he's taking the whole 600 in equity in cash.
Okay, he's taking that out and that debt's staying on.
Correct.
Okay.
And it's going to stay in his name for the next 2 years under the contract, the bond for deed, contract for deed.
But your LLC that I would be a cash partner in is going to be on title.
Yes.
Okay. All right. Okay.
Yeah.
That's cool. So when do you make money? I just want to make sure I understand that because I was trying to get, I know the 85-15, which I know your deal is a little skinny. That's probably the biggest critique on this is I see the opportunity. I think you're in the right lane of affordable housing. I like how you presented it and thought through it, but it's a little skinny on the profit return.
Yep.
For like a basically a 9% annual rate of return is not that exciting. But I have some ideas on that.
Yeah.
But when do you make money?
I make money at year 5. So generally my model is to hold everything. I like to hold everything. I want to grow generational wealth.
Why do you make money at year 5? Do you make money if there's cash flow?
Yeah, you make part of the cash flow.
Yeah, I make 15%. Sorry, I make money off the 15% right from year 1.
Okay.
Right.
You get the management fee?
Yep, I take a management fee off the front end.
Okay.
Yep.
What's that?
10,000.
Is that like an acquisition fee?
Yeah.
Like when you acquire? Okay.
Correct.
All right. So an acquisition
So it's a one-time fee.
Okay. All right. One-time fee when you acquire the asset. What's the, who's managing it and who's getting paid for that?
I'm managing it. So my payment for that is my 15%.
That's part of your job.
That's correct.
Is someone on site? Is there an employee doing this? Is that really you doing it?
I'm the one. So the property management with myself, she's been in place at that park for over 5 years and she grew up in the area. So together we manage the asset.
How does she get paid? I'm trying to understand that. Sorry.
The property manager?
Yeah.
She's part of the expenses here, right here in PM. She takes 8%.
Okay. So she's an expense in there. So you're getting paid to manage the property manager. You're not managing the property.
Yes.
Got it. That's what I was trying to understand.
Okay,
a lot of people, they have their own property, they have their property management company. That's what I was trying to understand. And then there's sometimes a conflict of interest with that. So you have a separate person who's on site that manages the property. That expense is built in. But
yes.
You don't charge that. The LLC that we're partners in is paying for that.
Correct.
Got it. Okay. Would you have, let me ask, what is the worst outcome that this could go? And what's the best outcome? You've modeled this for what you think it could hit, your pro forma, right? You feel like you're conservative in that, or where do you feel like that is? Like, is like pretty conservative or aggressive? What would you call it?
I think it's somewhere in the middle.
What would you call it?
What would I call it? Realistic, I guess.
Perfect.
Yeah.
Okay. So what's the best case scenario of what you think this would make for a cash investor on an annual rate of return versus what's the worst case?
I think best case, You were looking for a percentage?
Annual rate of return. Yeah. If you, I mean, you might have to work your model here a little
It's
bit.
going to be somewhere in the 10% range, best case. And worst case, I think it would probably be around 8. Because I've done the research and getting to know the area so well, there's such a high demand for that park. I don't see it sitting vacant at all. As soon as there's units available, they get rented. Like they have people every week inquiring, when will you have units available? So it's very sought after. There's no other parks that size in that area to service Fort Valley.
Is there a way that this deal works and a cash investor can make a 12% annual rate of return?
For sure.
How does that work?
We play with the numbers. We play with the equity. We play with the cash flow. Because
We've already given up 85%.
Yeah, but it's able to structure it out. That's the benefit of buying, holding over the long term, right? So I can make that money over the long term. It doesn't have to be in year 1 and 2. And I'm okay with that.
Yeah, because I mean, here's what I was thinking, like a few things. I've never invested in mobile home actually, but I like it. I like where you're going. I think where the market needs to go, there's an affordability crisis. You have a good scenario. You've got some seller financing built in. I like how you've modeled the deal. I really do. I think it's smart. I think the deal is pretty skinny when you run the numbers. Because I can get 9 to 10% in the S&P 500 that's been a 20, 30-year track history sitting in a brokerage account doing nothing. My personal money and anyone with their IRA or 401k. So I'm usually not even thinking about a deal unless there's 10%, because I got a lot more risk in this. In this deal in Georgia, I don't. So that's my first reservation.
Yeah.
Let's come back to that. Like, how do we resolve that? And I start to get interested at 12%. But really, if I'm a cash partner with you, I want to be thinking a 20, 30% return, because I have a lot of risk of loss. If this deal goes bad, it's mismanaged, there's something that happens, who knows?
So I think where it comes into play is because I have a long-term vision and because I'm always buying and holding, the 5 to 10 year mark is where this thing performs. It's going to double in value or more. So because we bring the rents up and they will double in that 10-year mark, we can get that 10 to 12% return over that 10-year period when we get from year 5 to 10 because of the equity. Does that make sense?
I think
But that's still not going to beat a 10% annual rate of return. An annual rate of return, and just think of that. If I can get a 10% annual rate of return, my money doubles in 7 years, 7.2 years. And so if you're like, well, we can double our money in 10 years, that's probably an 8% annual rate of return. It's not a lot.
I think you have to look at your numbers again, because if people are getting 90% of their money back by month 24, there's no way it's only a 12% return, because they're getting their principal back. They don't really have much skin in the game other than, let's say I invest $100,000.
Right.
Okay. And in 24 months, basically what I'm going to get is I'm going to get 90 of my original investment back. But I'm going, and plus the cash, the pref return along the way.
Right.
Now I only have $10,000 invested.
Right. But you're still getting the cash flow on the
cash
big,
flow. There's no way you're only at 12%. I think you're probably 12% for the first 24 months.
You're right. And I ran the numbers off if considering the return on the whole amount.
Got it. Okay.
Even though you're getting paid back. Does that make sense? You're getting paid back most of your principal at year 2. You're right. So
what I would do is I would rerun my numbers and I would go to somebody like a Matt and I go, hey, in the first 24 months, you will get a 12% IRR, internal rate of return. So I'll return you 12%, but I'm going to refinance and give you 90% of your principal back, keep you in the deal at the same amount that you were in. And now your return is like 42% because
it's 98%.
Okay. Yeah.
Yeah, because after year 3 and 4, the cash flow is about 70,000 and you've only got 75,000 in. So it's like a 90% return, because that's all the amount that you have.
I think you got to relook at the number to go to that. For somebody like Matt, you go, hey, you stick with me. You refinance your money out and not take all your money out. You keep some of it in. I'll let you ride with me all the way until the end. Your return goes from 12% IRR to 24% IRR, or whatever the heck the number is, but it's substantially higher.
It's substantially higher. I didn't want to put that in here because I didn't want it to be misleading, where people were like, how can he do a 90% return? It doesn't make sense.
Yeah.
Right. I just didn't want it to seem like not conceivable. I wanted to make it look like this is an actual real deal. and those numbers actually make sense based on what you see. Does that make sense?
Yeah, and
but you're right.
Where
The way
you're
it's structured.
What's tough about this is that, and you got to fight the good fight, is if you're in the beginning and you're raising capital and you can't say, hey, in my last deal I did 4 years ago, I quoted a 12% IRR. We ended up performing at a 21% IRR. Mm-hmm. If you could say that to Matt, and you say, look, Matt, I am saying 12% IR because that's how I roll. Mm-hmm. But here's my last performance. He would be like, okay, cool. I can gamble on that potential upside because you are a known performer.
Right.
But you don't quite have that yet. You will have that on this deal.
Yeah.
But you don't have that yet.
Yeah, fair.
Also, S&P sounds like simp to me. So for me,
Yeah.
It sounds like it to you, but not to a typical investor, because everybody has options, and where most people, if you're out trying to raise capital, that's your threshold.
Yeah.
Right.
Everybody that runs a freaking mutual fund in Wall Street, they ask me, do you beat the S&P 500 or not? Most of them don't. Mm-hmm. But it's this easy index people can buy on their phone in 10 seconds.
Yeah.
So, which I buy it sometimes. When I'm sitting between deals, I'm buying it because I'm like, it's kind of the default in many ways. Than just sitting in cash. Mm-hmm. So if I'm going to go out of default, I want to make sure there's an annual rate of return that's going to beat that. And IRR and some of that stuff can be very deceiving on deals. And so I think where I'm looking at a lot of more, and some of the, if they're going to model this stuff out with you and they're going to go critique your thesis, they can get into that with you. But I'm looking at annual rate of return. I think people can understand that. Because also it's like, how can I compare this if I just lent you the money?
I mean, it's very simple to understand. Like this one is going to do 12% for 2 years, and then years 3, 4, and 5, you're looking at almost 90%. So if you did the math on that and then average it over 5.
An annual rate of return, when you say 90%.
Yeah, because you have $70,000 left invested, right? 75,000, and you're making, there's the cash flow on the property.
So
70.
The collective group invests 750,000.
Because I saw annual rate of return here at like 9%.
Yeah, that's what I was trying to say. He needs to rerun his numbers.
Yeah.
You got to rerun your numbers because the first 2 years, yes, it makes sense to be at 12% or 9% annual return. But once everybody gets their money back and the return stays the same, right?
That's where they're making money.
Yeah.
Yeah.
Okay. The last thing I would say is, would you have a problem if someone came in as a cash partner in the deal? I'm in the LLC with you. Then maybe you're going to need a few people to collectively do this deal. 775 is a lot for one person on a cash partner on this type of a deal. Unique deal, creative, So, so maybe you need a few people in that mix, maybe up to 5, let's say, which that could work. But would you be okay with also doing a deed of trust on title and a lien securing the cash invested?
Absolutely. Yeah.
Because what's going to happen here, and this is what happens for a lot of investors in these cash partnerships, if it's enough money like this, like let's say someone dropped 200K into this, a couple other people combine, a few other, and you get to 775, is I'm not on the bank account with you. I could be. And sometimes people do that. I don't have the time to do that. I'm not going to manage it. I don't want to look at all the checks and all this stuff and all these little things coming in and out. So I could get lost with what's going on. And we've seen over my career, and so lawyers, sometimes I get the people that come to me and we made so much money. How do I save taxes? The other time we get people that come to us, I lost money on this deal. Can I sue this asshole that stole the money from the LLC checking account? We were partners and it just disappeared. But I was the cash person. They were the operator. So I was oblivious to this for 3 years. Now my money's gone.
Yeah.
But if I got a lien on the property that's protecting the equity, besides just my partnership in an LLC that's broke now, I feel better.
100%. But that also, and now the answer to your question is yes, 100%. But like Pace, I also have a personal $6 million portfolio with, I have $2 million in equity. So I can secure it that way as well.
Okay, cool.
The other thing
and you'd be open to that.
Yeah, absolutely. The other thing about it is
with a lien on and it could be in a second or
100%
junior position.
Because I'm confident in my ability. I know I can buy, operate, and lift this park, no problem. I'm 100% confident.
How I would pitch that, if you're willing to do that, I would pitch that in your deal, because the way you can preface that is that this has the characteristics of lending the money and being secured on real property, because there's equity that you can collect from in the event I don't perform. But it has the upside of participating in the profits.
Absolutely.
Which I think is pretty interesting. That's what I like about that.
Yeah, I agree. Back to
a lot of people don't do that.
Right.
Most people doing a deal like this, particularly if you put this in a fund model, you're not getting that.
Well, it comes back to your point. Is this person trying to make money off me or
Exactly.
with me? And I am primarily trying to make money with my partners together. And when it comes to like the bank account thing, that comes down to transparency. I'm 100% open, transparent. You want to see behind the books? You want to see behind the curtain? Let's go to the mobile home park. You can meet the tenants with me.
I don't want to.
Yeah.
So,
No.
sorry. No, I love
You don't. Some
I
people
love
might,
that, but
right?
I don't
yeah.
want to do that.
But it comes down to that trust and that authenticity. If you can find someone to invest in who is transparent.
And I'll think, and I just a lot of people that might be on right now, and there's always that hopefulness of that, or there's that excitement about it, and I'm going to be involved, and I'm going to know what's going on, and then they don't.
Yeah.
And I'm the same. And I've learned that about myself. And I've learned that about a lot of clients over these times. I got too much shit to do. It goes back to the return on hustle.
Yeah.
It's not worth my time. I want you to just do it.
And I'm
But I
happy to
also
do
want
that.
protection. And that's where if I can think of, I'm always thinking of title. How can I make sure I'm protected there? Even if it's in a second or something like that.
Yeah.
So, all right.
100%.
Did we go over
Final remarks.
final remarks?
Yeah.
I want to come back to, I'm interested in this. I want to, not just myself, but I want to, let's get back to that annual rate of return number and maybe rerun this. And maybe if you have time while you're still here, even this afternoon,
Absolutely.
if you can model that out and try to figure that out.
Yeah. Absolutely.
What's your timeline on this too?
So we're going firm on January 21st, and we are closing January 31st.
Oh, you're closing fast.
Oh yeah, success.
I mean, the
loves
best
speed.
deals are happening right here.
Yep.
We go. It's a real deal. Okay.
Yeah.
How much is going hard on the 21st?
20.
Is it? And that's already there.
Yeah, 20's there.
Okay. That's not.
Okay, Ingrid Hernandez, one of my favorite people on the planet, has a question.
Awesome job, by the way. Like the ease of confidence. I love it.
Appreciate it.
So there were some remarks in regards to you raising rents. I know that Georgia's becoming a little bit more regulated. Are there any foreseeable regulation changes on your ability to raise rents?
Not in the foreseeable future. That may come down the road. I do already own property in Georgia, not far from this property, about 2 hours north, just outside of Atlanta. We own a sixplex there as well. So we are managing assets in that state already.
And then is there any further protections because you're applying through a bond for deed, which we call it differently all kinds of ways, right? Land contract, agreement for sale, contract for deed.
Contract for deed, yeah.
Educating people in
Yeah.
chat. In what ways could this go south because you're not fully secured against the property per se?
I mean, any deal can go south in 100 different ways. And I think what's important is when you're looking at a deal, how do you mitigate those risks? By securing the asset, by securing the debt, and by making sure that your model for the future is sustainable, right? And I believe that I've done that with this, right? And like Pace does, if you are able to secure the asset by collateralizing it, everyone feels safe in the deal. And I think that's really important, right? So I hope that answers the question.
You had something.
Your personal guarantees are the thing that's going to make everybody else feel good about it.
Yeah, I mean, I'm confident this thing, I wouldn't even need to give it because it's going to perform. I know that there's a need for the mobile home parks. I know that in this area, it's in high demand because of its location to Fort Valley. So I know and I trust in the market, right? So I trust the deal because it's where it is.
So a little less about that and more that the owner still has control per se, because it's a bond for deed security versus a deed transfer.
Right. He's out. Once we sign and close on the homes, he has no, like, I'm operating the deal 100%. I make payments on his debt for 2 years and he's not touching it. He's not involved. Right.
Anything else?
No.
All right. So, couple of things. Great job.
Thank you.
Limited time, 10 out of 10. Anytime you have limited time, I was asking my questions throughout the presentation, just so you know. And I just want to say, as a fellow presenter, and somebody gives you 5 to 7 minutes, it's really hard to get everything involved. Okay. So I'm not giving this advice to you. I'm giving this advice to everybody else as a learning moment because you killed it.
Thank you.
Yeah.
Okay. Couple of things I would do for people that are putting these sheets together. I would put a what if sheet together. And what that sheet is, it should be at the end of your presentation, and it should have 15 or 20 what ifs. What if this happens? What if this happens? What if this happens? And it should have a link to a video of you replying to that what if question.
Brilliant.
So now as you're going through your presentation and you get through and go, all right, perfect. There's always a what if questions. We've looked at every possible thing. We asked the what if question. What if this, the seller, what if da-da-da-da, what if there's a hurricane? What if there's a fire? Here's all the questions. People look at that and go, they're not even going to watch the videos first and foremost. They might watch 1 minute of one of them, but they'll go, holy crap, this guy did his homework. So that's a good piece for everybody else. We do a what if sheet on all of our deals that we raise capital for. Also, IRR. I hate IRR because 99% of investors have no clue what it means. They have no clue whatsoever, so they're asking that question. So I really like annualized or annual rate of return. It's way more simple. It makes more sense for people, for everybody, honestly, across the board. So I like that you put both of them in there. Really good. The story is so much more important than anything else. So what I loved about Matt bringing up is, here's why the seller's selling. Now knowing a little bit more, the seller's selling because he extracted all the value out of the property. That's why. And he says, I now have been in the game long enough to know that I should take some chips off the table because I can strip a lot of money out of this deal and I can go deploy that capital somewhere else.
Yes.
Well, that's not you. So the opportunity is for you and other investors to come in and take a deal that might not be the juiciest type of deal, but it's a mobile home park. And so then I would jump into, okay, this is how we got the deal. This is why the seller's willing to do this. He's taking chips off the table, which gives us the opportunity to come in and provide affordable housing to the area, make a name for ourselves, maybe even start acquiring other parks in there, do a roll up where we all branded the same way. So if we don't have space here, we have space over here, et cetera. So that's the story that he's talking about, guys. Story sells all day long. People look at numbers and it gives them comfort, but like people will not write a check if they're not emotionally charged. You know this incredibly well because you know how to emotionally charge people. So again, I'm not critiquing him at all. I'm telling people in the side chat, when you are doing your own presentation, the story is way more important than anything else. I like
on the story, just
yes, sir.
Like riff for a second too with you.
Yeah.
It's the story of you and the story of the deal. Two stories. Whenever you're raising capital, make sure, especially with someone new that doesn't know you yet, make sure they get to know you. That's as important as the deal itself.
And
which you hit out of the gate, which was great.
He brought up the story, and then you told us about the tenant. Again, limited time, so I understand why you did. So again, this is not a critique of you. Other people in the side chat, when you have a little bit more time, that would have been a good part of the story of like, this is what our company, our group, right? Because people want to be a part of something. They don't want to just invest in something. They want to be a part of something that's doing something cool. And if you're solving affordability and you're like, we already have 2 families in here that we've been working with, that we're going to raise rents where we can, but there's some other places that we're okay taking some money off the table to make sure we're helping people because that's what our group is all about. That could have, if you had a little bit more time, should have been brought up. You did bring it up. You get my point. I like the deal. I think it's great. I would have to underwrite. I would have to look at the numbers. I think you have to look at the refinance of 24 months to get his attention. For me, if I'm a brand new person, I look at this as a different opportunity. I look at this as, man, I could stop by the property. I could sit in the office. Also, management side of things, when we were talking about the manager, that does she live in the park or is she out of the park?
Out of the park.
Okay, cool. So all of our parks, we have somebody who lives on site. We give them a reduced rent to be like eyeballs on the park all the time. I would maybe suggest that. It helps your management fee go down a little bit because somebody's there full-time, living there full-time type of thing. But I like the deal. I think the refinance thing is the only thing that you got to retweak, and then you're ready to present to people a little bit more enticingly.
Love that.
Give it up for Matt. Great job, brother. Really good job.
Appreciate it.
Now, leave that up there for just a second before I get to the next presentation so you guys can take a screenshot and reach out to Matt. A couple of things I want to do. Guys, we've been on here for about 2 hours, okay? And I want to tell you guys that I am looking at the side chat, and I appreciate everybody connecting in the side chat. One thing I want to ask everybody in our community, just throw your name and your number and your contact information in there one time. Don't do it 8,500 times, okay? There's some people that do it so annoyingly that they have no chill. Guys, if you need a Xanax, I'll find somebody to write you a prescription, okay? Just relax.
I got the handwriting for it, so.
Yours is great.
Yeah.
The thing you need to do is just put your information in the side chat one time and you're done. Why? because people can save the side chat by clicking on the 3 buttons down at the bottom. They can click on the little 3 buttons, save the side chat, and they have everybody's information. You just need it one time. So if you guys just can't help yourself, please do it right now. Put your name, your phone number, everything in the side chat right now. Do it. Just purge all of it. Get it out there.
Yeah.
What we really want more than anything else is we want feedback and questions in the side chat. Matt and I can both see the side chat. The live audience can see the side chat. What I don't want to see is your contact information every 30 seconds because it blocks my ability to see people's comments and what they're noticing. And what Matt and I want to do is we want to collect some of those comments, not necessarily talk to you directly, but take some of those and give those to the presenter. So do me that favor. Can I get a yes that is, we are all on the same page here before we go to our next presentation? Okay. Eric, who's running the board today, Eric, if somebody just keeps spamming the side chat, I don't care if it's my grandmother. You punish them by getting them out of here. We don't need, guys, in our private community, we don't need that, okay? Please. Yes, I want you to connect. So put your information in there for the 85th time, then be chill. Participate. You're here on a live Zoom on a Saturday. Participate by not having to freaking blast the chat with your information, please. Okay. Next presenter, Sam. Who do we got?
We have Kate Gomez.
Kate Gomez. We have Kate Gomez. Guys, give it up for Kate Gomez. All right. Hi, Kate.
Hi, Pace. Hi, Matt.
Hey.
Thank you so much for having me today. I'm so honored to be here.
Of course.
So I'm Kate Gomes, not Gomez, by the way. It's Portuguese.
Okay, so Kate, do me a favor. Look at the TV to your left. Do you see kind of where you're at? I would either A, step forward a little bit because you're not as tall as Matt. There we go. Yeah, amazing. I want to see your hands.
You look great.
Yeah.
Okay, here.
I couldn't see your hands before. So now this is so, thank you, Scott. This is so good. It's like you have style and integrity or something.
That's what they say. That's
Okay,
what people
cool.
tell me.
All right.
Leather jacket.
Now, couple of things, I don't know. I know you're out in the hallway,
Yeah.
but one thing I want to point out is that stupid remote. We got to buy a new remote.
They're telling me it works now.
It does now. Did you just?
The wrong button.
Okay, got it. Well, he was using Canadian buttons. I got it. We do think.
American, so
Okay,
you
look.
don't have to worry about that.
Yeah.
All right, Kate, you're in charge.
Okay, so in addition to having style and integrity, people also tell me that I'm a badass often, people who know me, because I'm a surfer, I'm a private pilot, a solo world traveler, and I've sold nearly $100 million in real estate as a realtor and closed over 100 transactions. I own a handful of investment properties and I've renovated a few. And today I'm here because in 2025, I'm going to fix and flip at least 15 properties.
I love how we're going from mobile home parks to fix and flips, by the way. This just gives us a completely different opportunity. So grateful for this.
Yeah, and it's fantastic to hear from Matt too. So I'm not talking about one particular deal today because, as you guys probably know, fix and flip deals, they come and go quickly. But as I said, I plan to do 15 at least this year. And I will be fixing and flipping bread and butter style single family homes in Central Florida. I call them bread and butter because they're like your average basic run of the mill 3-bedroom, 2-bath homes, around 1,300 to 1,800 square feet. I'm choosing these because they're easy to renovate and they're quick to renovate and they sell quickly. My targeted minimum return on investment per project is 18%, and the average investment is going to be around $375,000. That will definitely fluctuate depending on the deal. And I'm looking for a maximum of 2 investors per project because I feel like anything over 2, it gets complicated. And I want to keep this simple and moving. And today I have 2 offerings. The first one is I'm asking for 100% of project cost for 50/50 equity shares. So that will get.
Why didn't you bring this to me before you came and presented? Like, I do these all the time. I just did one with April Elias. We both made $100,000 on a deal.
I like that.
You got my attention already.
Don't get greedy.
Matt's here too. You want-
So I'm asking for at least 3 consecutive projects. And to your point that once you have more experience doing this, the rate of return for the investor can go down. And so I'm starting with this 50-50 equity partnership for 3 projects, and then we'll take it from there. So that will get you a minimum of 9% return on investment per year. And depending on if the project goes for 4 months or 6 months, it would be 18% to 27% annualized for you. So my second offering is for people who want, some people like to receive a monthly payment. So if you want, we can do 10% APR and 30% equity shares combo. So you may be wondering why Florida. Well, I spent about 8 months there last year and I fell in love with it. It has an excellent quality of life and the homes there are still below that national median average. I've built strategic relationships with wholesalers, realtors, and contractors. And I just think that it's a great place to be and a great place to fix and flip. Central Florida is also very diversified in their economies, and move on. So my strategy is to buy right, sell right, and renovate right. Very simple. Those are the 3 key elements to a successful fix and flip. And this is just a little bit of eye candy. Actually, this one is the before pictures, and then this is the style that I would be renovating in. This one here on the right is a condo I owned in California a few years ago. And as you can see, I don't like this one on the left is very white. And I don't, how can I say this? I like to add my own flavor with the wood and the color, and I don't do just vanilla. My years of experience in real estate, I would walk into homes that were fixed and flips and they were just all white and very cold feeling. And I don't like that. And part of the reason I want to fix and flip bread and butter homes is to bring a very nice home to people who can't afford the high-end homes, but you still make it a very nice, comfortable place to live. And this is a sample of a few deals that have come across my desk this last week and some of the numbers there. And that's.
Okay, I got a couple questions.
Yep.
Okay. So first thing I wonder all the time, I was a contractor for 10 years, as you know, did more flips than I care to even admit.
Yep.
The number one thing when you get into fixing and flipping is not even the operator, it's the contractor. So one thing I would suggest for anybody that's doing a presentation to raise capital for fixing and flipping is say, here are actual contractors that I'm planning on using.
Okay.
And here's their, amount of flips that they've done or other investors they've worked with. Because for me, that's more important. Actually, I think the contractor, knowing they're not going to run off with our money, because the number one thing you'll hear on a fix and flip, I lend money to, I'm a private money partner, which sounds like you're offering partnership rather than just lending.
Correct.
Now you are offering what I do like. You said, hey, I'll also do a 10% annualized monthly payment, and then I'll give you a less equity share. I'll give you 30% of the equity share, which means 30% of the net profit, and you, Kate, take 70%.
Yep.
I like that you're giving people multiple options. But the biggest thing I hear when people are lending money on fix and flips is they go, dude, my freaking operator hired a contractor, gave them too much money. That contractor ran off with the money. You can't even get a hold of them. And now they're asking me for more money just to fix the project.
Yeah.
So I know that you're currently networking with contractors, so I'm not going to push hard on you to who's your contractor?
Well, I can speak to a couple. As I said, at Central Florida, it's kind of a wide range of areas. So one contractor is not going to do all the properties. So currently I have a contractor on the Space Coast, which is near Cocoa Beach area. His name's Cedric. I have an Airbnb out there, and he's the contractor for my Airbnb manager. So he has, some great history with her, and I've spoken to him several times, and obviously I haven't done a project with him yet, but I'm meeting with him on Monday and spoken with him several times. He owns the companies that have the materials as well. So he's not somebody who's going to run away. And then, I have a flipping partner in Sarasota, Bradenton area, who you may know, Heather Dimmick.
Yeah.
We have a project going on out there right now. And so if I were to do another deal with her and you guys invested, she would be the managing partner. And she's amazing. She's done over 400 renovations. She has a crew out there. It's all dialed in. So
Love that. Now, why wouldn't you put her on your presentation? Like your face, her face, saying, here's the management team.
Well, because we're not
A formal
full-fledged
partnership.
right? It's deal to deal. She does her thing in her area, and she's not necessarily sticking to these bread and butter homes. I want to manage some projects myself as well and be the managing partner, like what she's doing in Sarasota. And so this bread and butter outline is specifically me.
Got it.
But if a deal came in her area that meets this criteria or doesn't, we may partner.
Okay, cool. Now on the fix and flip side of things, when you're a lender, guys, what's great about it is that Matt brought this up earlier. You get a rate of return, right? You're charging an interest rate. And what you said earlier was 18%, right? So how do I get 18% versus 50-50?
Well, no, the investor gets 9%.
9% interest.
18%
So you were
is
saying
the total project.
That was the annualized.
Oh, I'm
Go back
sorry,
to that
annualized.
slide
Yeah.
because you had that and I saw that. I stopped on
The
that too.
annualized is 18, yeah.
I think because you're saying you could do that twice. I mean, or that's just a 6-month
so
hold.
So these, like I was saying, these homes are going to sell quickly and they renovate quickly. So the whole thing should be turned in 4 to 6 months. So if you do it twice, it's 18% annualized. If you do it 3 times, it's 27%.
Okay. So if I deploy capital in deals 3 different times, the same money, we roll it over 3 times, which is kind of hard to do because the timing of that, right? Like you can't determine, unless you have a lot of deals in your pipeline, which you will, you'll have 15, you should be able to match up. Let's say Matt invests in one of your deals. He lends money to you on a deal. You could finish one in a quarter and then you're rolling his money into the next deal pretty quickly.
Yeah.
So you're saying if you did 3 deals in 1 month, Matt would get a return of 20% return on his money.
Not 3 deals in 1 month.
No, I'm sorry, 1 year.
Yeah.
That's what I meant. I'm sorry.
Yeah, that's the absolute maximum, I would imagine.
Okay, great.
Yeah.
I've went a lot on, I mean, it's possible.
How do I
To
get
get
the 50,
3 in with one operator in a deal. It depends on the type of projects you're taking on.
And the
But-
timing has to work out.
Yeah.
A new deal
I
has
love
to
that
come in.
if you
but-
could execute that. And
Yeah.
if you could, let me say this. If you had a track record on that,
Yeah.
done.
Yeah.
Done.
But 18%
Where you've
is
never
still
done
a
it before?
fantastic rate, though.
Mm.
Yeah, what I like about what Matt's bringing up, you've done $100 million in real estate transactions.
Yeah.
You're a private pilot. Being a private pilot is no joke.
I love that.
And you know, the
What's your call
consistency.
sign? I'm just kidding. You got to make one up. Call sign badass.
Yeah, I like that. So I like that you understand your buy box well. I love the presentation. I do like the credibility in the very front end. So you know you're going to know how to value a property better than 99% of flippers I know because of all the transactions you've done.
Yeah.
Which is nice. How do I get 50% of the deal rather than the percentage? Like how do I just get half of the profits?
That was my first option, your JV.
Okay, so option 2 is the 27% max in a year is if you lend.
No, the option 1, 50-50. So the entire project ROI minimum is 18%. So with my first offering, you would get the 9%, right? So what was your question?
How do I get 50% of the net profit on the deal?
You think the total profit's going to be 18% per deal?
Per deal.
Which means 9% for you.
Yes.
And if you did it twice, it's also 18%.
But 9% of what? 9% of the money I put in? So if I put in...
No, the profit, yeah.
The
No,
profit
50% of profit will equal 9% ROI because I'm not going to do a deal that gets less than 18% ROI. And you
Okay, so let's go to you have a screen a couple later that's like project, here's some deals in the pipeline. Go to the pipeline deal.
Pipeline.
Okay, so the pipeline deal right here. So if I look at the total net profit of this deal, what do you have? You have ARV 650, 615 purchase price. Okay, so you need to borrow on that deal. You need to borrow 512,000. The return on that is 23% of the 512. Okay.
And so you would get half.
Okay, so here's the thing. That's probably let's say it's a 6-month project because it's a bigger house. If I got $50,000, half of that. Yeah, okay. It's not 9%.
Did I do my math wrong?
No, I don't think you're doing your math wrong. I think you're just doing math done a way that doesn't make sense to me. That's all. It means you did it the way it made sense for you. So if I put in $512,000 and I get all $512,000 back in 6 months, and I get half the profit would be $55,000. Okay, so that's 10% return.
Yeah.
in 6 months, which is
Yes.
a 20% return for me annualized.
Right.
Does that make
Right.
sense?
Yeah.
Yeah, that's what she's modeling.
Okay, that's what you're modeling.
But
Okay.
you're showing 23% there.
This is just an example.
Yeah,
Yeah.
I get it.
Yeah.
And your math actually adds up. I'm just like,
Yeah.
what's the 9% and the 18%? I don't get that.
18% is the total project. Yeah.
The problem is this is because you used the 9 and 18 twice, because it is also if the deal has 18%
Yes.
profit
Yes.
and you get half of it, you get 9%.
Mhm.
And if we do 2 deals a year, you actually get 18%. Does that make sense?
Yeah, it
'Cause
makes
you're
sense.
50-50.
Okay,
It's
so here-
confusing the way I wrote
I lost track of it too for a
Okay.
second there.
Okay.
One thing is because where I'm going on this is the numbers.
Yeah.
Right. You have to understand the investor's concept perspective is. I want to come back to some other questions I had, but like they're going to start drilling into the numbers,
Sure.
right? Because they want return on their money. That's what I want. And you're showing me a better number than what you showed me at first. So I get to the pipeline and I'm like, well, how come you're not modeling and telling me what the return profile is what the pipeline's showing? Because that makes me feel like,
Yeah.
is this pipeline not realistic? Or are you being very conservative in your projection?
I think that I'm being, as the other Matt said before, realistic. Like 18% is realistic, but as a minimum number. And I think I said that in my presentation that it will be at least 18%.
Yeah, you did.
Yeah.
You did. I'm stupid.
Okay.
You've known me for a while, Kate. You
You're
should know.
the smartest guys I know. And
So I would say, here's how my brain works. I put in 500 grand.
yeah.
I get it back in 6 months.
Yes.
Plus 50.
Yes.
That's the number one thing I think. And I go, okay, so I made 10% in 6 months, which means I made 20% in a year if I can do this twice.
Yeah.
Cool. I'll do it all day long. I'll do it.
Hey, let's
Are you
do
kidding?
it.
Yeah.
Done.
And what's great about fixing and flipping, like when you're doing, you're raising debt, basically,
Yeah.
you're just raising money from a lender.
Yeah.
It's so simple. It's like
Yeah.
money in, money out. I'm not holding it long. So the benefit for these types of deals, if I'm somebody out there that's wanting to deploy my capital,
Mhm.
you'll find a lot more people to deploy capital in your deal than Matt will find in his deal, because what Matt will have a challenge with, and I do too on my big multifamily stuff, is people go, wait, I got to put money into this deal for 2 years.
Yeah.
Versus you're saying, hey, I'll have your money 6 months max. Our average will be 3 to 4 months. If something goes wrong, it'll be 6 months. Here's your return on the deal. Now you can choose to continue going or not.
Right.
There's a big benefit there.
Yep. It's like dating rather than getting married. Right.
There you go. Oh, in fact, going to Matt's earlier point about the story is I would say, hey, while everybody else is wanting to get into multifamily deals and mobile home parks and this, that, and the other, that's like getting married to somebody. All I want to do is date you. I want to take, use some good lines like that. Yeah.
You had me at, I just want to date.
Yeah, I just want to date you. I want to prove to you long term, blah, 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 blah. Like you again, you have a limited time frame before we start interrupting you. So you've done a phenomenal job.
Thank you. Thank you, Bertie and Lewis. They really helped me yesterday to.
Yeah. Okay.
it down.
Did we cut you off though? Did you have something else
No.
before we?
That's
Okay.
it.
So I had some other questions.
Yeah.
Okay. So my final question before I pass it on to a much smarter man than myself, Matt Sorensen, is buffer. So even me being a contractor for 10 years, we always have an allocation of buffer. So if my budget is, let's say, my renovation 70, that means my renovation is going to be 80.
Mhm.
Did you already include that in your 70? Meaning, hey, we think it's going to be 60, so I just put it in 70. So you already have
10%, not
Okay,
not
perfect.
10,000, but 10%.
10%. Okay, cool. When I was a contractor, I would call it effery. Like it's just the money that just freaking goes out the window.
Yeah.
You don't know why, but somebody overcharged you or something happened. It just happens on every single deal. So you already have buffer included.
Mhm.
What about time buffer? Do you believe that your 3 to 4 months already has a buffer in it? Or is that like, well, this is what's happening?
I think that 6 months includes the buffer.
Okay, got it.
Yeah, the one Heather and I are working on in Sarasota right now, it's a much bigger house. It's like 3,000 square feet and it's a complete renovation. And we bought that just before Boston. So just after Boston. So mid-October.
Okay.
It's mid-November. And it's going on the market in about a week and a half. So right around 2 months and a much bigger house with a really big renovation.
Wesley Pipe says, hey, I don't even want to date people. I want to do one night stands. Anybody got any one night stands out here? Yeah, that's a double close, bro. You go do some double close. That's a one night stand. Do some transactional lending. What I would suggest on the buffer side of
That's
things.
like a threesome though, isn't it? Because there's more than two parties.
Yeah, there's a threesome. That's a one night stand threesome, bro. That's great.
I think I need to leave the room.
Okay, so on the buffer, here's what I would suggest, Kate. I would suggest for future presentations to say, by the way, these numbers include a 10% buffer on time allocation and a buffer on renovation. We know all budgets go over. Just we might change our mind. We might go blah, 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 blah. Why is that a big concern of mine? Because as I lend money to people, April Elias, by the way, is one of the best I've ever ran into that I've loaned money to. And she was like on target, on budget. I think you were even under budget.
I was like right there.
Okay, which is rare, right? It's very, very rare. So what I worry about as a lender is people go, hey, we went over budget and I need more money from you. And if I'm the only lender in that deal, and let's say I literally allocated every dollar I had, right? I emptied my retirement account into your deal and you come back and you go, hey, I need an extra 20 grand to finish this. I got some payments to the hard money. You're doing all cash, by the way.
Yes.
Which is crazy to me.
Yeah.
So why not?
But let me say from a lender or investor's perspective, I can like that if I get the opportunity to have more money invested.
Yeah. And it's easier.
Yeah. Now I know for you from see this deal, maybe you could do some creative finance strategy and there's less cash you need. You might just need cash for the renovation maybe.
Yeah. What I would do is like, okay, so for example,
let me say for an investor, if
you're in first position,
I'm in first position and I can blend 500K instead of 100K.
But here's my counter argument to that. If you go to like myinvestorloan.com or you borrow money from me on a hard money loan.
I actually did.
Okay.
Yeah.
And they turn you down or what?
No. For our one in Sarasota, I'm sorry.
Okay, cool. So if you go to like My Investor Loan, I'm a partner in that business. If you go there, you can get like 9 to 11% hard money. Okay, cool. If you're paying those knuckleheads 9 to 11%,
they were great knuckleheads too, by the way.
They are great knuckleheads. If you give those knuckleheads 9 to 11%, then you can afford to pay the person that put a smaller chunk in, so their actual ROI is higher percentage-wise. Now, he might get a larger check.
Yeah.
But he also could deploy into 2 or 3 deals simultaneously if you're borrowing hard money.
Yeah.
And I imagine that's part of your plan as well.
And I'm totally open to doing that. But from my understanding, you can only do a limited amount. So maybe if I have 2 hard money loans going on already, maybe I can't get the third. I haven't.
If I'm your partner, I will sponsor all of your hard money loans, meaning my credibility with My Investor Loan will allow me to have 30 hard money loans simultaneously. So if you and I partner together, but I would ask you for more percentage, I'd be like, yo, give me a little bit more.
Right, because we're getting less on the bigger chunk, the purchase price.
Yeah.
Yeah, and I think for anyone that may want to be a private money lender here, and you're kind of pitching the lender structure here, right? We had Matt earlier pitching the cash partner structure. You're in this lender model, but you proposed an equity option too, a little cash. I want to talk through that a little bit because I want to be sure people understand that strategy, because I like that you gave this optionality. In this lender model here, well, let me go to the optionality there because it'll help tie it together. Because go back, you had the 2 options.
I like this because Matt sees a lot of personality types at directed IRA. Some people really like that monthly feeling of like a little dopamine hit. Or they're making, like literally one of my private money lenders was paying her grocery bill with her money that she was receiving from me monthly.
Oh, wow.
It's a personality thing. It's different, right?
Yeah. And I think that people, especially when they start thinking of their retirement plan dollars, and this could be any other money, but I just get that context because every like 5 minutes someone's investing in an alternative asset, mostly real estate deals at directed IRA, is they've worked hard for that money. They don't want to risk it. And they want to put it into deals they believe in. And people really believe in real estate, right? It's made more millionaires than anything else. And people have a good understanding of it. It's a hard, real asset. There's also an operator, and now there's a contractor in the mix. And so let's kind of go between the 2 different options there you have. What would happen in option 1 and how you want to structure this? Let's say that there are cost overruns. And who puts in more money? Let's say you need another 100 grand to finish the property. Whose job is that?
Another 100 grand. I think at the houses I'm doing, that's incredibly unrealistic to need another 100 grand.
Let's say you need more money.
Let's say 30 grand.
You need $1,000 more. Whose job is it to get the $1,000 extra dollars?
So If it was just $1,000, I would handle that. A benefit here is that, so I was a realtor in California. But
Let me say this. Let me maybe not. I'm trying to get the understanding of you run out of money.
Yeah.
We have an agreement. We're partners in the deal.
Yeah.
Whose job is it to bring in more money?
So up to a certain amount, I would take that off of my my realtor, because I'll be listing these as well in Florida.
Is my next question.
So
is
I
where do
could
you
cut my
make it?
commission.
Okay. Okay.
Okay, but well, let's say that you run out of that.
Yeah.
There's a foundation issue. I've had these happen before in a house where you go, holy crap, we have a $30,000 repair.
Yeah.
Are you going back to Matt for more money?
This morning, okay, Aaron, Aaron, my COO, he's coming over here this morning. He's like, he's doing a rehab project right now in Phoenix. He said, I had copper stole out of this morning. My GC found the pool guy stealing the copper. He didn't show up today. What if that happens? This stuff happens. You know what I mean?
Yeah.
So so you're going to take it out of your realtor commission. Then what though?
Then what do you recommend as a teaching moment here?
Honestly, the answer should be that you tell the money partner, say your job is to cover the money that we need for this project. That's why you're 50-50.
Okay.
If you want 50-50, you need to be bringing the money. That's what I would say.
Yeah, that's what I'm saying.
Like, if
But so this is probably the most contested issue in 50-50 or just work partner, cash partner structures.
Yeah.
I'm a cash partner. You told me my job was you needed 100 grand.
Yeah.
500 grand, whatever.
Yeah.
I gave you the 500 grand.
Yeah.
Yeah. I did my
You
job.
need more money? That's not my problem.
Mhm.
You know?
Yeah.
Like if you need to work more, you're going to work more too.
Mhm.
And so everybody's got a different perspective.
Yeah.
You're the work partner. You're like, I'm busting my ass on this. I'm actually working more. The project's taking longer.
Yeah.
But you also found the deal and brought the deal.
Exactly. And at this split, the 50-50 split, I feel like you're right, Pace, that the money person should come to the table with the money, because from what I understand, if you have three partners, the one who brought the deal, the one who is managing the deal, the one who's funding the deal, they're each 33% partners.
Yeah. And
right?
so as long as the deals are good,
Yeah.
especially if you have track record, that's a lot easier to be like, because what your answer there is you get the upside, but you also have the downside risk. But you get the upside risk that we knock this out of the park, or that we come under budget,
Right.
or that I sell it for a higher than what I've modeled this out. But you also have to roll with me on the downside risk, but I'm losing too. You know, what I could have made on this property, and I'm putting in time still.
Yeah.
Like, so you're losing too. So I think that's the right answer.
A good idea too with Matt, along the lines of Matt, is that let's say you go 50, if everything's on par with what my estimation is, renovation, timeline, et cetera, we're 50-50 on the profit. If we go over budget, we go over timeline, we go for whatever, that's my fault because I'm the operator.
Right.
And what I'll do is I will guarantee a certain profit for you, and whatever has to come out of my side to cover those losses or contract or whatever. So then that way I have at least a guaranteed threshold of like whatever. Now, if we do better, we both win.
Right.
If you do worse, it goes on your shoulders, which is what he's both basically saying.
I've thought of that too. And I'm happy to do that because I'm banking on myself. So I'm confident myself that that's not going to happen. So.
Okay, this is easy. This is honestly, raising money for this kind of stuff is so easy. I'll tell here, like somebody like me, this is what I would do for you. Okay, I would qualify for every hard money loan you need. I would also cover all the money. Even if you go over, I would still cover the money.
Okay.
I also have a great team that could advise and do whatever, and they can double check all of the underwriting. And I would literally just fund all of your deals. You'd never have to raise money ever again.
Let's do it.
Okay.
I'm happy.
But the downside to that is I don't love Florida.
Oh, why?
Permits.
Okay.
The number one most challenging state in the country to get permits is not Florida. It's California. Okay. You've got California, some other places that are hard, but Florida is really challenging. So there's people in Owners Club that live in Florida that their entire business model is getting permits for people in Florida because it's so problematic.
So,
do you know if your county is like that?
If what county?
If your county is like that, do you know?
Brevard County is not.
Okay.
And that's where I want to do mainly my little fix and flips. That's where I have the Airbnb, and I had to get a permit for that. Super easy. I've talked to the county about what it would take if, because there's a house I'm looking at where you have to move a wall. And so I called the county on that. They're like, no, it's easy. We just, come out and look at it and do it. It's a smaller town. It's not Miami. It's big enough. The county has 500,000 people, so it's big enough to do fix and flips in.
Okay.
I think it's a growing area because that's where SpaceX is and a lot of defense and aerospace companies there. So I think it's great money.
Here's what I also like about fix and flips is I'm in the business right now buying a lot of RV parks and mobile home parks.
Mhm.
Okay. Affordability is what I'm after.
Mhm.
In the time frame, I don't like having my money sit at, I can go put my money somewhere and make 10% or 12% pretty easily. I am not really interested in that kind of money at my level of the game. Okay. I want to be making 18 or 20% or 30%.
Mhm.
And I want to be participating and understanding how, like, Ingrid and I did a deal a couple of years ago in Tempe. Okay. Ingrid brings the deal to the table. And what I bring as a partner is if something goes bad, I can refinance everybody out of the deal.
Mhm.
We had a contractor that was licensed contractor that completely, one of the biggest things he screwed up, and this happens. Okay. And I called it out as a contractor. I was like, this is happening. We need to get this guy off this job site and we need to pull somebody else in here. He did not pull the insulation out of the home before we started buttoning up the house. Why is that a big deal? Well, the house was a smoker home and everything was saturated for 30 years, like the ductwork, the insulation in the attic. So this guy's buttoning up all brand new drywall, but he did the drywall over top of old 30-year-old insulation that smells like cigarettes.
Yep.
So you walk in, you turn on the air conditioning sucking the air out of the attic and pumping into the house. It smells like I was in Grandma Vern's Cadillac. You know what I'm saying?
Yeah.
So
I do.
what I did with Ingrid is I go, hey, Ingrid, let me refinance you out. You got paid to get out of the deal. I held the deal. I now still hold the deal. It's an Airbnb and we make money off of it.
Yeah.
But that also is something that when I come in as a partner, I feel like I'm pitching you right now. But as I come as a partner, that's one of the things that's cool about having me as a partner is that we run into trouble. I can refinance, put it on the as like a long-term hold until the market comes back around.
Yeah. And that's amazing. And I know about those houses and that's why I really am excited to be like involved hands-on in the project. The first project I ever did was in 2003, and it was actually a seller finance deal. And with my ex-partner and I, we did a fix and flip on it. And I was very hands-on. I was doing the demo. I was building the deck. I was making the plans, talking to the county. And I haven't been involved in a project that much since then, but I've wanted to for 20 years now. So I'm finally, it's time for me to go back to that.
Yeah. So for me, having my money sit in my retirement account, not making me money, waiting for my big RV park or my big mobile home park. I don't want that. I'd rather be deploying it into short-term deals like this. So the upside for you too, or for the lenders that jump into a deal is like, hey, you get your money back in 6 months. If you have a deal coming up, you can pull your money out or you can just redeploy with me. You have options. Going back to the dating. Anything else?
I like offering number two. I like that you kind of came with two options. Sometimes it creates confusion when you have too many offerings, but they're a little distinct enough. And so I think it works what you're trying to do. But explain to me offering number two though, where it's a private money lending and equity partnership combo, 100% of project costs for 10%. So explain what is that?
So the 10% annual percentage rate. So if you
What's 100% of project costs? That's not the 500K.
That's purchase price, renovation, closing costs, payments along the way, HOA, all the things. Like literally any dollar that needs to be spent, you're in charge of.
Which is the 500K.
Yeah.
Right.
Okay. Sometimes I would just like say that. I mean, I don't know, but okay. So 100%.
Say that.
Yeah, like 500K. Okay. So you're going to pay a 10% annual rate of return.
Yes.
Okay.
Which means I would get a payment for roughly $4,500 monthly along the way.
But you say it's no points, interest only payments.
Correct.
Okay. So okay. And then do a punt up. But I also get 30% of the profit.
Yes.
Does my profit, is that after so I get my interest separate, that 10%.
Yeah.
Then you calculate what's profit because that's an expense.
Yes.
Is the interest you paid me an expense?
Yes.
Okay. Then I get 30% of the profit.
Correct.
Love that.
You'd have a lot of people who take that.
Love that.
I wouldn't take that.
You like the other option better?
Well, because here's the reality. Who's making the monthly payment?
Yeah. Well,
Me. I'm basically making my own payment to myself, right? Because I'm the lender. I'm in charge of that. And so, which is smart. It's a smart thing to do.
But I'm the one getting guaranteed the first 10%. That's another way to say it.
Correct, yeah.
You're preferring, my return is getting preferred for the first 10%.
But it's 10%
And it's only costing
annual
me-
percentage.
not of
Right.
the, not 10% of the
Not
net.
10%.
This could be 5% on an annualized basis if
Yeah.
this is a 6-month deal.
Yeah, so I think it could be better
fair,
or
too.
worse, depending on the profits of the project.
Yeah. It all depends see, because here's the thing. If this is kind of a single type deal, I probably win. If you hit a double or a triple or a home run, I'd rather be up and offering 1, right?
Yep.
But I want to be an offering 1 if you hit a single. I want to be back down and offering 2. So there's a risk and reward on that, which is, I like how you've done that. I just kind of like, there's some risk reward to that.
Smart. I would not call them offering 1 and offering 2 from a marketing perspective. I would come up with a cool name for them.
Okay.
Like, hey, here's the partnership thing, and here's the lender thing. I don't know what you would call it, but come up with a unique name for those.
Okay.
Sometimes when I've talked to people, they're like, I kind of do deals this way or I do them this way.
Mhm.
When they're kind of proposing 2 different ways.
Mhm.
So it seems like it's like they're not confused and desperate. Not that I'm saying that's how you put. Sometimes when people are like, we can do it this way, we can do it this way, we can do it this way. It's like, hey. But if you come like, here's the way I typically do deals. I either do it like this or I do it like this.
Yeah.
Is a good way to talk to an investor.
Yeah.
You did great.
Yeah, these are simple.
Yeah.
I like simple, like to get it done, make some money and move on.
The other thing is just sometimes you talk about how if you might have multiple people invested on the same deal.
Well, I put
'Cause
in a maximum of 2 investors because it can
Max
get
of 2.
complicated and I don't
Okay.
want to herd cats.
Yeah.
I just want to be able to turn and burn.
2. Okay.
Are we done?
Yeah,
Is that a close?
send your next deal to my team.
Okay.
Let me qualify for your hard money loan. Let me
Okay.
fund your deal.
Okay.
We'll also offer insights and all that kind of stuff in design.
Okay.
I have a traveling asset manager, Heidi Silva, that calls and says, hey, I saw this. Here's a better way to get the pricing.
Yeah.
Not that we're going to do the job for you, but we
Yeah.
can help out 3% of the
Right.
way.
Okay.
And when things go wrong, we expect them and we don't yell, bark, etc. And we understand how the game works. So I'm a good partner to have on these kind of deals.
Okay.
How can other people reach out to you? Put your slide up there so people can maybe
Actually,
try and compete with me on doing deals
I
with you.
should have done better on this slide. It was kind of an afterthought, but
It's there. They can
There you
see.
go.
yeah, but I also want to, can I give a shout out to my wholesale hotties? I can be found at It's Kate Gomes on YouTube and Instagram. And every Thursday at 7 p.m. we stream live and talk about all things real estate. So
I love that.
okay.
You can date the wholesale hotties is what you're saying?
Some of that maybe.
Love it. Good guys. Give it up for Kate.
Me too.
What would you say is the appetite, Matt, for like a typical person that you interface with that is a more passive investor? Are they more like, I'm mobile home park, long-term invest. I don't want to deal with it. I know that I'm going to win long-term. Or do you think they're like short and sweet, in and out type of people? Or is it a blend?
It's a blend of both. What I would say is interesting on some of these deals is they're a little high for one person. Because the typical account for, like, again, the self-directed IRA person, even I'd just say kind of your everyday mass affluent person that's got some money to invest in like some alternative deal. You can call real estate alternative. They got about 100K. Like our average account, 125K. So when you come with 500K,
you're going to need 4 or 5 people.
it's like, yeah, on the average, I mean, there's people that have that, but even those that might have 500K might not be like, do I want to throw all 500K into one deal? Or 250s in this deal already right now, but I got 250 here. So that's why I think raising in, when you see like a lot of private funds out there, they raise in 50K, 100K chunks a lot.
Yeah.
And then they'll get, and you might see this in some of your funds or some of your bigger deals, is then you get one person that does 500 and then the next 2 to 100. And I don't know.
It's always a blended bag. You got people who write a check for $1 million that will never talk to you. And then you got people who write a check for 50,000 that stop by the office 3 times a week. So it's a very different blend. Are you guys enjoying this? By the way, everybody in Zoom land, are you guys enjoying this? Give us a yes if you are. We got 750 people with us today. Woo! I mean, having Matt ask these questions is preparing you for understanding what all these investors and lenders are going to ask you. It's freaking great.
I love it. Those two are excellent, by the way.
Good job.
Kate you need a call sign, you know. By the way, is Rhythm on? Okay, there's a legit fighter pilot that was at the Alt Asset Summit, by the way. His call sign is Rhythm. He's a real fighter pilot.
That's a dope name.
What's that? Rhythm's gonna get you? I don't know, but I thought that was kind of a cool one. He's got Rhythm. I don't know.
All right, Sam, who do we got next?
We have James Pakora.
James Pakora. I had dinner with James Pakora last night. James Pakora, come on down, brother. James Pakora, what did you order last night? I imagine it was a nice steak.
I had a petite filet and it was quite yummy.
Okay,
So,
amazing.
had the Bruno option.
And y'all, the Bruno option, what the hell is that?
I know. It was the scallops on top.
Oh, scallops on top.
Yeah, with the,
I was going to say, I mean, so I ordered the Tomahawk 32 ounce, knowing I could eat 10% of it, but I'll eat it throughout the weekend. So
yeah,
you
your
screwed
doggy
up,
bag
bro.
was quite large.
Did you eat the whole thing?
I ate the whole thing, but your doggy bag was quite large.
Yeah, it was huge.
Yeah.
All right, what do we have today?
Well, okay. So hi, everybody. I'm James Pakora. I noticed everybody else was giving kind of more of a history than I had planned, so I'll give a little bit more. I'm a musician by trade. I was a musician for 20 years of my life. You know, when I got married, had to become responsible. So I've been a programmer for the last 28 years. And in the last 4 years, I've been getting into real estate investing, right? So I'm a Subto Gator Owners Club, right? So I've got single family and multifamily in my portfolio. And I do private money lending on fix and flips or commercial EMD. So that's kind of who I am. We got a land project here.
I like that you are already a lender and you invest in other people's deals, because then you know exactly, you know, what it feels like for the people that are going to be investing in your deals. So thanks for saying that.
Yeah, you're welcome. So there's a lot of words on here. I'm not going to bore you with that. You can read it as you want. So I'm just going to give you a synopsis of the deal. So I'm here today to present an opportunity with Apex on a land development deal that's got a really interesting twist to it. So Apex is partnered with Deserts to Forests Foundation, and they're marrying land development with regreening of deserts. So if you haven't done any research or heard about regreening of deserts, it's the use of natural water, indigenous plants, and wildlife management to regreen otherwise arid areas.
Okay, how do they make money?
Well, that's interesting that you asked that. So they've been having a problem making money until they connected with me. And I'm like, well, let's do a land development. Why don't you develop the land, partner with the greening aspect of it, and we'll sell it. That's how they're going to make money.
Okay, so they're going to buy the land, develop it in terms of housing. They're going to put housing on here? Okay, got it. And they'll green it up, add housing, sell it off. Are they going to sell off individual lots before they're built, or are they actually going to do the build? Or are they going to sell the land to a developer and let the developer go do the actual development?
They're going to develop the land. Apex is going to develop the land.
Okay, meaning they're going to build the homes, not just add sewer and power.
Correct. And
Got it. Okay.
Not quite what you're describing. So let me get through the presentation, and that might
I'll
answer
shut my
some of your
mouth.
questions. That's all right. So I wanted to introduce you to some of the people on the team. Okay, so Dan Mueller's got 18 years experience in skincare. He runs a $5 million skincare company, and he's the director of the Deserts to Forest project. And he's got a partner, Wayne Weber, who is a gynecologist out in Los Angeles, has a big practice. He's a director of surgeon. Excuse me. He's the chief surgeon at the Los Angeles hospital. He's got a background in farming and road building, mining. Okay. And I've got my partner on the deal, which is Scotty. He is a foreclosure specialist and a docs specialist. So let's talk a little bit about the deal itself. Okay. The deal itself is a 310-acre lot of land in the Yucca, Arizona neighborhood, which is about 25, 38 miles south of Kingman, 28 miles north of Lake Havasu, right off I-40. There's a lot of construction happening in the area. There's two big projects that we know of, an RV park to the south and an RV park with tracks and stuff to the north. So if any of you guys have ever been out to like any of the desert area, you'll see a lot of RVs parked around. They might be communities, they might be actual parks, but there's people out there in razors and their 4x4s and doing all kinds of activities. And I only bring that up because you may not be a desert dweller, but there are a lot of desert dwellers out there. and this happens to be a desert.
Yeah, Lake Havasu is an interesting city. It's amazing. Every time I go out there, I'm like, wow, I can't believe there's this many people out here.
It's huge. Yeah.
Yeah.
So needs to be mentioned is the land is already purchased. It's 100% acquired. We've already done the hydrology report. You can see here on the display, they've got the water mapped. The red dot there is the proposed well site. They've got the hydrology report says there's enough water to do the project. We're going to subdivide 26 10-acre lots with other green areas. And what you're seeing here is a representation of what we're shooting for. This is indigenous vegetation in Arizona. So we propose obviously preparing the land, running the water, doing landscaping, and the regreening aspect. And our comps down here show anywhere from 290 to 465 currently. And what's important about that is on these comps, those are 2 acres to 5 acre lots, and they're not greened. So there's a difference. So we think our price point at about 350 is very reasonable to reach our numbers, which I'll show here in another slide. And I'm noticing a look of confusion on your face.
No, I'm super interested.
Okay.
Yeah.
All right. So where we're at right now, obviously we've located and acquired the land. It's already purchased. We've already done the survey, so we know we can get water, and we've already done a road excavation estimate. We've already secured the funds in order to maintain or grade that road up to the well and drill the well. And right here's where I need to make the prerequisite statement. We will not be seeking any funding until the road to the well is complete and the well is producing water. So most of the what ifs that you were talking about that I should have a slide on here for find themselves at this particular juncture, right? What if there's no land? What if you can't get the road built? What if you can't get the water built? So we've covered most of those to this point. And obviously from that point, we'll raise funds to build and sell. Our numbers come out actually looking really well. So we're seeking 1 million as a max and 200,000 as a min raise. That will go, the use of funds will go for building the property, doing the land modifications, running the water. And so that's for 5 lots. And we plan on selling them for around 350.
Okay, so you'll raise for 5 lots, sell them, and then turn around, redeploy that capital in the next 5 lots.
Correct.
Okay, got it.
Yep. And we might do another tier 2 offering or tier 3. Puts us at, that's 15 lots for the 26. And after that, we shouldn't need any more. It should kind of cascade and roll that on itself. But at a 3-year term, we're offering a 6% pref rate. We calculate a 30% IRR and a 1.4 multiplier.
I mean, an IRR of 30% means I'm gonna get close to doubling my money if I give you $1 million in 3 years.
Yeah, 1.4 is the return that we're seeing down here.
Okay, so I'll get a check at the end of 3 years for $1,440,000 if everything is done correct, the way you estimate it.
If everything works out correctly.
Okay, got it.
Yeah. The what if then would become, and I'm glad you brought that up because obviously the what if is if the land doesn't sell, right? And every development has this problem. What if the houses don't sell? Okay, so that's pretty much why we're not seeking 5 million up front to do 26 houses. We're going to do 5 up front for a lower rate to come in. And if it doesn't sell, then it doesn't sell.
Okay, got it.
You stop there,
I did stop there.
but you'd stop there. I mean, in terms of like 5 don't sell, you're like,
Well, okay,
you go raise more capital.
it's a good question. I don't have a plan for that.
So what else you got? I just want to cut you off.
No, that's it.
That was okay.
That's
Good.
it.
Okay, let us know. Okay, so like, okay, so go back to the beginning about the water and the reclamation. I got lost on all of that.
No, that's
Why does
all right.
that? Why does that matter?
Why does it matter?
Yeah.
Okay,
What's
so
the benefit to that?
the benefit,
Because I got to the end, I was like, where are you making money? What are you doing? I thought it was gonna be like a water project or something, but
Well, the water in Arizona, you're required to have a 100-year water supply to build anything in Arizona. So you guys are, what you're basically saying is, hey, we have the water. We bought the dirt, but that doesn't mean we can build on it.
right.
So we went a step further. We got the water report and we're tapping a well, and we've gotten approval to build on this land because it has a 100-year water supply proven by a water survey.
Yes.
That's what you're saying. So
That's
the
what we're
water is not necessarily part of the project, except for tying into his question. why do we got to make this shit green? Like, why can't we just leave it desert and sell it? You know what I'm saying? Or is this like a passion these guys have?
It's a passion these guys have.
Okay.
Right? So the land being purchased, is a selling point from my standpoint, right? I don't have to go out and acquire land.
It's a huge deal. I mean, these guys already have skin in the game.
Yeah, they got about 500,000 in the game already, right? So they've purchased the land, they've done the research, they've done the hydrology report, they've got the permits from the BLM guys to regrade the road all the way up to the well. They've already set aside money for the road improvement and the well drilling. So
They're funding themselves.
they are funding themselves up to that point. They don't know what to do from that point.
Why do they not want to are they not interested in participating in this part of it, or what's the?
No, they are participating. They're partners in that.
Okay. All right. So they're staying in, but they're just not putting more money in.
Correct.
They're saying our money stops here.
So it's a proof of concept for them. They want to regreen regreen the desert. They don't know how to do it.
Can we make money? Can we make, okay, I love what you're doing, James, because you're taking these guys, no offense to them, I don't know them, so I'm going to say make some like really bad assumptions. You're taking some guys with some hippie thoughts of like, let's regreen the desert.
Fair enough.
Like, all right, bro, you're going to do this 10 acres at a time?
Okay, so really interesting. You should look it up on YouTube. Like, so there's a bunch of regreening going on.
I've seen
over in Africa.
Yeah.
And it's fascinating.
It's cool. There's people doing it all over the country. It's really cool, but they're not making money on it. They're
Correct.
like, they're like buying 100 acres and they're living there and they're like, I'm going to turn this into, and there's people in Arizona doing it. So I get it, but that's why I immediately stopped you. I was like, how are these guys making money? Correct. That's where you come in,
exactly,
which you already said. And you said, hey, I'm coming in because I'm going to tell these knuckleheads, hey, having a green piece of land is smart, but making money from it can allow you to scale and duplicate that effort. Otherwise, you're just going to have 10 acres that are super green.
Yeah. And as you point out, some people are already doing that, but they're doing it on a very small scale.
And they live there.
If I got 4 acres and I put some trees on it and I try to irrigate it, that's great, but it's not really doing anything.
Right.
If you have 300 acres, that's significant. And I know these guys have their eyeballs on a 600 acre piece that's just up the road, but they want a proof of concept first.
Yeah.
And they were looking for capital.
You'll need a really good story to go raise capital for a 300 acre or 600 acre thing, which is what you guys are doing here.
Correct.
Okay, so these guys have already put skin in the game. They go, hey, all right, we want people to come in and participate on the exit of this 10 acre deal. And what you're saying is this return, if I give you $1 million, my $1 million return comes off of only the 5 homes.
Correct.
So if I really wanted to, I could deploy into the next 5 lots. If everything went well, I could participate in the first 5. I get my $1 million plus $440,000 back if everything goes well.
Yep.
Then I could redeploy that $1 million to do the other 5.
Yes.
Okay, got it.
At which point you're just rolling your profit over.
Yeah. I like this. This is interesting. And I like the return on investment. I mean, $440,000, what is my participation? Same thing, going to Matt's question earlier to Kate. What if you go over budget? What if a contractor screws you? Who's coming up with that money? Who's in charge of that money?
These guys are so determined to do what they want. I would guess they would put in the extra.
Okay, so
our spread on that, right? Okay, so like roughly construction costs are going to be darn near minimum. Okay, we're talking 1,000, 1,500 square foot off-grid home with water, right? Because the water is going to be provided.
Yeah. So
we're looking at construction costs of around 70, right? So the majority of that development cost is going to be land prep, running the water, running the irrigation. There's a large spread in there. Okay, and I think the comps are really good in the area.
So if these guys, let's say, need to get more money from us for whatever reason, they would probably be negotiable, say, hey, you'll get a higher return because we'll take
they would totally be open to
we'll take it out of our share, whatever we've gone over budget. Okay, got it.
Yeah. And as mentioned, the guys coming in, they have very successful businesses already. So,
yeah. I think this is really smart deal, especially for people that are like, I don't want to mess around with, like, no offense to Kate. I participate in all sorts of deals, but I look at Kate, some people go, that's great. I want to be active. Other people look at your deal and go, I'd like to have $440,000 return in 3 years and not have to get a phone call one time for 3 years.
Yeah, very, very passive. They don't have to do too much at all.
Like, send me a monthly email and send me pictures of what you're doing. And also you don't have to, okay, good question here. There's no payments on the land.
Correct.
There's no payments on the water, really.
Really?
So they don't even need all my $1 million right now.
No, like I said, that's why we have a minimum of 200K.
Okay, so I could deploy $200,000 at a time when they need it. It doesn't need to be $1 million check
so
today.
Literally the project could be one lot at a time. If you had people coming in at 200K at a shot, right? So that's why the max was $1 million, because we didn't want to get our we want to get too deep into it.
Yeah.
Right. 5 properties seemed reasonable. 200K would cover the 1 property.
Mhm.
And, you know, so
Like,
there's-
what was your plan to build though? Were you planning to have like 5 go at a time so you can have the different trades coming in and all
That
going
is
out in the middle of
totally- yes, that
nowhere
is totally
to
it,
do
yep.
5 at a time for
Yep.
the economies? Or were you like, no, we're planning to actually just build one and then build one and then
no,
build
again,
one?
that gets to the $1 million ask, right? So the max we wanted was $1 million, and that was to cover the 5. And you, as you mentioned, the trades would cascade on that, right? So you'd be doing the trades here, and they'd be shuffling over to the next lot.
But you
going over.
want to go 5 at a time is what I'm trying to
We wanted
understand.
to do-
Or are you okay going 1 at a time because there's different risk profile for
Yeah.
the investors?
I would be fine doing 1 at a time.
But does that still
But
make
I'll
the
be
same
honest with you,
money?
yeah. So like,
Because your costs of the trades
Right.
going in the middle of nowhere.
Deal. Yeah, that's
so
a
I've
good
never
point.
I've never talked through a deal like this. So
So let's just like get a frame.
you're right. The risk profile.
And you're like,
is
where do we
simple.
get framers to come out here? You're like, we got a guy in, I don't know, like Lake
Yeah,
Havasu.
right. Yeah. Okay.
But he's still going 35 miles out there in the middle of nowhere. And so he's like, but if I can go do 5 of these over
Sure.
the next month, I'm cool. We'll go knock it out. I'll get a crew out there.
No, that's a great what if that I'll have to
If
cover.
I'm popping back and then back and then electrician, what's that?
Ingrid?
Out there.
An RV out there.
For your.
For your crew.
Yeah,
yeah.
Right. Yeah.
While they're there.
No, so ironically, Ingrid, that's a good point. So like there's multitude of ways you could use the land, right? And I was thinking about all your RV parks that you're doing. And as mentioned, there's 2 large RV scenarios already going on in the area. So it's like, well, it could be an RV park, but in order to kind of keep the greening aspect of it, we wanted to go low footprint on the buildings, high remodel of the greening aspect.
So I don't know anything about that. My immediate barbaric brain is like, freaking ditch the plants, get the houses done, sell them shits. But like,
Just do that. Yeah.
is there research done on if we do more greenery, smaller footprint on the building, we'll make the same amount of money or more? Or is it, hey, we're okay not making as much money, we just are obsessed with plants?
They are just obsessed with plants. That's
Okay.
That's their goal.
Okay.
Yep.
Interesting.
So, but they're not money people, and the real estate was the money aspect of it.
Mhm.
What did you do in terms of determining the costs in this? 'Cause
Okay, I've talked with multiple contractors. My partner has got 14 years as a GC experience. I came out a couple of days early. We walked the land Wednesday or Thursday. So with the excavator, got excavation appraisals and estimates. Okay, so
Do you have it bid out all the way then?
not bid out all the way now.
Okay. All right. And what was your partner's name again? I know his name.
Scotty McDowell.
Scotty. What up, Scotty? Okay, so he's going to manage.
Confused with Scott, but Scotty, the good looking one.
Got it. Okay.
And taller.
All right. I would never make that mistake, Scotty. So is that his job though? Like he's going to oversee the construction, or whose job is that?
We will have a construction manager. Apex will have a construction manager.
Okay.
They have not been
And,
selected yet.
and is that a cost in the project, or is that part of their share of the profit? They're contributing those services.
They are
to
contributing that.
They're contributing that.
Yes.
Okay. Is there a GC that they're going to oversee a GC, or that they are the GC?
Apex is providing the GC.
Okay. So the trades are just all getting paid. There's no GC cost then.
Correct.
Okay.
This is an interesting deal to me.
It is kind of interesting, isn't it? I
Yeah,
had
like-
to present it. It was like, oh, it's just a land deal. But, we have an opportunity. So I'm like, this is really interesting. It's got a little bit of a twist to it. So
Well, also like if you're staging it, right? Go back to what Matt's talking about, right? Going for the economies of scales. You're pouring a foundation. These aren't mobile homes, right?
no, they're not mobile homes. It's a foundation.
Okay, so
single story.
You're going to excavate one lot, and then the excavator is going to move to the next, which then means you're going to run plumbing. Then you're going to pour concrete,
Yep.
right? So you'll have staging going on these 5 properties. Could the investor, this is for me, if I'm investing in this deal or lending on this deal, you're really an investor at this point, right? You're a partner on the deal.
Yeah.
So this would be category 2, right? You'd be a partner on
Yeah.
this deal. Okay, I'm partnering on this deal with you. Hey, I'm coming along. I would say, hey, I have $1 million available, but I'm not going to release the money until you guys need it, and you guys need to send a draw request based on completion. So in order to protect yourself really well, guys, as somebody who wants to be a partner, you could say, hey, here's my $1 million. Let's get it all contracted up. You guys can utilize this capital when you get there, but it's not like you're writing a check for $1 million. Would Apex be open to
They would
doing
be
that?
totally open to that
Because now you have
the
really
concept
low
of
risk.
draw is great.
You're the construction loan line of credit,
Yeah.
basically. Release the liens. I'm going to cut the bills. Give me the invoices of the contractors for what
Again,
they
because
did.
they do not need, the investor's money is not needed to purchase the land, right? It's not needed to drill the well. All that funding is already secured
It's just for the build.
just for the build.
Yeah, and you don't need all $1 million right up front.
Correct.
They could do a draw request.
Have there been alternative builds that you've considered? Like Boxable is a quick and fast maker of structures.
Yeah, I'm sure we're open to anything. We were talking, pre.
I feel like the buyer, Ingrid, you might be right about it, but I feel like my gut reaction, limited intelligence on this. Tell me if you think I'm right on this, Ingrid. The buyer is an older person,
Yes.
and they are going to want a concrete foundation, and this is going to be a dude
More
or
likely,
a retired
right?
couple
Yep.
that probably has a boat. They're going to buy the property for $350, and they're going to put their own little like warehouse, or they're going to put their own shed in the back, whatever.
You are totally describing that
The
buyer.
desert dweller.
the desert
Yeah,
dweller.
the desert dweller,
absolutely.
yeah.
They got a sand rail maybe,
Yes.
or an ATV at least.
Yeah, they'll want to build they care more about their RV garage than they care about their actual house. But I do think that demographic cares about a concrete foundation.
Yeah.
So Boxable is just a different type of.
Could you put on concrete?
Yes. Yeah.
Okay.
Yeah. It's a different manufacturing type, but it's very. I'm just trying to understand like what the part that I'm not getting from this is the vision of what that finished product looks like, so that okay, so like the Adobe
Santa Fe
flat
style, yeah.
roof.
Yeah,
okay.
I wish I had a little bit better picture. There's
Okay.
stuff that's actually in the area now.
That's sold.
This particular one here that
Okay.
is our envisionment. Obviously, it was a pre-mobile, or not pre-mobile, pre-built home,
Mhm.
right? Just a single story, 2-bedroom, 1-bath
Mhm.
type thing.
So you're getting the well out there. There's electricity.
Okay,
There's no
so
gas.
there is electricity in nearby neighborhoods. I would leave it up to the property purchaser to establish whether or not they wanted to run electric or not. We're envisioning it being an off-grid, other than the water being
Okay.
supplied. So
So-
off-grid would basically mean
You have
you'd run solar for your electric, but the water would be
Is
provided.
that what those are? Are those all solar?
290, I believe, is. The other two, I think, have power run to them.
Are you going to put the solar on? Is that built into your comp? I mean, you're going to come with a finished product to sell, right? And you'd be like, well, figure out how to get electricity, or you know what I mean? Like
Yes.
your estimate is including solar being put on already?
Correct.
It is.
Yeah.
Okay.
I feel like $70,000 is
cheap.
really cheap for
It
an
is.
1,100 square foot house.
Okay.
I feel like it's going to be closer to like 150 to 200.
Yes.
I would agree with you, but I've talked to a couple different providers of pre-built
Mhm.
homes, and they're like, it totally depends on your
Pre-built.
That's not pre-built
Okay.
on the picture.
where you actually do the walls on site.
Panelized.
Panelized. Thank you.
Okay, got it.
Okay, so you're bringing out panelized home. It's not pre-built. Okay, it's not a mobile home or anything like that. But the
But
guys,
it's not a traditional stick build.
correct.
Okay, got it.
Yeah. So, and they're like, basically your fixtures are where you run into issues. So materials wise, the people I talked to were like, for what you're talking about, materials, 15 grand to 20 grand. And the builders I was talking to were in Nashville.
Okay.
So they're like, our cost over here is going to be higher than what you're going to run into in Arizona. So,
Interesting. Okay.
yeah.
Prefab. Yeah. James Terry says basically it's a prefab home. Yeah.
And
It's like a Lego set.
2 week to a month turnaround time with an experienced crew.
Yeah. It'll go
And then
fast.
finish. So,
Okay. Here's a couple things. I probably would not invest in this deal until I saw a contractor's estimate to say, hey, I'm, and maybe that's Apex going and grabbing 15 contractors, putting them all together, showing that here's the person that's going to manage the project, excavation, underground plumbing. Obviously, they need to run electrical through the house. They need to have wiring,
yes. Yep.
and they need to have a stub out for a panel of some sort, right? So all of those expenses all the way through, I would not do that. I would not write a check until I had that. Right. And I probably, if I'm putting $1 million up, I would want to talk to the contractor or the person that's going to run the project,
Mhm.
because if you're the line of credit, chances are somebody's going to go over budget at some point. I would then want to know, if we go over budget, what is my benefit for bringing additional money to the table? Do I get more return? Does the other group, does it come out of their pocket? I like this deal. I mean, it's basically like a flip.
Yeah.
I just am like, why do we got to have plants? But I get it. These guys are into plants.
Yeah, right. You know a plant guy, right?
I do. Yeah. I do know the plant guy. Yeah. So, I like the deal.
Interesting.
And I like that you also would incrementally invest in the deal. So you could be a line of credit, like what Matt's saying. I don't have to write a check for $1 million. If you guys perform well, you get more money.
Yeah.
If you don't perform well, I have a limited risk. I'm not writing you $1 million check. I'm writing you a $150,000 check in the beginning. Maybe not even that. Maybe it's literally, I could just get a bookkeeper that goes, every time a contractor wants to get paid, the draw comes out of my account.
Yeah, I was just going to say, because your normal draw aspect, right, is you're not putting up the entire cost of the house.
Right. So you're
just draw
really,
what you need.
most risk is like $25,000 increments. That's it.
Yeah. Who would own the property at that point, though? So this is where my questions are. Let's say you're building, the property's deeded where?
To the LLC, to Apex.
Which LLC?
Apex.
And I'm participating in Apex.
You as the investor?
Yeah.
Yes.
So I'm a cash partner.
Correct.
In Apex.
Yeah.
And I got, what was the ownership stake? Do you know what that percent is? It's below 50.
For what? For the investor or?
Yeah,
for
the investor. Yeah. If I was putting in the cash that you needed.
the ownership stake in the LLC?
Yeah. What percent do I own?
I wouldn't even do that. You know what I would do?
Yeah.
I would ask Apex to subordinate and let me be in first lien position on the property.
Oh, I'm going to get that. I want to ask for that too. In addition to, I want to know what percent I own in the LLC.
Okay.
But
No, I have to run that. I don't know.
okay.
Don't have an answer.
Yeah, because those guys own the property, so they would get a loan. What I would do,
But they're going to deed it into this. There's their entity, Apex, that owns all the property.
Yes.
There's like hundreds of acres.
no,
The 310 acres. Yes.
It owns the 310 acres.
there's 310 acres here.
Yes. 26 10-acre lots. It was the plan.
26.
Just no, 5 to start. 26 total.
Yeah,
Is that because the zoning there, you have to do such large parcels?
I just think it's that buyer.
literally they went through.
That buyer wants 10 acres.
You won't
Okay.
get buyers with less than an acre.
Yeah.
That map right there.
Yeah. Here's the well, the proposed well site. Obviously,
Okay.
this would be common area.
So Apex owns that whole tract right now.
Yeah.
Is it already parceled out like that?
It is not parceled out like that.
Okay, you're waiting for the water or something,
We are waiting for the water.
and then
Correct.
it's going to parcel, and you've already.
Correct.
Okay, what's the timeline on that? You think?
For the actual.
So this deal is going to happen.
Okay, so BLM's already granted the road stuff.
Yeah.
We're just waiting for the road to be regraded to the well to be dug. So roughly 3 to 6 months we're looking.
Yeah. Because what I'm trying to get at is like, where's title going to be? And where am I with respect to title? And it's like, and this is just, if you're investing cash, I want to know, how do I protect my cash?
What if I'm your client?
Yeah.
Okay, and you're advising me on this deal,
Yeah.
and I put $1 million up in a line of credit, whatever,
Yes.
and they draw
Yeah.
from it. I go to them. Would you think this is safe? I go to them and I go, I want to be on the operating agreement of the LLC that if this project doesn't go well, I take ownership of the project, and that's how I get my money
Yeah,
back.
that's your normal MO.
I wanted to liquidate.
And I get that. Yeah.
How would you advise me to protect myself as your client?
I would say that there's 2 ways to do it. That's one way.
Okay.
That's probably a little more work though, because that's a lawsuit. We're in court litigating that,
Proving that
whatever
they
the
didn't perform.
terms were of that they did or didn't perform.
Okay.
Right. And that's the other thing that I have with these guys that are also involved here is what is their objective here? I want to come back to that. Like, what's their whole end game on this? I got to make sure whatever I'm trying to do to make money is aligned with what they're doing. Because I can just see some weird conflicts coming up with stuff I don't know about them.
Yeah.
And that's something that's got to be thought about. The easier or natural way is let me be bank on title and have a lien, because I can foreclose on the property and just take ownership into my own LLC or my own company and buy. I don't have to go to court and prove necessarily one thing. I just have to prove you didn't get me paid back of what I put in. So I can get title faster that way, but I can still have an equity participation and get the lien on title.
So you can double dip.
Yeah.
Yeah.
So you would want to make sure that your $1 million money that is deployed has a timeline attached to it that you can then prove that there's a breach, right? Because you can't just go, all right, well, I'll get my money back when you sell the property. It's like, no, there's a timeline I want my money back within 36 months. If you can't get it back within 36 months, here's a 6-month extension, maybe another 6-month extension. At that point, I can foreclose on the property and take the whole thing back.
Yeah. And again, listening to that, I don't have a problem. Again, because the
Do you
big
think
what
they
ifs-
would, the partners?
I don't think they'll have a problem at all. Because again, the big what ifs have already been handled. The road is in to the well. The well is producing water.
Mhm.
We're not even looking for money until that happens.
I mean, and for them, they envision they not being involved in this property. These are all getting sold to 26
But
different people.
I think there'll be covenants in place for the regreening to stay in place.
Dang, these dudes are like into bushes.
Yeah.
What if those bushes burn?
Force de jure, right? Is that what that is? Right?
Force majeure.
Force majeure. Thank
Force
you.
majeure.
Thank you, lawyer.
Yeah. Force de jure is the soup of the day.
And there you go.
I've never heard either one of those words, so I'll have that. Yeah. Soup de jour.
Force majeure is the act of God.
Yeah, force majeure, act of God, which happened a lot in COVID. You know, we were using that with a lot of people. Like, for example, you had an event at a hotel.
Oh yeah. You want your deposit back. Yeah.
You want your money back, and you're like, well, I can't do the event. COVID.
Yeah.
So that was force majeure.
Yeah, one of the companies I was in had that
Yeah.
exact scenario. Birdie.
And this might be a little premature to ask this, but when you have a scenario where so you're saying $1 million once the well is producing water. So who's handling that? What engineering firm or who's doing the well? And when you have 20, the master plan is that 26 properties have 10 acres each. How are they doing the well? And then, that's a lot of water. And so do you have one well site? Are there more than one? And again, this might be premature and I'm sorry, but this is how I'm trying to picture this.
No, it's my understanding that the hydrology report that they did, and of course, there's that map right there, right? That's from the hydrology report.
Right.
Where they've mapped that. And they've already stated that the well will support the development.
And that's the grid of the lots.
That's the proposed grid of the lots.
And so those are 10 acres each.
Correct.
And they all want to be neighbors.
They all,
that. I'm just saying, that's the grid.
That is the grid.
Does it have to be a grid like that?
I guess it doesn't have to be a grid like that. Again, this is just a proposed, what we're thinking.
Yeah.
So the actual road, the BLM road comes in here. Okay. So the road to the well is here. So development would start probably on 6 and 25 or maybe 18 and 26.
Uh-huh.
Okay. And then if you're doing 5, 1, 2, 3, 4, 5, right. And as they go,
right,
the roads will be extended and the actual waterways will be put in.
It's
Sewage.
an association.
What's that?
Is this an association? Because you said common areas.
No, but I'm not sure exactly how they have the common areas set up. All I know is that the owners, the deserts to forest people, want about 20% of the land to be regreened, right? And again, looking at what we have here, okay, that's roughly what that is.
Do you know if the buyers of these properties would be able to get a traditional mortgage type financing?
I wouldn't see why not.
USDA.
Right?
Yeah.
Mhm.
Yeah. Okay.
Are they aware that people have been trimming their bushes since the 80s? Is that good?
Bushes aren't as popular these days. Is that what you're saying?
At least 15 people were offended by that. I'm so sorry, guys. Yeah. So
Jump in a bush.
James Terry has a really great question. Will there be sewage, or are you guys going to include the septic on each?
Yeah.
Or are they going to have to get their own septic?
I believe septic is included.
Okay, I would figure that out because an average septic
Scotty?
is like 8 to 12 grand.
Septic in the
Yeah.
price or no?
We had not discussed that, so.
Careful what you ask for, because when it comes to stories, I have one for everyone. As a matter of fact, I thought Gio Garcia probably would have warned Pace not to ask him any questions.
Oh, okay.
Because when you ask me a question, it's
Mike.
like watching the Lord of the Rings kind of deal.
Just answer the
Okay,
question, Scott.
Exactly.
You got 30 seconds.
Will the buyer have a septic tank when they buy the
Buyer will
property?
their objective is that it's going to be off-grid green living.
Mhm.
Solar would be included, 1,000 square foot, off-site built, assembled on the property with septic, and the water would be communal so that it is not only domestic, but also irrigation.
Okay, got it.
No, Ingrid, the 70K was for the actual structure. not for the land prep and the water run.
Okay.
Budget on that is around 180, 200,000 per.
So they bought
100 of each 200 is for the infrastructure development on the water extending out throughout the project and the road.
So based on this, the 10 lots are going to be sold.
Yeah.
If we're selling them for 350, what was our cost?
Yeah. Okay. So if you take just the one lot, right? If you say 200 is our proposed cost,
Okay.
350 is the proposed sell.
Got it.
150 is your spread, right? That's where the numbers were run from. Okay.
That
Not
makes-
70.
yeah.
You mistook this. Yeah, no, the 70 was just for the structure. Yeah. Correct. Yeah.
Yeah, I believe you can do a 1,200 square foot home,
Yeah.
septic, and some solar for, some under 200 grand.
Yes.
Yeah. Okay, got it.
So
There's a lot of things I really like about this deal. I already said them all, but as in my final closing regards or comments, I will reiterate them. I like that if somebody came to the deal, they have the upside of being involved in the next several projects, the next several phases. Like, dude, this could be somebody's entire life for the next 15 years. They just keep deploying capital and being a partner in this deal. I like that. I like that I don't have to have full exposure right out of the gate. I could go, hey, let's start deploying capital based on draws and completion only. I like that. I love that the guys have capital. They're not knuckleheads that are like, yeah, we want to go do this project, but we don't have any money. These guys put their money where their mouth is. They bought the property. They put 6 months or a year into the project already before we even saw it. I like a lot of things about it. I think it just requires a specific type of investor for sure.
correct. Yeah.
Where are they making money?
Where are they making money?
Yeah.
Again, the primary, Dan, has a
No, on this deal.
on this deal.
On this deal.
On this, okay.
The other
On the
people
other
make-
end. Okay. So
They're
like-
making a portion. They're making a portion. We should take a break after James Pakora for a second. Oh my gosh, certificate of promotion.
No way.
Hey, what? Hey, stand over there.
Hi, Corbin.
What do you got? What are you now? Yeah, you're in yellow. Can you show us a good move? Okay, put the food down. Show us a good move. Show Scott a good move.
Good form.
Yeah. Dude, can I keep this? Can I put this down here in the studio? Okay, love you. Blow me a kiss. Okay, see you later. Love you. Thanks.
So healthy.
Did we order food for everybody?
Yeah.
Have you guys already been eating it?
Yes.
Okay, I think Matt and I will take a break for 10 minutes right after this. We'll come back. But James, I like this deal. It is a different personality for sure than a short-term investor, obviously.
Yep.
But I like it.
Cool.
I would like to understand, because I think they're making their money primarily on the spread between the 200 and the 150. They're participating in the profits of the flip, essentially.
Yeah.
What I don't understand that I think you got to add more detail to is like, how do we know that these trees and greenery is actually going to make us more money? Because business is about making money.
Yeah, right. So your concern is the fact that the people that would buy this really don't give a shit.
Yeah.
Right. And
But there's going to be covenants on the property that they're going to need to.
correct.
Who enforces those covenants though, if they've already sold the property?
Good lawyer question, Matt. Really good.
That's why I think someone was asking
Yeah,
if they're an
right.
HOA,
HOA,
is there an
right?
association?
So-
Glossy person that owns one of the properties.
Yeah,
Definitely the
So-
group.
and that would add
a great
cost
question.
and might be not the desert dweller vibe. They're going out there because they don't want that bullshit.
Right.
But I think this was interesting. I was a little lost at the beginning. I'll be honest. I was like, kind of like,
You were
Where-
probably lost because I was a little bit nervous. And
No.
So
no,
It's a new type of deal.
it's a unique deal.
Yeah.
Probably the good word for
yeah,
it.
that's true. That's absolutely true.
But at the end of the day, it's real estate development, which is very risky. From what we've looked at, this is the highest risk deal by far.
Okay.
In my opinion. And there's just a lot of variables here. And
I think if Matt was my attorney on this, I could turn into the lowest risk.
Okay.
Here's what I would do. I could go in, depending on if you guys raise the capital or not, I could go in and go, hey, Matt, I'm going to do one house at a time. And I want to set the structure up where if they can't perform and sell one, I take the whole property.
I agree with that.
Yeah.
But here's what you will have. A property that they couldn't sell either, probably, because that's my worry about this is assuming you get through the construction risk and you fund it, it gets built. Is there demand there to buy this? Is my question. I don't know where this is in that type of geographic region.
Yeah.
What else is around? I know you've got some stuff. There's a lot of questions I got about like, okay, now I own, like I've had clients that, they foreclose on stuff from property and are like, can I give this away?
Yeah, I have one right now in New Mexico, so I know the feeling.
And that's where, if it's in Central Florida, I'm like, okay, I'm okay. That's
And
someone's going to live in that.
literally the reason I brought up the Mojave Desert aspect of it was I'm not a desert dweller. I mean, I love Las Vegas, but I wouldn't live out in the desert.
Yeah.
However, I was driving to San Diego the other day and I passed 3 or 4 RV encampments. I don't know if they were RV parks or not, but there was 100, 200 RVs out there and everybody's jetting around having fun in the Mojave. And I'm like, it's not your cup of tea, but it's somebody's cup of tea.
Yeah. So here's what I would do. And this is just a diligence tip on any type of deal like this is, if you were investing in this deal, I'd want to this is enough money. You want to probably go to the property, but bring your friend that is the desert dweller or the type of person, whether you take video or whatever, or you show them on the map or you get their butt out there to be like, is this a place you'd want to be? Yeah. Like, cause you're going to establish a market for this out there. Yeah. Now, if you're like, if you could come to me and say,
smart.
Yeah. If you could come to me and say, hey, there's another one over here, 40 acres down the road, and it did well, then I could get a little more comfortable.
Sure.
And this is the concept they did. We're basically doing that with this green twist on it.
The irony is the green twist and the fact that they've already purchased the property and we are not even going to try to acquire funds until the well is producing water. Those things made me comfortable enough to stand here and present this. If it was just a straight land deal, it wouldn't even
different
bother
story.
me. Yeah,
Matt
totally.
made a really good point. So think about this. If you go out there and you look at these comps, you go talk to the real estate agent who's been out there for 20 years, 30 years.
That's a good one.
That represents all of these buyers. These buyers are hitting him up saying, hey, when you see a 10-acre thing pop up, hit me up. I want to be there, right? Yeah. And you go to that agent and you go and you put him in the presentation deck and you go, this agent's been out in Lake Havasu area for 35 years. He sold 300 homes. He knows the marketplace and he has a buyer's list that's waiting for these types of deals. In fact, we've taken a survey of 15 potential buyers. They want these types of homes and they're willing to pay that kind of number. Oh my gosh. Now you're going to somebody like me and Matt who, he's in Paradise Valley. I don't know if you know anything about that.
Yes, we are already working with an agent that is the head of the Friends of Yucca Valley out there. So she's already an agent doing that. And that's where we got the information on the RV park coming in to get a lay of what's going on in the area. So yeah, totally get that.
Go one further pace.
Yeah.
Take deposits for people. Just do a new pre-sale, like a new build.
That's
Hey,
then
you know what?
Ingrid, that's a great idea.
She's a great agent. You want to go to Lake Havasu?
Hell to the no.
That's a great tip though. And I think, see, those are great tips to de-risk this, which also helps you get an investor more comfortable, which is that agent that would be out there that's going to know that's going to be practical if you go and actually do this, that's going to help you sell it. And I want to work with you and entice them to have interest in this, but also they're not going to want to waste their time if it's not going to sell either, presumably if you get the right person. And then I love the pre-sell idea too, because that's what developers do.
Yeah, no, that's a great idea.
They pre-sell. If they don't get the stuff pre-sold, that's an indication they shouldn't do it.
Yeah, I like that. James, in closing, put your information up there. I want to just say something. The riches are in the niches, my friend, and there's no competition on this for you. And there is demand in Lake Havasu. Right? Like there's a guy I did the BLO strategy for, I bought and I'm lease optioning his property back to him. This guy is like, I will never move from Lake Havasu. I've got my boat. I got my life out here. This place is the greatest place for like retirees and like whatever. It is a whole mecca out there it's not me, it's not Matt, whatever, but it is them. I think you crack this nut, this is like a whole entire business that you could do for the rest of your life and make a ton of freaking money off of. You especially get this first deal done, you got a story to tell.
Yeah.
But, bro, good job. And one of the biggest demands that we see nationwide right now are 10-acre parcels. Everybody's like, I want to get away from the city. I'm sick of all these people. They want compounds. And this fits that need.
Yeah. Cool. Well, thanks, man.
Really good stuff.
Last thing I would say, just because I got lost on the green thing at the beginning, which I think that actually can be kind of a superpower, because this is this land that you have with no capital to acquire. You're only needing capital to go build, right?
Yep.
So I think one way you can spin that to work with what you have is there are people who are interested in this green concept that already own the land. That de-risks this because we have no risk on the land. It's already there. We just need to build on it. And so I don't have the full capital cost of acquiring land and building. We only have capital cost of the build. And I think that's a big advantage that typically you won't see in a development deal. They got to go buy the land, you know. And now you're partnering in on this too, but I think that's might be one way to approach it. But
Okay. Well, yeah,
very interesting.
all great questions. Thanks, guys.
Freaking great job, man. Really good. Okay, we're gonna take a 10-minute break. Is that cool for everybody that's hanging out? 700 people hanging out.
Mouth is dry.
We got permission to take a 10-minute break and not have somebody in the side chat goes, "Why can't I hear anything? Where is everybody?" We're gonna take a 10-minute break. Everybody on YouTube, just hang out tight. We'll be right back. I'm gonna make sure Matt gets something to eat. We'll come back. We got 3 more presenters, and we'll probably go another 2 hours, and we'll be done.
Heck yeah.
You think it'll be that? No, I think they'll get shorter and shorter. Because the biggest thing,
The 6 hours, dude.
no,
FaceTime.
no way. I mean, I think in the very front end, you're doing a lot of teaching moments that take some time, but now the presentations go a little bit faster because there's less to talk about because people are, putting it in. So we'll be back in 10 minutes. Eric, mute us, and we'll be back, guys.
This has been great.
Yeah, this is a lot of fun. People. All right, everybody, we are back. You know, it's always a sad thing when you go on a 10, 15-minute break, you want to get some food, maybe go pee, hang out for a little bit. You lose some audience members. So thank you for everybody that hung out, stayed around with us. We've got about 600 people on the Zoom and a couple hundred people on YouTube. Thank you guys so much for being here. I want to remind you guys, get your tickets to Squad Up Summit. Go to squadupsummit.com before it's too late. Every year we sell out. We sold out last time. Who tried to get in VIP that couldn't get into VIP last year? Rinda, you couldn't get into VIP. And here's the thing. When I say we sell out, I mean it, don't I?
I was very sad.
Okay.
I was jealous.
Yeah. So we sell out. I don't ever like being that person that says, hurry, we've got only a couple of seats left. I want to legitimately tell you if it's sold out, it is sold out. We do not open up more spots. We just are honest. So Murray says, going, I got mine. How many people are going to Squad Up Summit? Say me in the side chat, please, or me here. Yeah, you guys all better be going. I'll be crying. Okay, awesome. Hundreds of people in here, all going to Squad Up Summit. We'll have 3,500 people this year. Last year we had 2,100, so nearly double what we had last year. Pretty cool. All right, let's get back into it. We got 3 more teaching moments. Who do we have next?
All right, next we have Patrick Bison and Pat O'Brien.
Oh, we have Pat and Pat. Okay. I love it. Patrick and Pat O'Brien. All right. Now, Patrick is from Quebec.
Montreal. Yeah.
Montreal, and his first language is French.
Yep.
Canadian French. And Pat O'Brien, you can tell by the last name, this man is from Chicago. And his first language is mobster.
Yeah, for sure.
What's the best steakhouse in Chicago?
Best ribeye is Bavette's.
Bavette's. Are you Chicago
pizza?
Best pizza.
Best pizza is Nick and Vito's on 85th and Pulaski.
Okay.
Razor thin.
Okay.
Squares.
Thin? But that's not Chicago style.
It absolutely is Chicago style.
Okay.
It's not deep dish.
Yeah.
This is actually why I came to present today. So it's not deep dish. It's razor thin squares.
I thought you were going to say it's DiGiorno.
Oh, yeah. So
cool.
Yeah.
All right, gentlemen. Tell us what you have. You guys are killing it. The Bisons bought 4 RV parks in 2024. Congratulations, guys.
Thank you.
Amazing stuff. You guys scaled really well. Proud of you. And proud of you guys building your brand in the RV park world. You're going to do amazing things. And I know that Michelle was just texting me a couple of days ago that you guys are being highlighted in some really like nationwide magazines in the RV park world.
Yes, absolutely.
That's
He's
cool.
doing really well with that. Michelle is our CEO. And so we founded Bison Peak Ventures mid-year because we were growing so fast and we wanted to make sure that we raise money for the right deals. And at that one point we said, okay, well, let's go into a fund. And then that way we could have smaller investors all the way to, larger capital coming in. But that's how it started.
All right, love it. Now, here's what I want to give you guys as a tip, because there's 2 of you guys, and your tendency is going to be to want to talk to me.
Yep. So
as you do your presentation, do not present to me. Present to this camera right here, because that's the 700 people that are on Zoom right now saying, should I give this Canadian my money?
I'm American now.
Okay, all right.
No, I'm still Canadian. I'm kidding. But married to Michelle, and we're having fun. I mean, Bison Peak Ventures is really our group. Pat O'Brien is our CFO. I'm the COO, and Michelle is the CEO. And we have Rinda Emick, who is our director of operations. So, and it's a growing company. So we have a lot more to talk about in regards to that. I just want to talk about the confidential.
we're not your attorney and we're not your CPA. So be sure to get good counsel.
That's important.
Yep.
So if you're making an investment, you make sure you consult your CPA and your counsel, to make sure that you're investing wisely. So, and hopefully you can do it with us. So, all right. So let's talk about Bison Peak Venture. In general here, what we're, as a company, we're vertically integrated. So this means that we take care of everything from top to bottom. Michelle and I started investing in RV parks. We've had properties before that. And went into the RV world in 2024. And we are really dedicated at RV park specifically for this fund. And this is what we're doing with it, is we are helping baby boomers to retire. So that's the main thing about the RV business right now, is that they are mom and pops that are retiring or want to retire, and we are providing them the opportunity to do so by acquiring their property and sometimes working in some seller financing, which we've learned with Subto and the Owner's Club with Pace. So thanks for that. So it's been very helpful. We've got a pretty good track record so far. So we merged the team. We have Pat O'Brien has been with us for like 6 months now.
Yep.
So you want to talk a little bit more about what we have.
So collectively as a team, I've done 3 successful $50 million fundraisers, 2 of which we sold to private equity, and the third was to a REIT. So I've done a $50 million retail fund, $50 million multifamily fund, and then $50 million in hospitality. We bought a handful of hotels and repositioned into boutique and then ultimately sold. 250 apartment units that I've owned for about a decade. We own collectively about 30 short-term rentals throughout the US, Texas, that we self-manage, own or operate. Patrick had mentioned we've closed on 4 parks. We're closing on our 5th in March.
In Alaska.
So to date, right, we have approximately 30 million in assets under management, and we're over the past 10 years north of 20% cash on cash returns.
Yep. All right. So this is the offering in general. I just wanted to start with that so we could go through and then we could explain a little bit more in detail. But primarily our investment is a 506C, which means accredited investors. The asset class is 100% dedicated to RV campgrounds and RV resorts. The strategy is that we are going to be acquiring another 5 this year. Over the next 2 years, potentially 12 total parks in our portfolio. We want to make sure that these are improved, and we have a system for that. We've put that in place, and we also, our hold period is 5 years. So when you invest with us, it's a 5-year investment. And Pat, you will be able to run you through a little
for this particular fund, right now we're looking for a $6 million raise. There's Class A and Class B shares, which vary in the splits, which we can get into. But over the 5-year span, we will be doing quarterly distributions after 6 months. It's the 8% pref first, and then we'll be doing pari-passu waterfalls splits, but 70-30 and 80-20 splits between the LP and the GP. Over that 5-year span, like I said, we're doing quarterly distributions, but after that 5-year timeline, we'll have 100% of that principal returned. And then historically, over the past 12 months, right, we've hit the 20% cash on cash. So while you get your principal back, ultimately, hopefully when we sell to private equity or a REIT, we'll be able to double up, but we'll have those 20% returns throughout those 5 years.
Okay. So as we talked before, pretty solid team. We've got a lot of experience. We know what we're doing, and that's all we're doing right now. It's 100% dedicated to RV. And so we are putting our systems in place, and we know. So as I said, Michelle, being our CEO, and so we're working through some deals with mom and pops. And so Michelle and I, when we connect with sellers, we're actually ask their pain, ask why you're selling. It's like we're actually getting a lot of off-market deals. And by doing off-market deals, it allows us to go into creative financing with them. And we purchased 2 of our properties, 100% seller finance. So we were able to get a really good note on some of these. And one of them is actually a 3-year extension. The other one is a 4-year note and for $4 million. So some of the parks that the value that we're getting, we're buying them, not doing too much detail here, but we're buying them above 10 cap rate. And then, so that's our entry position. So when we sell them and when we will dispose of them, we really have a lot to offer, to gain into that. So the other side of it is that with the seller finance, that allows us the fund and our money that we're raising and to actually deploy it as CapEx, so we can improve the properties. And RV parks in general, when they're managed by mom and pop, they've been the same for quite some time. They don't have the best Wi-Fi or they don't have the best equipment on site. So what we do first and foremost is in putting these systems in place, including Wi-Fi, metering of each of the electric poles. And so we're adding value from day one. And these parks in general are cash flowing from day one. So we're able to offer an 8% pref to our investors, but also some distribution after 6 months. So a little bit about detail about why we invest in RV parks, right? So the primarily reason is that in good times, you have people going on vacation, they're taking their family. It's cheaper to take an RV and go in for like a week. You're probably going to end up spending like $400 or $500 just on your site, right? But if you were to go to an hotel, that's going to cost you $2,000, $3,000 at minimum, right? For a family of 4. You're probably going to need a second bedroom, and now you're scaling on that. So when that's in good times, people go and travel. And less economic downfall, or if there's any issue with the economy in general, which we've seen in the last year or so, people come to our parks and they want to live there. So it's almost like mobile homes, or it's like an apartment. They bring their RV, they connect to our site, and we charge them a basic fee, and then they pay for their electric. So we have, in all of our properties right now, we have dedicated, for affordable housing, we've dedicated 30% of each of our properties just for that reason. And that could fluctuate on a dime. We could turn around and say, okay, we need more properties for, like, more sites for affordable housing. So then we could do that. We could pivot and then go back to transient when the economy is great. The overall, if you look at what the main reasons why people would invest with us, that we invest in RV resort, is that we're able to provide better systems and then upgrades, and then making the property, we're fast appreciating the properties into more profitable. So
if I could just touch on that.
Yeah.
So consolidation as far as an asset class perspective. So there's not a lot of institutional groups yet. There's a couple, not many, but there are a few groups that are just starting to get into this space. So multifamily, retail, office, hospitality, right? That's pretty picked over. With RVs, why they're not really in there yet, it's because it is so labor intensive, right? We were recently in Branson for an expo, and right, the typical RV owner, husband fixes the toilet, wife keeps the books. We don't have a website. We haven't updated the rents. There's so much labor intensive things to do to get into that. So with the consolidation in the submarket, right, a refined group comes in, systematized, building out the infrastructure. You have one website, one platform, you keep one set of books, building out those systems. So you get to a point of 15, 20, 25 parks, and then you could bundle it up and ultimately have a successful exit that is a true turnkey portfolio.
Right. So our investment strategy, as I was saying before, Michelle and I like to connect with the sellers. So we have approximately 20 brokers right now that are sending us deals. And our first thought, and whenever we talk to and we look at deals, we're underwriting about 20 deals a week right now, with, kind of a elimination process. When the deals make sense, then I look at them, then I pass them on to Pat. He is phenomenal underwriter, has got a lot of experience in it, and that's super important, right? We have to know our numbers. So we go from that stage, and once it works out, then we submit LOIs. So we're submitting roughly 6 to 8 LOIs a week. We're in that phase right now because we want to close on 5 parks this year. When we take a property and we looked at everything within that property, what the potential can be, there's a lot of just on the surface, like by fixing a few things, there's a lot that we could see right away and then make it more profitable. The second thing is by connecting with those sellers through the broker, we literally try to move the broker out of the equation. We just can say, listen, you're going to get your money, but we want to talk to the sellers. And if that doesn't work, then we go to the next one. There's 12,500 RV parks and resorts in the US. Plus, I mean, there's been more that have been built recently. So that's really important to know that the pool is there. And then we are very, very selective when it comes to the properties that we're acquiring.
So two things I just add, just to really drive home what Patrick and Michelle and a part of our secret sauce is, which I despise, but they are phenomenal at, is building that relationship with those sellers. I do not have good bedside manner, but that relationship, that constant education, talking, hand holding, all these sorts of things. It's
I even like the way he describes it.
talking. but they respond to that, right? So the deal we're under contract on, it was out in the market, super overpriced. It wasn't able to trade. Then it was back on the market for more realistic numbers. Patrick and Michelle got on a plane, met the seller, developed that relationship, hit it off. We had dinner with them a couple nights ago, and we're going to get it for a 20% discount. So there's the actual purchasing price of building that relationship. There's the opportunity of the education and seller financing component. So we're able to get more competitive debt than institutional debt or banks. And then because we are buying and we've bought so much in such a short amount of time, brokers, sellers, people know that. So now we're getting first look at a lot of deals because we're actively acquiring.
Absolutely. We're getting, like I said before, we're getting a lot of referrals. Emails are coming in. We have a dedicated box inside Bison Peak Ventures, and you can find us at bisonpeakventures.com. So we'll plug there. But at the end of the day, we're delivering high 20s, in the IRR. I know we mentioned that, but there's also the rest of the
high teens, low 20s, cash on cash.
Yeah. So it's extremely profitable. And so our buy box, which we've learned on lesson 1 when you join Subto, so you have to create your buy box. What are you going to do? Well, we are looking at 100 pads or more. So that's, standard for us. 1970s and older. I mean, we were looking for, we don't want the lead pipes, right, in their systems. And so we're looking at that. Market is basically across the US. Ideally, we like to have a property that's going to operate 12 months a year. But there are some, like in Alaska, that's making all their money in 4 months. So during the season, it's all hands on deck. And then during the off season, they renovate or they add, or, so that's what we are seeing so much value add in that park, in particular in Alaska. You could check it out. It's called Eagles Rest in Valdez, Alaska. And the price range for us is we're looking at the properties is 2 million to 10 million. We haven't had a 10 million yet, but that's our range we have to look at. Sometimes we start high and then we negotiate and we can get a lower price. And in terms of properties that we're looking to do is roughly, like I said, 10 or 12 properties within this fund, and then we'll continue growing after that. So just a quick chart here. Pat, you want to take this one just to walk people through how we're actually doing business?
This is the hardest I've ever had to work in putting something together, is this diagram. So this is a big deal for me.
Better than talking, Pat.
Yeah. That's true. So typically how we do things, right? So obviously tremendous amount of underwriting, developing relationships, due diligence, comparables, all the different market analysis. So then we close. We come in and rebrand and reposition, right? If they don't have any type of website, if they need a coat of paint, if we can add pads quickly to just kind of get that value add right away. So then we do that. And then we implement dynamic pricing. We make sure that we are at market rate as far as occupancy and guests. Again, as Patrick had mentioned, we are doing a 5-year hold for this fund. All the while during that time, right, we're doing our quarterly distributions. We're doing our pref, we're doing our Parapassu waterfall. And then hopefully after that 5-year, depending on the market and economic tides, if the market is down, we can do a cash out refi, we could sell, we could do a 1031. And so we have different exit strategies after that 5 years. And then like we had said before, right, you're getting 100% of that principal back. And then we can grow into fund 2, 3, 4, and 5.
Good. So this is an example here that you want to walk us through.
So this is a deal that we're currently under contract on. This is a great example of what is typical of the deals that we're looking at. So it's between 4 and 6 million typically, right? So for this exact example, this is one that we're under contract on. It's going to require 1.5 in equity, and that's down payment, rehab, and then reserves, just to make sure that we have enough budgeted. So
every single property that we buy, we want to make sure we have a capex and a reserve, because you never know what could happen, right? So
whether it is seller financing or if we have institutional debt, right, this is what our lender is going to look at to make sure that we hit our DCRs, that we are allocating for vacancies, understanding seasonality. If it is longer term rents, like when those leases are expiring, so we don't have everybody turning over in the same 3-month window. So that allocation. So this particular deal, if you were to invest 1.5 million, that 8% pref initially is that. So I'll step back. So we have our NOI, then we're paying our seller financing, then we have our cash flow after debt service. So we now have our pref that we can return to our partners. And then we get into, so a question you're often asking, right? When do you get paid? So it's after that pref, right? You are guaranteed your 8% pref, and then we do our GP LP splits.
Yeah. Just to point out, in our investment, if you're investing $50,000 to $250,000, right? So that's a 70-30 split, LP to GP. If you're investing above $250,000, you get 80-20 on the split. So I think that's important, because not everybody can, put in more. So we opened it up from 50,000 to 250,000.
Smart, really smart.
Yeah.
Something else just to note, obviously there's the true dollars and investment and returns, but then there's all the tax benefits that go with the RV asset class. Yeah. So bonus depreciation, everybody knows what that is, but cost segregation is a law that was passed. It's tiered down, but I'm hopeful it'll
come back, baby. We're back.
But
it's back.
But
Cost seg's going to be back.
Right. So, but as far as an asset class goes, if you're to do multifamily or something else, you aren't able to realize the dollar for dollar opportunity that you can in RVs, right? It's water, electric, utilities, concrete. It's
so much more than I originally thought. It's surprising.
Yeah.
I was like, oh, we're not going to be able to get a lot of tax benefits because it's all dirt. I was so wrong.
Yeah, it's very different than
year one,
multifamily,
right? When year one, you're starting, you're getting it right away. So all of our partners, everybody that's investing with us, will get a K1 at the end of the year. So now we're in 2025. You can guarantee that with your tax, you'll get a K1. We're doing it too because all of the properties are in one lump. So therefore, we'll have 10 properties. So you could imagine that the value of all the investments that are in will get a good write-off.
Just as a clarification, we're not your accountant, we're not your CPA, right? And then also we have our mothership LLC, and then every single property has their respective LLCs.
Yep.
So if I have a slip and fall or something on property C, it doesn't affect property A or B.
Yep. So this is, thank you for that. I'm going to show you just briefly here a little addendum. This is an example of one of our
Papa Chubbies?
Papa Chubbies on the Lake of the Ozarks.
They used to call me that, dude.
Pace, you got to invest in it now. So here you go. Man, we'll just replace that logo. So Papa Chubbies, what is it? Well, we talked about RV parks, but it's bigger than that, right? So we have this RV, which you could see in the top portion there. That's a row of 54 pads. Then we have cabins that are available. Then there's a restaurant on site. And then as you can see, the boat slip. There's a line. There's 35,000 boats on that lake that are registered. And there's a line from 11 a.m. to 7 p.m. of boats parked to try to get into Papa Chubbies. So we're going to be working on expanding the dock for sure. But we are max right now with that restaurant. So we're doing an expansion. And we're using, as an example, we're using the liquor license and beer, wine, and spirits for the locals. But we're actually going to do a store that you could bring onto your boat, and so that's part of what we're doing as far as expansion. The way that this is going with our capex for this one, we're spending $300,000 on an acquisition. But this property, we secured it for $7 million, and it's valued at $10 million.
The restaurant does $3 million in annual gross.
Yeah. So we're looking to grow the capacity of the restaurant.
Okay.
The park itself is going to be expanded, and there's not on this picture, but there's 84.5 acres of commercially zoned land that we have acquired in the process. So Papa Chubby's is destined to be another section for RVs to start, but eventually we'll build some homes on it, or we can do whatever. Like, there's a lot of opportunities. We've actually had some builders approach us and, hey, I want to build on this. Let's JV on it. And we're like, okay, let's take our time and see what the best scenario is.
So something else just to note, right? So typically in a fund, it's you're banking on who these people are, their track record, and it's at the end of the day a concept. This is a fund that you have an opportunity to invest in that already has active deals, active real estate that exists in the pipeline that you invest, you're a member in that.
Yep. And then just as the last slide I wanted to show you, but this is Lake Ridge RV Resort in Hillsville, Virginia. So for those of you who don't know where that is, it's just at the end of Virginia. It's actually south of West Virginia. It's a destination park. It's got 2 water slides, perfect for the kids. Place you could bring everybody there.
That's right.
And with your RV. This is 98 acres that we have acquired. The property itself is valued at $5 million, and we secured it for $4 million with 100% seller finance. What we're using the CapEx from the fund for is improvement. So we're going to add cabins to this one because there's a demand for it. We're going to add some RV space. We also have an HOA on site. So we control, and Pat is the president of the HOA.
I am.
But we
Very excited.
We actually have residents that live there.
I'm also a 51% shareholder, so.
Yes. So we have a control over the HOA, but we're providing them services like garbage and maintenance and keeping the property beautiful.
And their dues are going to be raised.
Yep. And it's got the dues will, yes, you have to raise them once in a while.
Recall election.
Yeah, but we're looking at all ways to make the property profitable. But here's an example that we've done with this property here. First of all, we put managers in place. People say, like, how do you guys manage all this? Well, we have people lined up right now to work for us, and we are putting experienced people into each property. Also, when we acquire properties, we give the people that are there, other than the owners, to stay on board. I mean, we're not firing people, hey, we're cleaning house and getting it done. No, we're coming in and we're really focused on interviews, and we walk with them. We walk the park and we say, what exactly do you do here? Just like an office space. But we do.
What exactly do you do here?
Yes. What do you say you do here? So, but at the end of the day, this property in particular, it's got an arcade. It's got a store. We're making pizza we have a restaurant, but it's like minute. So we could all improve that based on our background. So my background, personal background, has been in the hospitality business for over 27 years. Pat's background understands all the numbers, right? Michelle did the same thing. She was one of the first women entrepreneurs. So, and then Rinda has been helping us with all transaction coordination. So you have an experienced team here that is really focused right now, laser focused on RV parks.
Patrick, go back to this screen of your guys' contact information, please, while we do questions.
Right here.
Yeah, there you go. First and foremost, Michelle, are you proud of this man?
Very proud.
You guys did an incredible job, dude.
Yeah, thank you.
And to give you some kudos, bro, you're charismatic.
Oh man, hell. Thank you.
Okay? Like, my CFO is not that funny.
Thank you
for not liking talking and stuff.
Yeah,
you're great.
Great.
Thanks.
I loved you guys' presentation. You had great organization. You clearly know what you're doing. You even got your boss here supervising you, making sure you didn't screw it up. Good under pressure. Yep. Can I just start with some basic questions? Is that okay? So what's the difference between an RV resort and an RV park?
Good question. So an RV resort, it would be a destination where you're going to go and spend time with the family and go on vacation. An RV park in general is more about monthlies and where you actually live on. So that is the difference between
amenities.
Yeah, like I have RV parks.
Yeah.
Some people live there permanently.
Yeah.
There's nothing to do with my RV parks except sleep. And there's like a little park.
No Papa Chubbies?
No Papa Chubbies.
No Papa Chubbies.
There's no Chubbies over there.
So Lake Ridge, that Virginia deal, right? That water component, the water slides, the local community has access to that. So that does $250,000 in day use passes.
$15
that people
a head.
can come in the water park. They can use the arcade. They can have the food and bev.
Okay. Cool. Which is what I thought, and that's cool. That's where your hospitality background. The first thing that's great about you guys are a team, but I really saw like your strengths of what you guys do weaved through what you talked about. Even you saying what you hate doing is great, because when I'm looking at investing in a deal, and I want to invest in your guys' deal. I just want to say that first. I got a lot of questions that I want to go through as an exercise, and I want the answers to, but I think a lot of people minimize the value of having a team. And when they start, because they worry about there not being enough money to be made and sharing. And I think that's the wrong thing, because it might seem like that at the beginning, but you can go a lot farther if you have the right team. And it seems like you guys have a lot of things of complementary strengths of lanes you stand. I don't want to be investing in a thing that's got a bunch of centers in it, and like a basketball team, they all can do the same thing well. You want the people that have some complementary skills. But also, as you guys, if you're investing in something that's going to scale, which is your guys' vision, right? You want to scale this thing, build a larger portfolio to sell it. That can bring a tremendous amount of upside value. Like I can get my head around that. That's more valuable as you get it bigger. But that takes a team, So maybe explain, I was just curious about this. Is this all your guys' day job, or is this so you have day roles and other projects? Is this full-time? Where's everyone's role outside of this?
So I'll speak for myself and Michelle. I retired end of September of 23, joined Subto first week of October 2023. Bought our first RV park.
Retirement didn't suit you.
So I retired, joined Subto, learned everything, learned creative finance, bought our first RV park December 28th, 2023, 51 days after I joined.
Congratulations, brother.
Yeah,
that's badass.
So Michelle and I,
separate park, is that one in this portfolio?
that is actually one that we're rolling because we have our own skin in the game. So we are in the process of taking that property and rolling it into the fund so that all of our investors know that we are part of this too. So that's our skin in the game. But we also have, when Pat and I met through Rinda, again, great connection on the Subto network. We hit it off. I mean, he's from Chicago. Talking. So, but we started talking about what's our vision, right? And Michelle is really the one behind the whole grand vision, because she goes, look, we need to do this because we're retiring mom and pops. We're the baby boomers, they're sitting on these great businesses, but nobody else will take the lead after them. So we're taking that on. But also there's a component of what we do. So we did our Mount Everest, and that's really what was driving that. So we're behind it 100%. The end game is really to be able to support families that have an issue with medical bills and all. So we are doing a portion of charity that's going to be at the end of that. But this is our business, 100% invested in our time, energy. I'm actually working harder now than I was in the W-2 job. I mean, it is what it is.
That was a warm up, bro. Come on.
Yeah.
It was what?
That was a warm up.
So I own other real estate. I own a couple other businesses. So that's relatively passive. I have my teams built out on that other stuff, but I spend all my time on this now.
Yeah.
Yeah, and Rinda, same thing with Rinda. Rinda has a full operations business. She helps other companies with their operations it's a service-based business. She also does transaction coordination. She also owns some of her own real estate. So it's a 4-person power team that all came together that doesn't need to draw big salaries to go build something cool.
Yeah. And we did just hire a director of operation for the parks, because now we're at 5. We're going to be at 5, and we need help. You just mentioned it. Absolutely 100%. We need to scale. So we've created our org chart through the Owners Club. It was great mentorship from Pace, but we do know where we're going with that. So we have building blocks that will help us elevate this company and really take care of the fund. So
I mean, I've known this group and this couple for a long time, and I've been telling them that they are the future face of the RV park world. And you guys RV resort world, yes. This team is going to go do really, really cool things. You already have done cool things, and you're helping a lot of people along the way. One other thing that they'll be adding is additional revenue model outside of their fund is they have so many deals coming to them in the RV park world that they'll end up probably wholesaling a good amount. You guys will have additional revenue. It won't be a fund thing. It'll be your guys' own partnership thing. I'll probably buy 2 or 3 of your RV parks this year just from your guys' wholesaling. So you guys have a lot of good things going for you.
Yeah, thank you. Good.
Can I get back into some of your deck, if that's all right?
Yep.
If you go back to, you guys have some historical performance in there in your numbers of what's already in there, right? Okay.
Historicals.
Yeah, just what's already happened in the fund. You have
So it's like page 2.
Page
I have this under management. Is that what you're talking about?
Yeah, I was just trying to see what's already happening in the fund right now.
Oh,
is that like
no?
What's
So
already
what
in there?
you were talking about that is not historicals on fund performance.
Okay. What's happening in there right now is my question. Of like because you have some assets already that are in here. So I know you got a new one coming up. You mentioned.
Yep.
But there's 4 in there right now.
Yep. So 4 in there right now, and then closing on the 5th. So what we're doing right now is the value add component, adding pads, getting websites, updating the rents, building out our operational infrastructure. So when we take down 5 more in 2025, that part is done. So
do you have any
stabilization.
Are any of those at stabilization yet? None of them are at stabilization.
They're all stabilized.
They're all running.
Oh,
yeah. They're all running on all cylinders. Well, we're going to add some more to it. So
okay. Yeah. How are those doing? Is what I was trying to get at.
Lake Ridge, for example. You want to talk about that one?
Tell me your best one that you have right now, and your least performing one right now in terms of return.
I would say the best one would be Lake Ridge.
I mean,
we're all again. Go ahead.
I would say the best is probably Papa Chubby's. So acquisition was extremely low. Acquisition costs, there's immediate value in that.
There's equity in it.
There's a tremendous amount of equity in it. So there's the food and bev component, which is Patrick, hospitality industry. We have a restaurant consultants like beefing that up, updating the menu. It already is performing, but there's a tremendous amount of value add. We're adding pads as we speak. And then there's all the existing commercial zoning to develop on.
Yeah, there's future.
So that in my opinion would be the strongest. I mean,
does it perform from a cash return standpoint to the fund the best right now, or it's got just some built-in equity and future development
after
value?
season. So ask me in 11 months.
Got it.
Okay.
Yeah.
But the forecast is we're our pro forma for that one. In particular, we are looking to be around 600,000 in NOI net.
You haven't had it for the season, which is summer, I presume, out there.
And that was part of
the reason for the acquisition the way we did, to be able to come in and do this when it was down.
Get it fixed, get it ready to go.
There's contractors everywhere building that out. We're adding off of the restaurant, we're adding a convenience store that you have to walk through. So liquor sales, you can buy that. All that's happening as we speak.
We're looking to make $500,000 net out of that space. And it's like a barn dominium, the steel building that goes right in front of Papa Chubby's. So, and in the same style. So people will walk through there, merchandising, selling T-shirts, and I mean, it's everything.
Do you have one that you've seeded yet? That's stabilized. That's like in the fund, stabilized, and the cash flow at least.
Virginia.
That one?
Yeah,
okay.
the water slides, yeah.
Okay.
Yeah. So that one, we just took it over. Actually, it was, we bought it from people that bought it a year and a half ago, but they were in over their head. They didn't have their systems. They didn't have a lot. They just took an old park and then
They put a lot of sweat equity into that.
Yeah, they did. So we're benefiting from that, but there's still a little bit of work to do. But the park is rolling, and our reservations. Here's the other thing about RVs is that you're getting the money up front on a lot of this because people make reservations for July. They want to be there because the park is sold out in July. So we are getting their deposit and we're getting all that money. So despite the fact that we're going to be in a low season right now, when we acquired it was literally just before Thanksgiving and the low, but we have money that came to us. So on day one, they handed us, money to literally pay for everything else. So,
okay.
Yeah.
What I'm trying to get at, and this is some of the strengths you guys have with existing assets, is trying to understand, is there a historical performance I can look at and to see how these are performing based to what you kind of your pro forma on them versus, and so like projections to actual basically.
Yeah.
Versus here's the next deal we want to do. And even some other deals we've seen are like, well, this is what we're looking at doing. We need the money to do it.
I mean, the T12s for all those deals are confirmed, right? So obviously we've been acquiring over the past 12 months, but those in seasons, those are all actuals and realized.
Okay.
Yeah. So some of the numbers they've shown on here are actual numbers from their actual parks.
Correct.
Yep.
Got it.
Yep.
Okay. Which numbers?
Go back to the one was your financial breakdown that you would show to a bank.
This one here?
That's an actual.
Yeah.
Yep. That's all actual.
Okay.
Yeah. Yep.
Okay.
What's annualized?
Yeah, and then he's the CFO, so he's not only they acquired the T12s from the previous owner, but he's the one that's been in charge of the T12s of the existing 4 parks they've acquired the last 12 months.
Yep.
So they're all producing, they're all bringing in income. You have financials to show.
Yep. Absolutely.
Yep.
Yeah.
We go through a pretty rigorous due diligence process.
And then we've also talked about hiring more people, right? So we have our CPA, we have our lawyers, we have a team, we have a person that does all of our bookkeeping, and it's just one person. It's actually, she has like 10 people working for her. So it's extensive bookkeeping. Like I said, Pat mentioned before, each of them have an LLC, and each property actually has 2 LLC, one for the land and then one for the operation. Because as he said before, if somebody comes and wants to do a lawsuit, you just,
So a lot of the payroll is being paid, all the payroll is being paid for is coming from existing cash flow on their existing parks. So everybody that's on their team is being paid for by revenue that's already being generated.
Yeah.
One thing I would add. So RV resorts, right? That expense line item of that's the number one is payroll, and then payroll tax. And when we're acquiring these from the mom and pop shops, they're extremely bloated because it's their sole livelihood. They run their personal home and Netflix account, right? And everything runs through this RV park.
Yeah.
So right away, we're able to slash a lot of that payroll expense.
Yeah. But a lot of them, on the other hand, too, you could see is they're not taking money. They're not taking a salary either sometimes.
That's what I'm saying. They are taking salaries, right? So like,
I know, I'm just saying a lot of small businesses, they're like, they are the person operating the business every day, and it looks like it's profit coming out because there's no salary for the owner.
Yeah.
You know what I mean? Okay. The one thing that I only have one critique because I thought you guys did excellent.
Phenomenal.
Yeah. The one thing that because once you got to hospitality and I was getting that this is an RV resort different, I started seeing the pictures because I was thinking RV park, and I started thinking, who is your customer? And I think that would be really good in your description of like, how are you serving that customer that comes to your RV resort? And how important are they? And because I think when you connect with them, and I know that they're like in top of mind, and you have limited time here, of course, but like, I think that's a important thing. And a lot of these other deals, it's different, but I think you guys, particularly if it's got this hospitality angle, I kind of get touched by that sometimes. Like, I'm like, they really understand their customer.
Yep.
And so when you mentioned it a little bit, and families going, but my only experience going to what I wouldn't call an RV resort, I would call, I don't know, it's in the middle, RV resort, RV park. My daughter came home from elementary school, 8 years old. Dad, what's camping? Have we done that? I was like,
oh, here we go.
I was like, I have failed because my youngest daughter. So that weekend, we went to an RV park.
Oh, okay, sweet.
/ resort. They had some fishing on site and stuff.
Did you rent a cabin or did you?
We camped at the park.
Okay.
So we camped in the back of the car with the tent. And so, I get it. So
how were you treated? Did you reserve online? Did you talk to people or?
I reserved it online.
Yeah.
And so, but I liked the family. I was just trying to, like, I could have connected with that if you got that. Like, that was a big, like, emotional thing in my, like, I still remember obviously now because I was like, oh my gosh. But like that family time and who's using that park and that type of stuff, I think probably the only thing.
That's one of the things that we actually improve on our websites.
Yeah.
The amount of websites that are there that are just dull, it's like there's no action. Now, if you're going right now to Lake Ridge RV Resort and the first thing you see is a lake, and then you start seeing families and entertainment and all that. So the way we talk to our people is we're looking at historical, everybody that stayed there before, and say, hey, either we announce, pretty heavily the new management, or hey, improve this, improve that, better Wi-Fi. We're really connecting with them, because I'm sure when you went, you needed your Wi-Fi, right? The kids were there.
Yeah.
You were on your phone probably at night, and then enjoying the day with the kids,
that,
right? So, family time, very important. And that's what we're focused on. So every property. Now, we do have, one of our property is more about, there's 51 spots. It's a smaller Camp Mikasa. That was the second one that we bought, 100% seller finance. And the owner was built it in 2014 with her husband. Husband gets a stroke 3 years ago. He can't really do as much. They haven't been on vacation in 10 years. When we connected with them, and Michelle sat with them, and we said, hey, what do you want? And she says, I just want to go on vacation. And she was working in a bank. She was actually a mortgage broker for a bank. And it was either the bank or the park. And so we ended up telling her, retire from the bank, work for us. And it was a light bulb moment. And then so what we're doing is we're using the staff that's there right now. We're using that really touching, connecting with customers. But what I wanted to say is that the people there, that park, there's 51 pads, about 37 of them, they're permanent. They're living them almost like a mobile home park, but it's an RV. And at any time, sometimes they just say, okay, hey, I'm off for this month. I'll go to Florida right now. A lot of them want. But in the meantime, we have all the transient and all the workers working in that. So consistently, we're looking at what is the park going to do to perform? And then now we have Stephanie, who's running that park, who knows it inside out, and she gave us 3 years, and that was part of our deal for seller finance. So she's not getting the tax hit on the wholesale. So
anything else you got before closing remarks for me?
Yeah, go ahead.
You done?
Yeah.
Appreciate your question.
Great job, first and foremost.
Yeah,
phenomenal job, guys. Also, what I love is that all of your guys' previous experience shows up, and you got everything in your previous life was just a warm up for this amazing moment. You guys are going to go take over the whole world. It's freaking awesome. One thing I would add, I know you have short time frames. So again, this is not a critique for you, but just an addition for education for people, is I would show people what this industry looks like in 10 years.
Oh, yeah.
Because I know as an RV park investor and believing in what you guys are doing, I know that the market is tripling in the next 10 years.
Yep.
And so your investors should know that, right? In fact, I would even show, like, while Airbnb is dwindling, this is projected to triple over the next 10 years. And here's the 7 reasons why. When COVID hit, people realized they could work from the road. I would even do a thing about Starlink. Like, since Starlink has been out, that was one of the reasons why I didn't hit the road for 6 months. Yeah. When Starlink came out, I was like, I'm buying an Airstream and I'm hitting the road for 6 months because now I have unlimited internet. So I would maybe do a slide or two about that, of like where the market's going and what has changed and why people really like this. Also, I would even highlight to people that don't know this. You guys obviously know this incredibly well. This is not an education thing for you guys. You guys are doing great. But there are the permanent people that live in these parks that they can rent a whole space from you guys for like $1,000 a month. Utilities, internet, all these things included with $1,000. Where the hell are they going to live for $1,000 a month with sewage, utilities, et cetera? You're not your customer. Great point from Matt. Highlight that customer, that family, because you guys have camping, you guys have cabins, you guys have all the things.
Yep.
Highlight that customer who's coming there for the activity, but also highlight, when the economy changes, you guys can just rent these places out for $1,000 a month, and you're making money no matter what.
Yeah, in the Midwest, in Branson, Missouri, for our first property, it's $650 plus electric. But we installed meters, right? We installed these things to measure and to be able to do that. The previous owner was charging like $700 all in, but he was losing money because he wasn't charging the electric, so the proper rate. But yes, absolutely. The metrics and understanding of all that. So we did have market trends and in the presentation, but this is short.
Of course.
So we do.
That's more for everybody else.
Yeah.
You guys, I know you guys would have had all that stuff in there.
This is probably the biggest one, is that first-time home buyers has risen to 56 years old. So if you're a 56-year-old person, which is not even me yet, but that's most people buying their first house right now.
Wow.
So affordability is not there. Right.
And this is why this is the future, is that people want to
Absolutely.
get out, see our country.
Yep.
There's an interesting stat also about how Europeans think that Americans are so under-traveled.
Mhm.
But the reality is we don't need passports because we just visit our own country because our country is the best in the world.
Yep.
But there is a stat there that's really interesting too, that I won't go into, but RV parks are one of these things that you don't even know how many there are until you own one. And then you go visit a couple, you're like, dude, these things are freaking everywhere.
They're popping up. It's the red car, right? The
Yeah,
red car.
the red car, yeah.
So definitely, we're everywhere we go. I mean, Michelle actually has this idea of every time we drive, we say, "Hey, there's an RV. Let's just throw a flyer at them as a joke." Like,
Yeah.
But it's true. I mean, we're seeing RVs everywhere, and I didn't see that before. But over the last 2 years, really, because prior to we were looking at joining, and we're really seeing the development of that. There are some new RV parks out there, but the majority of them are renovated. It's mom and pop. So talk about fix and flip. I would say that RV parks in general, what we're doing now is a fix and flip, right? But we're keeping them, and we're keeping them for 5 years and appreciating them. So, and final thought is that it's much easier to work an RV park and fixing it versus an apartment complex. I think multifamily is fantastic. You have rents, you have renters, so you have to deal with that. If one of your pipes burst in unit 4 of 105, okay, so you're going to have to fix the water, right? But if it's floods and it contaminates the rest, then you have to fix all that. If we have a faucet that breaks in an RV park, I run a hose 25 feet to the other one.
Yeah.
And my guest, because we don't have rent, we have guest fees. And so my guest is happy and he's able to continue enjoying his vacation with his family.
Yeah, you don't deal with any of the crap you deal with on single family stuff. The management is so low. Most of the people actually, Matt used to speak on, what's the name of it? Host campers?
Work campers.
Work campers.
That's another thing. So
there's like full-on communities of people that will work for
hundreds of thousands of people
Yeah.
on that Facebook channel. And it's just, we're getting, like I said, there's a list of people, even Alaska. We're like, okay, do we really want to go to Alaska? Well, after we met the owners, unbelievable. And they said, listen, I already have people, they told us, they have people that are managing it for them. And you need to meet with them, which we did. And then they said, well, look at the work campers. Seasonal, everybody wants to go. We have a list of 100 people more that wants to work as a work camper. So
it's an exciting business, and this is an exciting opportunity. You guys obviously have your crap put together. It's freaking impressive.
100%.
Super proud of you guys. Great job.
Thank you for the opportunity.
Thank you.
Hey, Patrick, one more time, put your contact information it's already up there. Perfect. As we transition to the next person. Thank you, Scott.
And can I say on this one, this is like, so if you're investing, this is accredited investor.
Yeah. Accredited
Okay,
investor,
506C.
Yep.
Which is for those of you raising capital, right? This is that investor category. They have their management team. You're in a passive role, don't have responsibility. You get a share in the return, but you have to qualify as an accredited investor. 200,000 annual income single, 300,000 annual income married, or $1 million of net worth, one or the other, which can't include your home. So
all the PPM docs, all the legal to support that. Yep.
Cool.
Thank you.
Great job, guys.
Thank you.
Do people with IRAs invest in that?
Yeah.
Have you guys had IRAs invest yet?
Yeah.
Yeah.
Cool.
Absolutely. Self-directed IRA. Absolutely.
All right.
As long as your LLC is set up, obviously for your self-directed.
Do you know anything about that?
Yeah. You don't need an LLC. They can go right into the fund. Yeah.
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 But you guys set up their LLCs and all this stuff, right?
Yeah. If you need one, but you can just have your self-directed IRA invest right into their fund.
Yep.
Yeah.
And that's very simple. It's actually clean, very, very clean and easy to do.
Yeah.
If I call you guys to invest, am I talking to Michelle, Rinda, or Pat?
You're
not talking to me.
Yeah.
You're calling me first.
Okay.
I'm the first point of
You
contact.
screen people for Michelle?
And then
you'll talk to me.
Then we'll make sure. And most of the times we've been doing this together, but we're getting quite a bit of calls right now, so we're expanding and making sure that everybody's taken care of. We're using one more thing, but we're using a platform for communicating. Right?
So we use InvestNext, which is very typical in real estate funds, organizational. So you are an LP, you're an investor. It is within our website. You can log in. all of our respective P&Ls and rent rolls and tax documents and everything will be per site, will be all in one spot for you as the investor to see that.
That was
Freaking love that. People call it the data room type thing.
Yep.
It's like all there,
Yep.
prepackaged. Anyone wants to deal
Yeah, yep.
that can look
So-
at it.
And that's
And
currently
you
what we're
update it to last performing stuff.
Yeah, yep.
Love
Yeah.
that.
Great job, guys.
Thank you.
All right. Amazing stuff. Are people on YouTube enjoying this?
Yeah, they seem to be.
Okay. I can't see their comments.
Yeah, I can see the comments.
But anytime we hang out for 6 hours on YouTube with this kind of this is awesome.
Yeah.
All right. Sam, who do we have coming up next, Samuel?
All right, we have a little bit of a different spin here. So we have IO Sunmoon.
Okay.
IO is going to be on Zoom. We're going to
Okay. IO.
have their business partner, Andy Choi. And he'll be here right now.
Okay. IO and Andy Choi. I love it. I met Andy Choi last night at dinner. We took everybody to Mastro's and I'm the only one. Did everybody get butter cake?
Yeah, it was so good.
Tell me it's not the best dessert you've ever had in your.
I had a bite, but it was divine.
Oh my gosh.
Excellent.
Excellent. So freaking good.
Like City Hall Mastros? Which one?
Yeah.
City Hall?
Yeah.
Okay.
Okay. So don't you wish you could do this like one time a week? Like you have the time for it?
I do. Yeah.
Because you could just
I
be
do.
putting money into deals every week.
Because I'm able to like find some cool deals and meet some cool people and also try to teach a little bit.
Yeah.
It's like
kill all the
triple
birds.
play, man. I love it.
Birdie and
And
Lee,
hang out
just so you
with
know,
Morby?
this like how you've prepared for this is showing up. I just want to let you guys know that. Like how you've prepped everybody how to present, all of those things. It is so good. Thank you.
A lot of different deals and
Oh, I'm down for.
Got my pom-poms on ground.
Oh, well, we will all enjoy that.
Pace called this Saturday Morning Live, so you guys could do a little skit, you know, like a little Saturday Night Live, little SNL. Yeah, SML. Yeah, SML.
Not be appropriate for the cartoon crowd.
Yeah.
For everybody that's been asking, how did they get the opportunity to present in here? Everybody in here is Owners Club, trained at a little bit higher level, highest level group in our community. They are the leaders of our community, unbelievable people, very diverse, from people that flip houses to buying businesses, RV parks, mobile home parks.
I just joined in the webinar. What up? Can you guys hear me okay?
You're working a deal right now.
I did. I am working so many deals at the moment. Thank you so much for having me virtually, you guys. Let me put this on silent.
Okay, Io, we'll introduce you in just a second. Andy Choi, how you doing?
Amazing, Pace. How you doing?
What'd you order last night at Mastro's?
Oh my gosh, I got the steak.
What kind of steak? What
It
kind
was
of
a fillet, 8-ounce fillet.
That's
medium
all you
rare.
can handle is 8 ounces?
I mean, I had to keep it light for this opportunity here. You know,
Okay, I love
the
it.
camera adds a few pounds. I heard.
Do you,
So it's
you ever go to dinner
I had
with
keep
people
it
and they
light.
order like a charred, well done steak?
Oh, yeah.
That's Jamil.
Yeah.
I'm like, what, dude, just order beef jerky. What are you doing?
Yeah.
Are you a medium rare guy?
I'm running a good thing.
It was a great opportunity with the Owners Club members. Some really amazing people. And I'm glad to be here. Thank you guys for providing this opportunity.
Of course, we love doing it. So the floor is yours. We'll let you run this. Now, IO is on virtual, so we're going to have two different things going on. Eric already knows to do this, but the speaker that you guys will be hearing IO out of is over by Eric, so we'll be as quiet as we possibly can so we can hear you across the room.
Right on.
Floor is yours, Andy and IO.
Right on. Thank you guys so much. I'm able to do this virtually thanks to you guys. What happened was my wife went into labor a few weeks earlier. So Thursday I got to meet my baby for the first time. So super grateful. Shout out to my wife. Ingrid knows the story and the journey. So yes, super blessed. Brave the wildfires to be in this world. Anyway, so Andy and I are here to discuss some great opportunities and teach folks what we do at Urban Equity Holdings, where we believe in wealth creation through responsible urban infill. Just want to kick this off with a quick disclaimer. My partner Andy and I are not financial advisors. This deal is not an SEC offering. Projections are based on past performance, which does not necessarily guarantee future returns. And we are more than happy to provide all the legal paperwork so you can consult with your financial advisors and your attorneys.
Was that off the cuff? Damn. That's pretty good. Yeah, you've done that one before, huh?
No,
It's a practice.
we're so pumped to be here, and we just want to be very transparent with everybody. So I'd like to introduce the sponsors of the project. So standing by my side virtually and in your studio is Andy Choi, who's been doing development in Los Angeles for 10 years plus. He's completed over 100 projects ranging from wholesale, single family, commercial, and multifamily development. Not with us, but working hard behind the scenes is Isaiah Henry. He's underwriting deals and sort of filling up our pipeline for 2025 and beyond. He works in the private equity space and has his own kind of own portfolio of service-based businesses in the East Coast. And then there's me, Ayo Sanu. I am very passionate about construction. I've been building in the commercial space since 2005. Everything from retail, mixed use, commercial, affordable housing, luxury, residential, tons of other stuff, cool LAX projects, airport projects, that type of thing. And so throughout my construction career, and as I pivoted into development with the help of learning how to invest through communities like Subto, I was starting to put the pieces together that, building at this rate with the current cost of development is not sustainable. I was on a project that it cost nearly $600,000 per door to provide affordable studio, quote, air quotes for affordable. And so, it really left me questioning hey, how can I help solve this problem? I partnered with Andy, to sort of answer that question, hey, how can we on the private side bring in equity partners and figure out how to build efficiently, bring more housing to the marketplace and still maintain quality. So what we came up with was a pretty concise system to deliver quality housing in Los Angeles by utilizing infill lots in desirable areas and while taking advantage of key pro-development policies in California, like ADU laws, so that we could build to the max zoning permissible by right in California. I'm going to share with you one of these deals that is sort of an illustration of this model, and we'll call this deal Comey Avenue. We are currently seeking $325,000 in exchange for 20% equity to our investor partners or partners. The minimum investment is $162,000, for which you will in return receive 10% equity of the LLC that operates Comey Avenue. The project IRR is 61% and the equity multiple is 2.43. At our firm, we implement a 50-50 split between the sponsors, us, and the investors. We can call them GPLP. As the sponsors, Andy and I will handle all aspects of the project, including finding the deal, obtaining permits, overseeing construction, managing leasing, ensuring that the project operates smoothly. For you, the LP, the investor partner, your projected return would be a 34% IRR, a 1.71 equity multiple. So for the people in the back, what this means is that, say you invest $162,000, you would yield an estimated $110,000 in profit. At the end of the project, when the property is sold, will return your principal investment along with your profit. So that's kind of illustrated in the table down at the bottom.
This is in California, I imagine.
Yes, this is in Los Angeles, Comey Avenue, and this is a rendering of the project that we are building there. A little backstory about this one, Pace. You might remember this one. It was a pre-foreclosure lead that I door knocked in my backyard.
I remember this, yeah.
Yeah, so this woman, Sharon, she fell behind. There was a series of events. Anyway, hard money loan. She wasn't able to keep up with it, lost it. Luckily, we were able to step in, get into solution mode, stop the foreclosure the day before the auction, sort of unwind a few other challenges related to her health. In the end, we were able to help out a member of the community, let her stay in the property for 3 months rent-free while she figured out next steps. In fact, we even found her a new place guaranteed her with the new landlord. The cool thing about it is that, we asked her, when she agreed to sell it to us, we asked her if she would carry back some of that equity so that we could bring her in as an investor in the deal. And we did that for a few reasons. One, just because we wanted to, obviously it made the pro forma better, but we also wanted to put more money in her pocket to kind of close the gap and make ends meet, because our larger goal is to basically at the end of the 2 years, when she is also cashed out, we'll have rebuilt her credit and we can get her into her own place and get her back on her feet. So anyway, this is a really great story. This is one of countless distressed properties in our backyard that fit this infill lot strategy.
And also it has nothing, it's not even remotely close to the fires that are going on right now, guys. There's already people asking that question.
Oh, good point. Yeah.
Yeah, I mean, everybody that thinks LA, obviously LA is huge. People are going to immediately go, oh, is this a fire area? No, this is across a freeway. This is across a whole bunch of stuff. Yeah, there's no way that a fire would ever reach this property. I mean, this fire, I don't know if some freaking crackhead at Skid Row is going to walk over here, but this isn't a safe area. It's north of Culver City. I just looked it up on the map. This is a great area.
Yep. Yeah, I'll get into the location in a minute, just to get you guys familiar about what it's like to invest in Los Angeles. A lot of people are a little shy to invest, but I've got some great reasons why you should be pretty bullish on Los Angeles, and I'll get into that in a minute. But just for the just kind of framing the project itself, our plan here is to take down currently a single family home, build it up to 5 units, taking advantage of what we can build by right, which is two units, and then 3 additional ADUs, so total of 5 units here. The whole project life cycle is 24 months. We're already into that with acquisitions, and we've already started some of our pre-construction to get us ready to issue plans and permits. I know it was brought up, how challenging it is to get approved for plans in California. But we're at a good place in that process. We should have RTIs in March and be ready to break ground in April. So
what's an RTI?
Ready to issue plans.
Okay.
So that means gone through permitting and gone through plan check and been approved. So basically, if you came into the deal now, you're kind of at a great point. You're kind of reducing your risk to that whole process since we're kind of through that hurdle. So like I said, we'll build, probably take 12 months or so to build. And then that leaves us a cushion of 5 months to do lease up, stabilize, sell the property and so forth, because our strategy is to sell it at $4 million, which would put it at a 5 cap. If in the event at the end of this project, it's not, market conditions shift a little, maybe there's more of a correction, we can hold on to the property, refinance it at a lower interest, and just hold it, it'll cash flow, and then we'll just wait for a more opportune time to sell. So this is like next slide is a overview of where the property sits in Los Angeles. So for those of you who don't know, it's about 15 minutes from all the major entertainment studios in Culver City, 15 minutes from Beverly Hills, these iconic places like Rodeo Drive, 15 minutes from all the well-known beaches in West LA, which are unfortunately experiencing a lot of wildfires, but because we're east and south of that, this property is in a safer area. It's 15 minutes from UCLA and at USC. It's really central, basically. And Pace, incidentally, it's only 3 minutes from Charlie Rocket's Dream Factory. So I know you know.
Oh, that's a great spot. Yeah.
Yep.
Cool.
So just for you, those are a little shy about Los Angeles and why to invest there. While a lot of cities in California, you're seeing migration out to places like Texas or Utah or Idaho. That's not actually the case in Los Angeles. We experience year-over-year population growth at just shy of 1%. So it's like 12.5 million people living in LA currently. That growth is about 100,000 people every year. So just to also kind of drive another point home, it's a rental market. 63% of households rent, not own. And especially right now with what's going on with the wildfires Pace, there's a lot of displacement happening. The demand is already high for affordable housing, and let alone, what's going to happen now that people are impacted with the loss of their homes through the wildfire. And our renter avatar for Comey is sort of this tech worker, entertainment worker. So we've got, just so people know, the employers in this region, they're kind of like the entertainment industry, tech, aviation, like YouTube, Activision, Hulu, Disney, SpaceX. That's kind of giving you an idea of who's going to be renting these spaces. Next slide. So let's get into the economics, and Andy is also able to answer any questions that you guys might have. But for now, the performance slide speaks for itself. $1 million purchase price. The construction cost is just shy of $1.5 million. Financing and finance fees and admin costs, about $320,000. So the most important thing is, out the door, the total project cost is $2.785 million. And
is the seller, I don't see it here, but maybe I'm wrong. How much is the seller carrying back?
she's carrying back $110,000.
Got it. Okay, got it.
Yep. So I can go into the sources and uses because we kind of already went on into the exit and the profits. But
okay, so IO, you already covered this a little bit with the raise. You're only raising $375,000 roughly. So you guys are going to go get a loan for 1.9. The equity 811 is much higher than what you said you were originally raising. Why is that the case?
Oh, we've already got committed investors in the deal. So
okay.
We've already secured our loan.
Okay.
So we just have the remaining raise, which is $325,000.
Just a critique before you even finish. So maybe you were going to go here. I probably would have put that on the page that you said you're raising 375. I would say something like, we already have X amount of investors at $500,000 committed to this project because it's super exciting.
Right.
We only have $375,000 left.
Right. Yeah.
Right. The fear of loss is greater than the motivation for gain.
100%. So let me backtrack a little bit then. So, that 20% that is given to the investor or investors who come in with that remaining 325, that's because Andy, the sponsors are going to take 50%. The LPs are going to get the other 50%. So $162,000 contribution is about 10% equity.
Okay. Love it.
So we've already secured nearly $2 million in debt financing through institutional lenders. We have
who's qualifying for that?
Andy and I. We
Awesome.
We already signed on.
Okay, great.
Did they have to personally guarantee? Did you guys have to personally guarantee?
We did. I and I personally guarantee the loan. It's recourse.
Yeah. So
your butt's on the line is what I was trying to get at.
We're going to put absolutely. Absolutely.
Owns you.
We have skin in the game, yeah.
Yeah, we have skin in the game, and then how you at the top of the this webinar, you guys were talking about other lender types. We brought other lenders into this deal too to help us with the foreclosure and acquisition piece. A lot of people are making money. We got a great TC through Top Tier TC, Lynn Davis, shout out. So lots of people are involved in this deal, but anyway, we there's other ways that we can bring on investors and lenders to this deal still. But our budget is pretty well defined, detailed line items, and we've grounded them all in actual data from previous developments. So these are real world numbers.
And these are previous developments. Obviously, Andy, Choi, and you have the experience, and so you're aggregating collective data between the projects that you've successfully done yourselves rather than somebody else.
Yeah, and later in the presentation, we can show a few case studies of that. That's how we get our hard costs really dialed in. We stay pretty competitive. We have some key partners, but we're always getting more and more competitive bids, just so there's no complacency there. Andy and I do tons of SWOT analysis constantly to reevaluate how to make sure that this stays efficient and on track. So anyway, the most critical thing about this is, take a look at all the numbers, but, the total project cost again is $2.785 million. And you're working with seasoned developers like us. So we can answer any questions before we move on, if there were any questions about this slide.
They're great.
Okay. So going on to the next slide, which is the pro forma rents. We analyze rent comps in the area. We'll show you that in the next slide. And, pay attention to that number down in the corner, 22,400. That represents the gross scheduled income. Think of that as the monthly revenue generated by the building. That's what's providing the reliable income stream. What's compelling about this unit mix that we've decided to go with is, they're larger units, 3-bedroom, 3-bath. So we're thinking thoughtfully about the kind of client where the client avatar or the renter avatar, and, especially smaller families, maybe. I think this comes at a perfect time for what we were talking about earlier with who's being displaced at the moment with the fires. So, happy to.
Yeah, I think thanks for pointing that out. Somebody from Arizona, I'd look at 1,200 square feet and I'd be like, 3-bed, 3-bath. Like, what are you doing? But it makes sense where you are, right? This is a very LA thing. So you guys have obviously done your homework. You have the experience. Thank you for pointing that out.
Yeah, and we know too that, this is also a co-living model that can work so that everyone gets a bedroom bathroom ratio there too. So it works for small families. It works for, young
roommate situation or what have you. Yeah.
Exactly. Yep. Okay. Next slide is kind of showing you kind of the like for like what we're competing against for those rent comps. What we do is part of our model is, we're and just for folks to understand the rental market in LA a little further, what we do is we make sure average rents in our infill lot strategy exceed $3 per square foot. And that's very easy to do when you buy right, and you go after the distressed, and it's a win-win for everybody. So our pipeline is full of deals like this.
Isn't this crazy? This came from IO door knocking a foreclosure in LA.
That's crazy.
So cool. And helping the seller. You guys helped the seller get into a new spot, you said earlier, right?
Yep.
So cool.
And she's a friend, at this point, we're very much accountable and grateful. I mean, we can go into the story of her later, but yeah, it was a great story. One thing to note for folks is to look at what the rents can fetch for a 3-bedroom, 3-bath in LA. I don't know that people are used to this maybe in their city, but this is pretty typical for Los Angeles. So we can go into the sales comps, which kind of help us get to that 5 cap we were talking about. These are comps that we did like for like properties in the area. And if you notice that fourth one, I think the numbers are inverted, but it's number 3. It's the 4th one on the 4th row, and that is, I'm sorry, it is the.
No, you're correct. It's the 4th row. Yeah, it's the 4th row.
Yeah, so 6066 Comey Avenue is right next to our subject property that we're developing. And that one went and was sold in August for 4.3 million. So with our expected exit at 4 million, we feel really good about that, especially with the time horizon that we're going to be selling in about 18 months. So we'll see appreciation on our project, probably higher than the 4 million that we're anticipating. But
are you worried about your lot size compared to their lot size? I think you guys are 40% smaller lot size than them. Are you worried about that at all?
Yeah, well, luckily
you took that into consideration.
We took that into consideration because of the ADU laws. This kind of gets in the weeds. We don't have to provide parking density. So we had a lot of other things that we could do with that square footage that the other competitor didn't have.
Okay. Makes sense.
Yeah. But yeah, good catch. Next slide is kind of just reiterating the target returns and what we're asking and what we're seeking. So again, $325,000 for a 20% equity, minimum investment of $162,000. And so that's the breakdown. You contribute $162,000, you make $110 out of the deal in less than 2 years, and so your total return will be $272,000. I spoke a lot. I don't know if I missed anything, Andy.
No, I think you did really good. Just a really great opportunity to, provide more housing, more density in Los Angeles because there's much need. And also, Io and I were very passionate about doing it quick, doing it efficient. We run a very tight ship in our operation. If you're on the boat, you got to row. There's no space on the boat if you're not rowing. So the whole SWOT analysis, we're constantly leveling out bids, getting competitive, speed to market, so that we can house more people in the long term, quicker and faster. Yeah.
Yeah, so we threw up a slide there with our QR code for anyone who wants to kind of find out more about the deal. You know, you're welcome.
Man, I'm like wanted to invest in everybody's deals. You know, have you had that same feeling?
Yeah.
I'm like, where should
I said, hey guys, can you have like one deal bomb?
Yeah, for real.
Because that's reality is more deals bomb than do well.
Yeah.
Right. And I'm going to be like, yeah, that's a bad deal.
We tried.
You tried?
We did.
We
See,
just
we
have
talked about that, huh? We really did, because that's the reality of it. And I'm like, I don't want this to seem jaded.
Yeah.
Like every deal you're going to see is a good deal you're going to do, because that would send the wrong message.
Right.
So we should probably say that.
We should say that.
These are better than what you're typically going to see.
I'll tell you, our company looks at probably 20 deals before we say yes to something. I literally would say yes to almost every one of these deals here today. And I hate LA. And I would still write a check for this deal.
You definitely pitched to Jamil.
The return is
Stupid. And this is a great team with great story. And like, honestly, I mean, I haven't looked at all the things, right? So this is just
you got to validate.
This is conjecture.
Verify.
Yeah.
But I'm like, yeah, this plan makes sense. It's a short time frame. You already have people invested. You guys have put personal guarantees and your credit on the line. You're out there with more projects. So this is and also your track history, right? You guys have been doing projects. You've been in construction and doing projects like this since 2004, right? Long time. I mean, you're making babies. Gosh, damn. You know how to make something.
Yeah.
Yeah, no, we'll paste
I'm going to hold on the
the
Papa
scarcity here, because we're doing deals like this. This is an example of something that we're doing, you know, hand over fist, and especially.
Yeah, and what I want to point that out. There's obviously large development companies in LA, but when you're doing infill lots like this, you kind of find a small niche that beginner investors can't touch this. Bigger investors that's too small for us.
Right.
They're going for bigger things, right? Buying something, tearing it all down, rebuilding the whole thing brand new. There's multi-billion-dollar development companies in LA that would never even look at this.
Mm-hmm. It's too small, yeah.
But you guys having a tight ship, everybody on the boat has to row. You can't just be chilling. You guys fit in this little niche of little infill lots like this. My gosh, I love it.
The Goldilocks of development.
Yes.
That's good.
Get in your boat any day.
Yeah. IL, you did a great job laying out the details. You guys obviously know what investors are looking for, because the way you flowed through this, you did such a great job of the presentation. You also have a track history of actual projects. Your estimates on your construction are not just, hey, we think it's going to be this. I like everything. I'm sitting here going, I got to text somebody at Directed IRA and go, how much money do I have in my retirement accounts?
I don't mean to be a dick, but I have a couple questions.
Be a dick.
All right. Okay. This is lawyer Matt, he's no fun, but okay. Can you go back to the slide? I want to talk about management fees and management costs. I'm just curious how that's built into the project and the costs. And this gets back to one of the things I talked about at the very beginning was, when I'm investing, I want to be making money with you and not you making money from me. And usually when I see management costs, management fees, sometimes I get a little gun shy, because I'm like, is that to you guys? And which is okay. But I want to know, and you're transparent in dropping it in there, but I want to know, is that checks to you guys?
The simple answer is yes. The management fee, the $272,000, those are management fees to the management partners. That's a 2% acquisition fee, 6% development fee, and a 2% dispo fee or lease-up fee when we sell the property. Mainly because...
So sorry, you had a
2%
asset under management fee and acquisition fee?
Acquisition 2%.
Acquisition 2%.
Development 6%.
Development 6%.
Stabilized disposition, like selling the asset, 2%.
2%.
Yeah.
Okay.
So that is...
Would stabilized disposition be a refinance?
It could be. It could be a refinance based on a loan amount, or it could be based on the sale price.
Okay. If it's a refinance, does that cash the investor out?
If there is leftover, the first payout would be the first note holder.
Yeah.
Would be our construction loan. And if there's any equity left, it will be distributed proportionally based on how much you put in.
So just because you came in cash investors.
Yeah.
Only.
So just
not to you guys though.
It wouldn't be like first in, first out.
Yeah.
But let's say hypothetically, it was like 100,000 left, then every investor would get prorated based on the equity they own. So it's fair if there was equity left on the refinance.
Okay, so you're in this cash partner structure, like in an LLC. This is not a fund.
No.
It's like a one deal. You have a small group of people. You guys have management, day-to-day authority, but there's some voting rights in there, a little bit, and protections. Okay, so when that, let's say it's a refi, and you say everybody's getting paid out based on the percentage of ownership, that's the cash investors, or is that you guys too?
Cash investors first, we're always last.
Okay, so this is one thing, like in the cash partnerships that sometimes people gloss over, is when we're doing distributions, and let's just keep it simple. I'm cash investor putting in 50, cash partner, let's say I'm putting 50%, so I'm putting my cash in to get 50% ownership, and you're 50%. We're like, all right, well, my 500,000 is still in the project and we're going to start distributing cash. Well, there's 10,000 to go. Do you get 5,000? I get 5,000, or I get the first 10,000 until all my cash is paid back, and then we start splitting.
So in the event, we don't have a waterfall split or anything like that. It's straight down the middle, 50-50. So if there was distribution of $10,000, we would split that 50-50. In the event we did refi, and let's say the investors were made whole, then we would change the distribution to 70-30 while the investors retain the 50-50 equity. Because at that point, your liability went down because we made you whole.
Is that how it's built in the agreement, like an operating agreement?
In our agreement, in operating agreements, that's all laid out. Yes.
Okay. And there's different ways to do it. Some, like, even just a basic fund will do it that way. That it's like, well, it's 80-20 on the cash flow. When the asset sells, the cash gets paid back first, and then we split the proceeds after that. Like you get your money back, and then we're splitting profits off of disposition. And so
this is a little bit more of an easier structure, because I'm also a fund manager in 3 506Bs. And yes, we do have waterfall methods, 8% pref, et cetera, but there's only going to be 4 to 5 investors at the most. And speaking to our SEC attorneys, if they own 10% equity, then they're a member. So we do kind of, tattle on that gray area of, SEC rules. So if this was a bigger raise, like a couple million, 2, 3, 4 million, for sure we would go to the whole fund model. Yeah. But the cost of doing business for a PPM is like 14, 15,000.
Yeah, you wouldn't do it on this deal. I was just trying to get at it's time to distribute cash. When are we splitting that versus when is the cash investor getting their original cash paid back?
Yeah. So in the refi, if there was any proceeds left, then that equity would be distributed to the investors, step one.
And that reduces my capital account.
Correct.
Basically, because I had 500 and now you sent me 100K, I'm down to 400.
Correct. And then if any leftover cash flow distribution will be split 50-50, because we're still managing the asset on a day-to-day basis, making sure everything's going good, doing our.
So you guys have the optionality as managers to decide when we're distributing this out, how much is reducing your capital account back down versus how much is a split.
Yes and no, because of the fact that it's an LLC agreement, there are voting rights. You as a member, you have voting rights as well. There are some voting rights because it's an LLC. We do have a little bit of superseding control in terms of the management, but hypothetically, like this wouldn't happen. But if we were to be negligent, you, the investor, could vote me out and take over the whole asset.
Yeah.
So it's set up that way from our attorney. So people,
which is smart. That's good legal advice. You have good legal advice there.
No, that's not legal. That's not legal advice. I'm just telling you.
I think you received good legal advice.
Yes, I did.
Okay, yeah.
Just want to be clear, putting me on the spot.
I'll throw some holy water on it or something for you.
I'm gonna start meditating here. But just going back to the management fees, because people are like, well, that's a lot of money that's going to go in your pocket. But really, that's operational costs.
First and foremost, that Matt is not criticizing that at all.
I just wanted to know what it is.
He wants to know what it is. And secondly, I love when people charge these fees because I want to know you're incentivized heavily. I want to make sure you're making money, so we go do a bunch of projects together.
I'll just add to that. I've been in some situations where my partners didn't perform because they had to go chase after a paycheck. I had this situation. So now we have these overheads. So we're working towards something. That doesn't get released right away. That's a quarterly thing based on milestones too. There's checks and balances. So it motivates us as human to get money. right?
Right.
And it helps us pay overhead, OpEx, employees, et cetera, softwares and stuff.
Yeah. And it's in the financial, it's in your pro forma.
Absolutely.
You've accounted for it, so I can know you're getting paid that, and then I'm still getting this great return.
That's correct.
Okay.
What happens if you blow up your contingencies?
We have in the hard cost of $1,050,000 and the soft cost of 200,000, we have about like 10% contingency. But just to go back, these are like definitive numbers from my past projects that I have. So they're all historical numbers. We already have hard bids already completed, or hard bids now that are in construction phase. So if I were to use that contingencies, if it was to go over, I think that would be internal discussions with the general partners, because the last thing I want to do is do a capital call and ruin my reputation with my investors.
But the answer is it would be a capital call.
Technically, it would.
Okay.
Technically, it would.
No problem. People just need to know that, and that's fine. That's fine. I've been capital called before, and I get it. So,
yeah. But in that scenario,
Something in the horizon is that you're going to have a lot of demand in that LA area for
Mhm.
supplies and materials.
Yeah, I was thinking.
I'll drive your lumber from Arizona. I'll just drive it over.
All right, we got that.
We'll take care.
We got that figured out. Okay, see, Subto. See, look at that. Let's go.
I think unfortunately, it's something that is in the horizon.
Yeah,
right.
Yeah. We're in a very great spot for this project now because we've already submitted plans to the city. We already got a review and corrections, so we're like going to get RTI in the next March.
Yeah.
And we're already getting multiple bids for foundation, structure, and lumber. And I'm going to go back and lock those in. So they're locked in on those numbers. So really good point.
The other thing about the construction costs on the fire stuff, guys, no offense to people in California, but California sucks, okay? And they don't allow for permits quickly. And so what's going to happen is there's a lot of people dealing with the Palisades fire that are not going to be able to build for 2, 3, maybe even upwards of 5 years, a home that gets burned today. So I feel bad for them, but nobody's getting a permit in the next 12 to 24 months. Impossible. Impossible for them to even get one in 24 months, probably. And when that happens, look at the hurricanes that happened in Houston. What was funny is Houston's price per square foot actually went down when they had the hurricane and all the floods. Why? Because my price per square foot went up in Arizona. Why? Because our contractors left Arizona to go to Houston because there's more stable work. So it's the same thing this last summer. My Arizona contractors, they can't find as much work. They go to where the work is. They're not charging more money. They're just going to where there's more stable work. So in the Palisades situation, in 2 years when permits start getting deployed, it's not like the whole neighborhood of the Pacific Palisades are getting permits at the same time. There will be an influx of workers that come from other states to come and chase down work. It'll happen. It happens in every situation. So will the prices go up? Yeah, but your contractors that are building this type of home are not going to be hired for the Pacific Palisades homes. It's a different builder, right? They're building apartment style units versus the Pacific Palisades are like $3 to $5 million single family homes that are customized with marble and all sorts of. It's a completely different builder quality. It's not even the same person. One thing we make the mistake of a lot of times, if you're not in the construction world, the same person that built Matt's house did not build my house. You have a different builder in Paradise Valley, right? He would never come over to Mesa. They just wouldn't. And they get known. They get known in that area, and everybody knows that contractor, and they hire them over and over and over. Your contractor who you have a relationship with cannot be overstated how important that is. Right? You have a relationship with like Chava, my contractor here. I don't even tell him to bid the project. I go, my budget's 60 grand. Can you do it for 60 grand? Yeah, I can do it for 60 grand. Great. And he does it for 60 grand. Is that something everybody can do? No. Somebody with credibility and a track history can do that. So it's good that you're locking these things in, but people that are looking at deals like this, their prices of construction won't go up for 24 months. They just won't.
Can I talk to one other concern? Okay. All right. I love that you guys, when you have skin in the game. Do you guys have cash in there? I know your butt's on the line for that loan, but do you have cash in?
I think as of now,
it's okay.
Top of my head, we have maybe like 20,000.
Okay, cool.
At the moment.
All right. So if I'm just lawyer Matt here for a second, I'm like, okay, where are the incentives here? And so, because when it's on one of the incentives, then I'm trying to protect that from the legal standpoint. If I'm drafting this operating agreement and trying to think of the incentives. The twisted way for you guys could be, all right, let's run this project. We're going to get our management fees, get our management costs. Are you guys connected to the GC? Is it your GC license or is it, okay, and let's run up the cost as much as we can. And so we can sell this up to the loan amount because we don't want our butts on the line with the bank. But these cash investors, there could be possibly a very skinny profit left for the investors.
I haven't even thought about that, but I'll answer that question.
Yeah,
Wow.
and that could be unintentional too.
Sure.
That could just be the deal goes that way for whatever reason or problem or difficulty or issue that arises that was unforeseen. And so I'm down here with a projected return that just turned into, and I thought, these guys, I thought they had skin in the game. Well, not on my cash, they didn't.
I could, speaking on behalf, we're looking for the long game. If I was to do that and the margins are thin, like, oh, hey, it was, this happened. I don't think you're going to want to invest with me again in the future, right? Over time. Maybe I might get away with it once or twice hypothetically, but that's not a long-term game. And I'm not in the business here to plant seeds just to keep planting seeds. I want them to grow into trees.
You have a 6% management fee of the construction of the deal. Is that above and beyond what the GC charges?
What's on our pro forma. So I can't go and just charge more management fees just because the budget went up.
Okay, so as the contractors are getting paid and their draws coming from the loan or wherever the draws are coming from on the contractor, are you showing disclosure of here's the receipt, here's the thing, here's the paperwork? We're not upcharging these types of things?
Everything's open because you're on the LLC. I have to disclose, right? If anybody requests for that. We also have a monthly update call with our partners going over what we did and what's the next steps. Every quarter, we go over the budget line by line. So here's the actual, here's the current. So we have a spreadsheet that does all that. Really cool.
I like that.
Yeah. So it's very transparent. If there was any bad news, we're going to deal with it, right? Bad news up front is always good news because we could have options and mitigate.
But can you protect me then in the agreement, let's say, or an investor? I know you've already got some money raised on this, but to say, hey, if we can't operate this to where we're thinking, you'll at least get this return.
Yeah, I think what we're showing here is what we're very confident that we'll deliver at the end of the project. So where did it go? Yeah, this is what we're projecting that the project will return. This is like the middle threshold. I think with the budget that you're referring to, we want to perform so well that we're considering to be the GC to use our trusted subs. And that's more of a management question down the road. When we get to that point, the RTIs are ready. Okay, do we want to self-perform, save that money for the whole project that wins for everyone? Yeah. Or do we, or that are one GC freed up right now? So perfect, let's get them going. So I can't give you a straight answer right now, but we do have plan A and plan B. Right now, IO and I are leveling out bids for foundation and framing as just a plan B, just in case. So we already got like multiple bids on that right now. And if needed, then I will pull the permit under my license. Yeah.
This might be the first LA thing I invest in.
It's an option. And then I like to have options because things always happen. So options are very important.
Do you have other projects coming down the pipe after this one?
For like to partner? Yeah, we do. Io, you want to answer that one?
Yeah.
Since I've been talking.
Yeah, we're looking at actually a value add play in Brentwood. And we're pivoting so that more of our portfolio reflects the affordable housing option for folks, housing recipients and voucher recipients, really kind of tailoring to VAs, senior folks, youth transitioning out of foster, and single parents. So we've got we're building relationships with those operators now. We have a deal in, and we just submitted on that we've already got funded for. So that's just one of many. We're also working with the mayor's office on housing to provide kind of more modular housing at scale. We're partnering with several owners with that and those are going to get into more 30-unit developments
All right, cool. Love that. Put your contact information up there. We might have a couple more things to, Eric, switch it over to them so people can pull them up and invest. Thank you, Eric. Man, you've gotten good at that deck today. Have you figured out the picture-in-picture thing? Like the little hacks? Somebody needs to teach me that, bro. Come on. Okay. Any questions, any comments from the audience? We haven't really opened that up much today. Well, you're always welcome to grab the microphone. This is great. You guys did a great job. And I just want to say, Andy, what a great feeling it is to have a partner like you, that if I run in a bullshit situation, like fires and lack of flights, I can't get out of town. Oh man, heaven forbid my wife have a baby. It's nice to be able to rely on somebody that can show up in person. And Io, great job on the presentation. Awesome stuff.
Thank you. That means a lot. Thank you a lot. Yeah.
Thank you so much. It's a pleasure to be here.
I just want to just kind of close out one thing that thank you for providing the flexibility given the situation of everything that's going on. We're calling Io's baby the dragon girl because we think the fires had something to do with it, right? But we'll only know in the future. But again, just thanks for the space, guys. And I just want to say, like, me alone could only go so far, so much, right? I, as a developer, I'm limited, right? Io as a builder, et cetera. Pace, you as a community leader, Matt as a CPA attorney, we're limited. For me to learn what you're going to do, it'd probably take me 5 to 10 years of brain damage. And I don't know if I want to do that right now, right? I think it's really important to know who to work with, subject experts. And what I'm hoping that we can kind of do together collectively is like fix the housing issue, which is like stagnant permits and slow building costs and all this red tape. So I just want to thank you guys for this space, and I hope we can do something great in this community.
Really cool, man. Yeah. Really, really good job, guys. Thank you so much. Boom.
Right. Thanks, Andy. Thanks, Io.
Thank you.
Do you want to be known as a CPA?
No, but everybody throws that to me,
We're talking about how
Not a CPA,
you guys were all
Yeah, this was a really good deck. Hey, we should take all the Owners Club's decks that have been prepared and share them in all the communities just so people can get the value.
Yeah.
Right. R&D, as Ingrid says, rip off and duplicate. But also there's a lot of people who probably want to see these to invest in these deals.
Yeah, I'd say the last two were the ones you could run the numbers quick and validate them. On that last one, I could run their equity multiple and their IRR really fast to be like, okay, those tie out. That made sense. They're right next to each other. And one thing they did is they did it for the project and the investor,
right?
Which I really liked because I think that was what got screwed up on the first one.
Yeah,
was it that the numbers were versus investor versus project?
Nathan, will you grab me? What do we have in the fridge right there? Can you grab me something, a Gatorade or, yeah, sure. I'll take that. Whatever. Okay, cool. Yeah, that buys cool.
I know there's people on here that want to invest in deals, and we're trying to, if I can just say this disclaimer, we popped the disclaimer up before again, that, we're not endorsing any investment or anything or opportunity or any person presenting. So make sure you're conducting your due diligence on them. And we just want to have a real live environment to talk about real deals and real situations and how to think about them, how to present them, how to approach it as an investor. So please, everybody, just take that into account as you're viewing this today.
Matt's worried that these deals are too good. Okay. And he is right. It is not normal. It's just that we have a really high level group here. And Birdie and Luz, who really set the organization up, they were looking for more bad deals. It's just these are high level groups that have a lot of experience from previous situations. So these having 5 out of 5 bangers is not normal. And also we didn't actually underwrite a single deal. All of the numbers could have been completely fake.
Yeah, we got to validate everything that we just talked about in diligence.
Yes, we haven't looked at this. Matt and I haven't looked at this. We're looking surface level. If you're interested in these deals, you need to dig deeper, spend some time on the phone, Zoom, verify, look at all the numbers, make sure everything was not Photoshopped.
You wanted bad deals, but this is just a testament.
We need you to have a mic. Do we have a mic anywhere that we can give to Luz real fast?
I do have a big
I was just going to say that you wanted some bad deals in there. The problem is that this is just a testament to how well you prepare the community.
Yeah.
Thank you.
It really is.
Yeah.
You know, it's them doing deals within the community, learning how to structure everything, and they're doing the thing. So,
Hey, as a reminder, one of the biggest compliments I've gotten of the year was the Matt Sorensen Zooms we did for Zero Down. Who's watched those trainings? Holy crap, dude! People are buying businesses. I'm on a
I love that.
I'm on a Zoom on Monday with Mark.
Okay.
Because somebody watched our Zooms that we did last year, watched them, took action, came back to me and go, I'm ready to buy a business. I just got this deal under contract, $4 million. And she's like, what do I do? I go hire Matt's law firm to put it all together. So it's really fun to be able to have friends like this. Like, doesn't everybody wish they had friends like Matt Sorensen? Even though his aunt is my HOA president, and she sent me a text this week telling me how upset the neighborhood is at me. I was hoping Matt could come over here and maybe talk to her this week.
Well, I said when I can, you know, I got you. I said, hey, when I come over, I can just park at my aunt's house. I'll walk over. I won't get parked in the street.
Oh my gosh. This is so good. I wish we could do this literally every day. And what I would do is I'd be sitting here like a private equity firm. I'd be raising tons of money and just deploying capital into people's deals. This is so fun.
Exactly. Why would you want to golf today? I mean, I like to golf. Don't get me wrong, but I really like doing this.
I'd rather do this.
I really like talking about deals. What's that?
Oh, Birdie sold her husband's clubs because she's like, she walks in, she sees that he hadn't used his clubs in 6 months. She goes, he's not using these. And she went and sold this dude's clubs.
It's being resourceful, you know? What do you do? Oh, just put this money to work.
Did you 1031 exchange the money? Sam, who do we got next? Who's our final culprit?
Our final presenter today is Casey Gregerson.
Oh, Casey Gregerson. He's a badass. We appreciate him a lot. Casey, come on down. Casey Gregerson, you have the floor, my guy. Now, you are the last person of the evening. Have you learned anything from the previous contestant?
Absolutely. There's many advantages going last. So, yeah.
All right, let's, Casey, you got the floor, my brother.
Absolutely. Well, start off with gratitude to both of you guys. I mean, going back to I've worked with other people in self-directed IRAs, and I remember listening to your Zooms years ago, Pace, and talking about like what a powerful audience it was to do deals with, right? But like, how do you get in front of them? So I just wanted to thank you guys for providing this opportunity. It's a dream come true, and just kind of hairs on standing up on my arms for this opportunity. So thank you guys so much for that.
Of course.
Yeah.
You bet. Okay. So kind of go into my story, my journey, right? So you guys see the first logo here, that's for Shell. So I started working with Shell back in 2011, all right? So I always, this is kind of a funny joke, right? But I would say 3 months ago, there was probably not too many people who understand what it looks like to work in oil and gas, right? But now, if you guys have seen Landman, you know,
that thing is blown up.
That is, and guys, it's crazy. That is picture that. That was what I lived for like 12 years, literally in West Texas. That's where I was working. It is crazy how factual it is. So if you guys have seen that, you could probably, what I'm about to tell you probably won't shock you, but working out there was a lot of things I love, but I started to ask myself this question. And the question was, but what if I didn't have to be out here in the field for 2 weeks away from my family? What if I didn't have to be out here on a dangerous rig or flying on a helicopter out to a platform? What if I didn't have to be in this volatile industry that was laying people off like year over year over year? So as I asked myself that question, it's really one of the catalysts to becoming an entrepreneur. One of the first things I did was I opened a Pure Barre franchise. So if you guys know what Pure Barre is, it's a women's fitness, it's a boutique fitness studio. So at one point, we actually had 7 of those spanning from Midland out to Houston, all the way to San Diego, California, believe it or not. So that was a great business. It taught me a ton about how to run a business, how to be a leader, how to do, and one of the biggest ones was marketing and sales and marketing, right? As surprising or not, as an engineer, we didn't learn a whole lot about sales and marketing, right? But I learned it through running that business. And I really parlayed that into real estate because while I love that business, it wasn't my true passion. What I found was my true passion was real estate. So back in this 2011, it was actually 2010, I bought my first rental property up in Laramie, Wyoming. So I grew up in Wyoming, went to school there, and I bought my first property. My dad actually helped co-sign on the first house. It's a really neat story, right? So I was house hacking back in 2010, right? People are still doing it today. But that was the first property. And one of the advantages, though, that oil and gas gave me is when I worked that 2-week on, 2-week off schedule, that allowed me 2 weeks to go. I didn't have to open my work phone or open my work computer. I could actually go start investing in real estate. So I started fixing and flipping, buying rental properties, and really starting to grow a portfolio. And what I found as I started to become part of, like I started surrounding myself in other masterminds and getting around communities like this. And what I realized was in Wyoming, I had this really unique niche, right? Everybody raise their hands if you guys knew somebody that invested in Wyoming before today. Anybody?
None. Nobody does.
Yeah, not many people, right? Little competition, but there's still a lot of demand. A lot of people are moving there and still want to live there. And case in point, 4 or 5 years ago, before I started my wholesale company, there were no wholesalers, right? I would have loved to start buying from a wholesaler, but there was none. So we started and went and built out my wholesale company, which is today is WYO Houses. So now that helps bring in all the lead flow to us, right? So I got to look at all the deals first and figure out, hey, what is the best way that we can monetize this new lead? Okay. So the other part is, I'm sure Pace will appreciate, we talked about earlier, is construction, right? So as I started to scale and do more deals, managing general contractors, that was a huge bottleneck. So what I did early on, as soon as I had enough flips going and enough rental properties to manage, I went and hired somebody internally that could manage all my stuff. And in Wyoming, it is like contractors are challenging anywhere. But in Wyoming especially, there's not as many of them. That actually creates a lot of demand in Wyoming because they're not building enough properties to keep up with demand, right? So what I had to do is I had to go recruit these guys. So today, as I show here on the slide, I have 4 different crews, and I don't think my other slide, yeah, I had a slide showing them, but I don't have it here, but I'll go back. But I have 4 different crews today that are working across Wyoming. Some of them are actually helping me out in Montana as well. But this is now my Revive construction company, and it's when I work with, or when I think about my business and when I think about working with other investors, this is one of the biggest game changers because, it gives me predictability, not only when it comes to budgeting and hitting time, but it's hitting timelines, right? Time is money when you're fixing and flipping. And when you're working with a GC, he's got 5 other jobs, right? But when I have my own in-house guys, I can decide, all right, this one needs to get done now because we need to hit the market. It's July and we need to get on the market because if we don't hit the market now, come August, September, this thing is going to be sitting. So having that control was big for me. Now, the third part of our vertical integration that I built was property management. Okay, so that first house I told you guys back in 2011, I was up in, I was a property manager, right? I was house hacking, and I still own that property today, and I own 250 other doors. But these properties, guys, I'm still managing them today. But is it me managing it? No. Now I've been able to build out a team of virtual assistants. It's really cool, actually. They're worldwide from the Philippines to Mexico. They manage all 250 units, like literally everything other than the boots on the ground, like repairs of the properties. They actually, all those, so I mentioned I have these 4 teams now of contractors. They're the ones, if we need somebody to go out and look at a property, they're the ones that go out. And I didn't even mention this yet. I live in Houston, Texas, right? And I invest all over Wyoming, and now we do the surrounding states. But I do that because of the competition level, right? So building out this vertically integrated company took me about 6 to 7 years. And as I built it, I really enjoyed that. But what I really found about myself, as I kind of reflected, was I really enjoyed helping people. Right? I wanted to help more people get into real estate. And that's one of the things I'm most thankful that Pace gave me an opportunity to do was lead problems to profits. So I approached Pace about a year ago on this to do this Zoom. And we went back and forth, and he kind of had some really good ideas and helped guide me. And we started it. And this has been such a cool experience. Every Friday we meet, and it's supposed to be 2 hours. Sometimes we're going 4 to 5 hours long because these students are bringing deals and we're calling people live, and they're bringing these problems, right? And we're turning them into profits. So as I showed you guys on the bottom of the screen too, my goal this year is to do 100 deals. So, and I want to hear some shout outs if there's any Subto students that do problems to profits in the chat. I want to hear from you guys, but I've told these guys that my goal is to do 100 deals this year. 50 of those are going to come from my WYO Houses company. And then I want 50 of them to come from students, actually doing deals with students. So it's really exciting.
Oh yeah. You got a bunch of people in here saying, hey, Casey, you're the bomb.
Awesome. Yeah, I figured that. I love it, man. You've created this awesome community, and it's so much energy working with those people.
It's the best. It's honestly, the secret hack was attracting awesome leaders like you that we all span over the whole country, and we lead this the whole industry. It's awesome.
Absolutely. So that's the first group I love helping. The second group is people that were the people that I worked with, right? And they're people I think that are listening today with self-directed RA. People that they don't necessarily want to go build a vertically integrated company, right? Not many people want to go cold call. Not many people want to run a sales company. I mean, we're spending $40,000 a month in marketing to get leads. Not many people want to do that, right? And they definitely don't want to go manage contractors, right? It's plenty of headaches. Like, leave that to us, okay? And the third thing is property management. And it's been crazy after working with a lot of investors, how many people, like, it is insane to me how many people won't get started in real estate just because they're like, I don't want to be a landlord. I don't want to manage tenants, right? But now, because we've created these vertically integrated companies and birthed my fund, Bighorn Capital Fund, now we can give our investors the opportunities that I have now with a vertically integrated company. So you guys can tell I'm excited about it, but it's man, it really gets me going. So before, okay, so I want to go in, before I go into the pitch, I want to go just a little bit deeper into like how many people I wanted to help. So my goal, my Mount Everest goal, is to help 100 families achieve their financial freedom. All right, so why is this so passionate to me? I want to share my story, but I want to give you guys, go back to the question that I asked you earlier. Right, I asked myself the question when I was working in the field in oil and gas. I said, but what if I didn't have to be out here for 2 weeks and be away from my family? And I want you guys to ask, but because I think a lot of you guys are probably in this situation, but what if I didn't have to choose work or my business or my W-2 job or whatever? What if I didn't have to choose that before my family, right? That's why financial freedom is so powerful. And to share just a quick 30-second story of how I left my W-2 job 2 years ago, because it was the best gig ever. I was making $200,000 a year for Shell. I was working 21 straight days in the office. Like, I'm not in the field anymore. I'm like in the office, 5 minutes away from my family and kids every day, right? So I go for 21 days straight. And then I have 21 days off. So I'm working half the year. I'm getting
crap.
Best of both worlds, right?
That's amazing.
Yeah. But here's what
Are they hiring?
That's right. I know. I still kick myself. So, but here's the reason why, guys. I was working a 2 p.m. to 2 a.m. shift, right? And I was missing all of the most important stuff with my young kids. I've got 4 boys now, and one of my biggest passions is coaching them and being there for them. And I was missing all those games. And I'll never forget the conversation with my wife. I'm getting the chills right now. Is like, I'm not going to miss these. I'm not going to go back and look at my deathbed and be like, oh man, I'm glad I stayed those extra 2 years for Shell and missed all those games, right? It was super passionate for me. So I share the story with you guys because I had financial freedom. I was able to make that choice, and that's why I want to help 100 people be able to be in that same position. All right, guys, let's get into the actual offering today. So I went back and forth before I share the offering. I went back and forth between equity and debt because I actually have a customizable fund that allows me to do both. But what I finally settled on after much deliberation, going back and forth literally for about the last 2 weeks, Birdie knows, Birdie and me, we're bouncing back and forth. But what it came down to is what is simplest and easiest to understand. And really, when I'm working with these 100 different investors or people that want to achieve their passive income goal, one of the easiest way for them to get started, and this is especially if somebody's brand new to real estate, or maybe they just don't know me and they're getting to know me first, it's hard to go in and do a long-term equity deal, right? And it's you can do it, but you got to have some experience and you want to know your operator. So what has worked really well for me is getting those people and doing debt deals, because a lot of those people down the road, they end up doing equity deals first. So that's the one I wanted to share with you guys today and kind of roll through this, okay? So I want to keep a super simple offering and make it flexible. So what we do is we're paying 12% as a continuous offering debt fund. And it's a 25K minimum. Again, I wanted to make it low because there's just, I'm sure you've seen it too, Matt. There's a lot of people that when they get in where they want to dip their toe in of maybe 25K, but they've got a lot more capital, right? But they want to get to know you and see that you perform, right? So that's why I kept my minimum low and we made it flexible. So my fund, you got to commit to at least 6 months, but after that, you could actually make a request to withdraw within 90 days to give them flexibility. Because I also find, and again, came from years of raising capital, asking somebody to go commit for 5 years and commit their funds. There's a lot of people who love it, but there's also some people that are like, hey, can we just do something a little shorter term, or at least have that optionality, right? So that's why I created this fund, to have flexibility. We also do quarterly distributions. And then timing. I've already got some soft commitments already now in Q1, and we're going to be launching this in Q1. And what's it for, right? So before we go to our case studies, why do I need this capital? Why did I design it? So I shared with you guys my goal to do 100 deals this year. So to do 100 deals, that's 100 different potential private money lenders or hard money lenders or different banks, right? We do a ton of creative deals. We do a lot of Subto flips, right? But I wanted to figure out a more streamlined way to do this, right? And that's why I created this fund to where now we can bring in multiple deals and actually cross-collateralize them and do multiple deals at a time. The other kicker was I've worked with banks and I've worked with private money lenders and hard money lenders and created a lot of relationships. But back to the goal of helping 100 people, if I can be giving those people 12% versus giving it to some hard money lender, right? Or some shark of a hard money. If you guys have worked with some hard money lenders, they're tough. There's some good ones and not so good ones, right? But I would rather give that to people that I'm actually helping my passion of helping 100 people. So that's why I thought it was a true win-win to be able to bring people in that could invest, and I could start to cut out some of these hard money lenders and ultimately hit my goal of doing 100 deals this year. So with that, I want to go to you guys, the case studies. I'm not going to go too deep here. I actually shared a QR code. So anybody who's watching right now, if you guys go to that QR code, it's going to take you to our website, right? And when you go to the website, you can actually go see our track record. And this is one of the favorite things I like to share with our new investors, right? I'll click on it now so you guys can see it. But what I did after feedback from raising capital from people way smarter than me that had way more years of experience doing funds was he basically said, Casey, if you can't go and show me settlement statements, photos, like when they bought it, if you can't show me all that stuff, then it really didn't happen, right? So I built out this Google sheet that I share with all our investors. There's 120 different deals that we've done. We talk about their settlement statements. There's all that in there. I talk about how much the investor put in, what was their return, and all that. So that's a really good resource for you guys to go check out. I'm definitely not going through 120 right now, but it's a resource you guys have. And if I go back to my case studies, I've got a couple other ones. These are other ones I've done in my fund. One's a debt, one's an equity. And the reason I'm putting them out there, and we can dive into them if you guys would like, but I wanted to put them out there because at the end of the day, I want to just connect with more people who are, like I said, I want to help 100 people achieve their passive income goal. I want to start that conversation. And if that starts out by investing in our debt fund, great. But a lot of the people, they want to go and look at an equity deal. And if you guys want to look at that together, I'd love to. So with that, I'll open it up to questions.
That's phenomenal, by the way, the case studies. What a great hack that very few people actually do. It just shows that you care about your track history. It also shows that you're an engineer because, you know, it's so, I mean, bro, that's so good. And that you have addresses, settlement statements, legal docs. Here's the thing. Here's what the investor got. That kills so many questions. Kills so many.
Absolutely.
Yeah, it does track to those verifiable documents, that thing, so I can click that and view a doc.
Bingo. Go right to the settlement statement. It's like a vault. And I'm a spreadsheet guy.
And that was with the Bison deal. Last name is Bison, but it's called Bison.
Yeah, because people can't pronounce, even if
and I saw the animal.
Yeah.
A bison.
Yeah, it's because everybody calls the Bison family the Bison family.
Yeah.
So they just decided, let's just lean into it.
I get it. Okay. So I just want to make sure I wasn't, getting it wrong, guys. But yeah, but the Bison, right? They have like a data room basically, or where all the diligence stuff is as you log in. You've got to fund in a different way, but it's going to source this because that's so big. And that's what a big institutional fund does. If you're a big person, if you're a big boy raising big dollars and you're trying to go to uber wealthy people to go get it, they expect to have this data room. They expect to diligence it.
Yeah, they want to send it to somebody to say, go through all this kind of stuff.
Yeah, go find the settlement statement.
Here's all of our stuff we've used to base this on. Our track history, our methodology we used, our assumptions we made, validate who we are even. Like it's all in there. And I think for the investor side, anyone doing that, that's a lot of people are like, well, how do I do due diligence on someone? Well, ask them for this. They should have this in a fund structure. Now, maybe I get the cash partner deal, I'm not going to expect this. Or even a private lender deal, I might not expect it. Somebody still wants some track history, but where you've packaged it altogether for investor to oversee, to look at is freaking awesome. I love it.
Yeah, just real quick. Some people have the same question I had in the beginning. I now figured it out, but they're saying, are you investing in fix and flips?
Yes, great question. Both, right? So with this fund and with this debt, it's primarily going to be fix and flip, but I could also go, I mean, I find numbers, I wanted to share this rule of thumb for people, because trying to figure out like what's a good deal, what's not. It's called the 1% rule. Like if the monthly rent divided by the total purchase price is 1%, it's typically going to be a good cash flowing deal, right? And nowadays you really can't find those, right?
They're hard to find.
They're hard to find, right? But we still, because again, Wyoming prices are a little bit lower, but there's still strong rents, we're able to still find deals like that. So the reason I share that is we can actually still make a deal pencil paying 12% on the back end. And that's how, and because
to hold.
Yeah, exactly. To hold, right? So say because the reason I wanted to have it be continuous and have multiple deals is I've been doing this for years, right? And I've thought about the timing of like, okay, say you finish a flip, now you got to put that money back to work. But what I found is when I'm working with my private money lenders is we're almost always putting them immediately into another deal, right? To where we're trying to, I mean, it's a little bit of a puzzle piece, but we wanted to put them immediately into a deal. And I've just moved other properties where, okay, I've got good equity, for example, like Pay said earlier, like on my house, it's gone up in value. And I've got a couple actually properties where I'm doing medium-term rentals and they perform really well and have really good equity. So quick numbers, house, I owe $500K, house is worth about $1 million now. But the thing's cash flowing, or it's making about $7,000-8,000 a month as a medium-term rental, right? But I've got a 2.75% loan, so I'm not refinancing to get that equity out.
No.
So what I do is I'll go put somebody in second position, and I'll go up to maybe 70 or 75%, but it still services. Right. And the reason I'm sharing that is we'll do that same model within this fund. If it'll still pencil as a buy and hold, then we can move it in.
Okay, and this is for accredited investors only?
Yes, good point. I did not cover that. It was on the slide, but I didn't say that out loud. Yep.
Okay.
Let me ask this. So there's the debt fund, and this is a separate fund from the equity fund. That's another pooled vehicle type thing. So you got the debt fund. If I go into it, let's say, and I want to do $100,000 into it, I'm getting a 12% annual rate of return.
Yep.
Now, the fund is paying me that 12%. You take that debt fund and lend it to your other entity that owns the property.
Correct.
Who enters into a note and a deed of trust. The debt fund puts the mortgage or deed of trust against your other entity that owns the property and doing the flip. Is that how it's going?
Exactly.
Okay. All right. Okay. This is good. And so now you are the borrower. So there's a conflict of interest here a little bit.
Absolutely.
Okay. So how have you thought through that? And this is common. So this is like there is an inherent conflict of interest though.
Yeah, absolutely. Yeah, because I'm the manager of my LLC that's doing the fix and flip. Right. I'm also the manager. On the flips, and I'm also the manager of the fund. Right.
Right.
So that's where it comes down to the underwriting and them seeing how we're doing it and them counting on. And again, that's why it's a fund and there's trust in my track record that I'm going to do the right thing.
Yeah.
And I'm incentivized to do. I mean, there's obviously no incentive for me to go and default, right? And it's really based on the underwriting. So I have my PPM, right, like any other fund, but with my customizable fund, we have deal disclosures on the deal level, right? So for example, this Lilac Way was a deal we did in the fund, and it has its own deal disclosure. It was also secured with the deed of trust, right? But this one it'll have multiple deeds and cross collateralized, right? But in my deal disclosure, I outline what are we buying, right? We only, for example, lend up to 75% of ARV, right? And it's really, we're treating it like a hard money lender, right?
Yeah.
Would.
Yeah. And so what would happen like in this scenario where you have to go short, like a deal goes, the amount that the fund has lent to your operating entity that owns that property is the debt is more than what you can sell it for. You're upside down, basically.
Yeah, exactly.
Do you still, does your operating company still owe on that, I presume, and would still be responsible for they lose the security, maybe, but did they sell it short? I don't know if that's addressed in the docs or.
Yeah. So maybe to explain it.
Always worst case scenario.
Absolutely.
Guys. Okay.
Yeah,
So
absolutely.
If it's making money, nobody cares about this stuff.
Yeah. And I compare it to doing just like one deal. And there's a lot of people I work with, Matt, right, that they just want to be one deal because if it goes sideways, they want to be the one stepping in and being able to save it.
Yeah.
Right?
But onto that, and it's because I like what you're doing. Don't get me wrong. And so please, everybody know this is like lawyer math, and I'm like, because on the one hand, and I'm on this side too, when I'm private lending the money at 12% interest, is then you close the deal and you send it back to me and it sits in my account for a month.
Yep.
And I'm like, damn it.
Yes.
I lost a whole month.
Yeah, then you're not really getting
that
12%. Your effective rate of return is like 9.5% because you missed out on 3 months of return or whatever.
But I like that I had control on the deed of trust or mortgage. It made me feel a little more safer.
Yes.
But over here in the debt fund model, where almost all of those have this conflict of interest issue, it's just not how you've structured it. It's just how those are done. The person raising it is lending it to themselves or their friendly entity. Is I am one step removed from the lien, and you're in the middle there. So there can kind of be that conflict. So that's what I'm trying to just get a good feel around, and I think that would, like, if I'm advising a client, and even just for myself, because I'm thinking about your deal and doing it, is feeling good about that.
Yeah, and I think it's the cross collateral, right? Like if you go, because you ultimately, Matt doesn't want to take this property back, right? He mentioned earlier about the return on hustle.
Yeah.
He does not want to take it back.
No.
So, and you do run that risk if if it's a single property, we know, and fixing and flipping is inherently risky, right? So you could play both sides, right? The one side is I could step in, I got more control. On this side where I'm doing it, you can't do that. I think the other counter to that is now we're spreading it across 5, 10 different properties, right? There will be some inevitably probably that don't go as well, and I'm going to have to cover those, right? But I'm also going to have ones that go really well. But at the end of the day, my borrower, the borrower, which would be my LLC, the flipping company, right? I keep all the upside. And the reason why I love, Pace talked about it earlier, right? When you do enough deals and you could borrow in debt, I want to keep the upside on my flips. So there's some flips I'm going to crush and we're going to make 50K. There's some flips, and we've lived it. I could point to some that have still happened in the last couple of years where I broke even or I lost 10K, right? But I'm still paying that 12% no matter what. And then what I'd like to say is, like, because it's cross collateralized, the probability of like all of them going sideways versus a couple, I think it de-risks it.
It's a great point.
Okay.
I have 2 questions. That's okay.
Yeah.
Mike?
Mike, you don't need to ask for permission.
Sorry.
One is, in order to hedge some of that potential downside, are you keeping any reserves should there be a risk of losing? So like, hey, no matter what, we're going to keep 100K set aside to make these 12%,
to make
investors whole, right? Lenders. And then the other is, there's a lot of Casey's in Subto, right? And by the way, you were an engineer, because I just told him that could have said Casey studies, and that would have been better branding. But anyways.
Yes.
Okay. So with so many folks in the community, where you could just be the lender and lose the conflict of lending to yourself. So anyways, those 2 things.
Yes. Okay. So I'm working that into my disclosures to where I can do that, because I also, if I go take in 4 million as our goal, I got to keep it working, right? And that's why I'm excited about Problems to Profits, is like being able to do more deals with other people, because there's so many deals we underwrite where it's a deal, but can we go find somebody at 12%? And I always tell the students on the call, I'm like, not many people can go borrow at 12%, no points, right? You got to have experience. But if I can go create this, and now I can go partner and do more deals with these guys, like, that's my ultimate goal, is to do both, right? But again, the pro and the con. The pro is now it's a different operator, but at least I can underwrite it and look at it. But I think the other benefit of me being the borrower and the fund manager is that we know who we're working with, right? I know my track record. I know. And back to the vertically integrated company, like, I've got way more bonus slides that we won't get to. But like what I think makes us most unique is the vertical integration, because you can lose money. You can buy a bad deal, right? You can have issues with contractors. You can have bad property management, right? But if one of those goes sideways, we've got the other 2 that are still going to be profitable, right? So it allows me to lose, to go miss, hedge. There's the hedge, right? Mm-hmm. And back to your first question, right? So that's the biggest way I'm hedging, is some of these are just going to be good cash flowing rentals, right? That are going to be spitting off cash flow, right? And then, but you're also going to have your fix and flips. One last thing I'll share with you guys, just a lesson learned the hard way, and I think it's worth sharing people that are watching this, or maybe have a self-directed IRA. If you're looking at a deal, you've always got to have 2 exits. And ask me how I know. I've lived it, and it's not fun, right? If you're flipping a house and your only exit is to flip that thing, I was doing this in DFW like 7 years ago, and we were flipping at a high price point. The market turned a little bit on us. We had bad contractors. We were using hard money, and it was not pretty. And the only option was to drop price and just lose it, just take it in the shorts.
Yes, right. The check.
Exactly. So, but now, I learned that lesson the super hard way, to where a lot of these, that's why I love Wyoming, because I could still buy deals where if I get stuck, because that's the other thing too, is if things went completely sideways, it's 2008, like I'm going to hold these things, I'm going to fill them with rentals, and I'm buying them at a good enough price point to where I can still service the debt.
Okay, one last thing then.
Go ahead.
I see a man who's stretched thin in the way that you explain this now, because now you're working all of these verticals. Like, how can we become, and I'm just saying these things not because I believe that, but to making sure that you have the brain capacity and the time capacity to rightfully manage what is going to be a good sized fund against all these projects ongoing. So I guess maybe clarify if you have other folks who are going to kind of help you oversee these elements.
Yes, dang it. I added the new slide last minute, but these guys got it going. I didn't make it on the final cut. I actually was going to share my org chart, but I'll just go back here.
I have on this side.
You do?
Yeah.
Swap it. Sweet. Oh yeah, I'll just show you their org chart, and then and I'll set a cool picture of our construction crew, because those guys.
TV to your left. TV to your left.
Oh, there it is. All right. Perfect. Here it is. Okay. So yeah, I'm glad you asked, Ingrid. So we, early on when I was working in oil and gas, it's me, right? It's me hustling, and it's still me hustling to this day. But at least now I have my COO, which is awesome slide deck. He helped me with. He's actually was my marketing guy too. He was actually my marketing guy. Kind of grew into the COO, because this guy, man, yeah, you guys, I can't say this out too loud, but he is awesome. He's the first guy I've ever seen that cares as much about my business, and I didn't have to go give him a big equity stake.
What's his phone number?
Yeah. Yep, he's good. But anyway, yeah, you're right. His name's right there.
Oh, we're skipping crazy.
Or no, you know what?
Him right now.
Yeah, I did put it. But anyway, so he's the one running it, right? He's actually the project manager. He oversees the 4 contractors, right? Or my 4 foremen. And then property management, they report up through him. We did have a property manager, which we got rid of. So he's helping there, and eventually we'll backfill that. And then sales, I'm still very involved in sales, right? I have a sales manager, and I have VAs, and they're driving the leads, right? And I'm working with the students, and I'm still ultimately love helping close, right? But my goal in Q1, actually, because again, I've been spending a lot of time planning, what are my goals? I want to do 100 deals. And my thought was, I got to make sure I'm there to help close deals, because as you close deals, you really start snowballing, right? Especially as the year goes. So I'm still very involved in helping make sure we're getting deals done, right? But then, yeah, I've created these 3 verticals and people managing it. So my ultimate goal is I've got a sales director, and I've got my project manager, and I've got my property manager, and I could be a true CEO, right? I would love to, as you can see, I love speaking, I love helping people, and if I could be doing more of that, that's my ultimate dream.
Love it. That's very EOS model right there.
That's right.
I love it. It's great, by the way. Great org chart.
Thank you. That's thanks to COO.
That was a great answer to your question too, huh? He had it in his deck.
I love it. Yeah.
That's right.
Nice deck. Yeah.
And EOS is tough. I read that book years ago, and I tried to apply it immediately. It was when we had the Pure Bar franchises, and I was trying to do it, and it was always, and now I realize looking back, that's not an easy system to do.
It's not.
Yeah.
You guys are probably big enough to do it.
Yeah. You got the vision. There's a lot of versions that came from that traction, scaling up, but they all kind of gone off of this EOS, entrepreneurial operating systems and structures. So, but you've got balance of the visionary, the integration, which I think is the key.
This was really good.
Thanks, man.
Phenomenal.
It was fun giving it. It was fun putting together. And
put your contact info up there, brother.
Yeah. What was this? This is 506C. Accredited investor.
Accredited, yep.
Okay.
Accredited investor. And there's the equity one too. So we just finished one up at the end of last year where we raised about $2 million. Because the other thing I'm loving doing is again, we can find the deal, fix it up, and manage it long term. So what I'm finding is it's fun to bundle I did this at the end of the year, we bundle them up, and it's the appreciation thing, right? Fine. I worked with, they're actually, again, Subto community. These guys were in Gators. They had had a really successful year lending out as Gators and were showing a lot of profits. Well, we partnered together, and I bundled up a big bundle of my properties, moved them into a partnership, and they bought them. They got the depreciation, and I was able to recapture some of my cash out of these deals. So anyway, I'm going to set up another one of those this year, which will be equity and more of a preferred return waterfall split. Cool. Too deep to go right now. But
What if I raised money for you and I had unlimited ability to bring cash to the table? Could I get a better percentage?
yeah, absolutely. And I mean, it really, and this, whether it's Pace or anyone, like that's where like, let's get on the phone and let's talk about, that's where I talk equity deals. So for example, this Hillside one, right? This Hillside was the first really large multifamily deal I did. And I brought in a partner and he co-signed like, it was a big enough loan to where I needed a co-signer based on balance sheet. And again, this is still a couple of years ago as I was growing. But yeah, we did that one 50-50 and it's basically a burst strategy that we're hoping to refinance here in the next couple of months and get our capital back and hold it long-term.
I love it because I have a legal ability to raise basically unlimited non-accredited money. Something I've been working on with my securities attorney. And I'm looking at this and I'm like, oh, this is so, I could raise $4 million for this and put endless amount of people into this deal. But we should have a conversation.
Yeah, absolutely. But that's, I mean, but that's what it comes down to, right? If it's bigger, like I almost had a slide on that. Like if it's bigger amounts, because I was talking to Bo's like, are you ready? If somebody writes you a $4 million check and you have a flexible fund and they request it in 90 days, is that going to work, Casey? I'm like, well, if somebody's going to write me a $4 million check, we're going to talk about structuring a little bit different, right? Yeah, figure out something that's win-win for everybody.
Will you put the contact information as the main slide up there, Eric, real quick? Thank you so much for that. Guys, reach out to Casey Gregerson. He's freaking awesome, a great leader inside of Subto. He's been running a Zoom for, has it been a year?
Yeah, I mean, I reached out about 7 months, like not straight every Friday.
Freaking unbelievable. So good. Great job, man. This is awesome. Thank you so much. Casey Gregerson, everybody. Thank you. For those of you that are going to stick around, well, not stick around, we're going to end the Zoom. But I have another Zoom starting in 25 minutes where I'm calling a seller who's in foreclosure to structure my final negotiation with them. So everybody inside of Subto, the link to that is in the featured section in the Facebook group. And you guys can watch me actually negotiate with that seller. I made the call to the seller originally on Tuesday night, I think it was. And now he's following back up saying, okay, I'm ready to move forward, but we need to work out final details. So that's at 5 o'clock. Man, if I had a twin, I would sit here, I would make him sit here, right here, all day, every day, and just look at deals.
Yeah. No, but have that twin go do the work, and then you,
Pace, okay, there you go.
Be sitting here, you know.
Oh my gosh, man, this is so great. And how lucky are we that we can have such an amazing group of people to present for us and tell the story of where these deals are coming from and how people can actually make money on these types of deals. I think people that have money in their retirement accounts that are busy with their 9-to-5 job and their families are like, oh my gosh, this is where deals come from. It's pretty awesome. Yeah. And we'll send the replay out to thousands of people. What I'd like to do for the replay, if we could, it'd be really great if the replay gets emailed out to everybody and the contact information of all the presenters is in there with their deck. Okay, yeah, that'd be great. Like even, down in the description on YouTube would be great. Get their decks as like PDFs, or not PDFs, but like links to a PDF or whatever. And then we'll send the replay out to everybody in the community that wasn't able to show up today. This is not something you can email to your people as a replay, is it?
I got to think about that.
Because that's like a
I'll just direct them to your way.
Okay. Cool.
And then maybe we'll throw it on my YouTube one time, or we can stream it there too, because we got to do more of this. I think if this was a test run, this was like a concept out of Pace's brain.
Did you like it?
I love this. I was just thinking about it here. Because I'm going to invest in probably half of them. You know, I want to talk about to some of the people here, just myself. And I know there's some people I talked to just yesterday, a few people, Trent and who else we have that were like, and we just couldn't get to like calling people out on here just because we're way behind schedule, as you can see. But I want to figure out how to do this and just help people learn how to do this, because I think this is where it becomes real and tangible. But everyone's also scared about it, including me, because I want to be everybody's got to be a big kid about this and make sure you have the right people presenting, but also I'm not endorsing this, you're not endorsing this, and Attorney Matt just can't get out of he can't get out of his own way.
He has his attorney hat on today.
Yeah, yeah. But
maybe I mean, there's multiple things that get done here. Like, I think Casey did a great job presenting for sure, and so did everybody else along the way. But they obviously got to watch the people before them present the questions that you and I asked to then go, oh dang, let me put that in my thing. Oh dang, I know they're going to ask that. Think about if we did this once a month, not 6 hours, but let's say we did like let's say we did a 2 or 3 hour thing once a month, where I came to your office, you came here, whatever, you came to my Montana home. Wherever we are in the world.
Summer, let's do it.
We do it. I think the in-person is so much better too. Don't you guys agree?
Yeah.
Like having a live audience is so nice, and having them directly in front of you.
There's some great comments out of here too, and questions here, which we couldn't really get online. And your people are smart, by the way.
Yeah, they're cool.
Like everybody presenting, I was just super impressed.
But think about if there was a standardization around the presentation style. Like, hey, this is what your deck should look like, in the steps it should look like. Everybody did a great job, so I'm no judgment. But what if there's just a standard flow? It's story, it's this, it's that. We're not just teaching people about deal structure and how to invest, but also how to present.
Yeah.
Like, this is really cool. It's multifaceted. I had so much fun just chatting with the people while they're presenting and giving a little bit of feedback. And then everybody in the audience is like, oh, cool, I can do this too. Guys, you killed it. Everybody freaking killed it today. Gosh, dang it. Amazing.
And I'm going to tag Jared along in one of the deals, Jared. Yeah. We got to figure out. Okay.
We'll get enough money rolling in so you can afford a haircut. Just kidding. I actually want to grow my hair out like that. Sick.
Fun to have a guest too, somebody new occasionally because you guys have this rhythm with each other and you ask the right questions for you, but like to have someone else even in there that's like America's Got Talent.
We should have somebody that we verify. Maybe it's not one of your clients. Maybe it's just somebody inside the community, so it doesn't look as if you're, promoting them to invest in the deal. But we have somebody that's like, I'm just a buyer or I'm just a private money lender and I have verifiable $200,000 in my pocket. And my intention, not that I'm going to, but my intention is to actually deploy my $200,000 today. So it's like a third person that's not as savvy as myself, definitely not as savvy as Matt.
Yeah.
But like a third person that has a different series of questions.
They're like, they win a seat on a shark seat.
Yeah, like that.
Yeah.
And then they might have their own like quirky thing that they really want to see that you guys wouldn't ask.
Yeah, we need some female energy up here, by the way, right?
Yeah.
No, you don't need my energy.
Yeah.
We love your energy.
You could tailor some of that. Like, so imagine Abraham, for example.
Oh my gosh.
Loves more like those like entertainment sort of restaurants and whatnot. Like maybe have themes within those things so that whatever guest potential investor is oriented, and we wouldn't be throwing them into something they would have no want. Like maybe if it was an oil and gas company and that somebody who doesn't come from that, they're like, well, that was not very useful. Right. So something more structured.
This was fun.
Yeah. It was so fun.
Yeah. What we could do, because I could do it at my next self-directed IRA summit, is if I know what we're doing and I can commit people there, I will say, who will show up? Let's have the date figured out. My next one's in April. And I can get a few people and be like, and you're going to commit to invest X amount of dollars to come here. Because that's what I love that idea. And getting some people because I would like someone investing here on the spot or with an intention to, that's going to ask some of the more intermediate questions too. I want some other expertise of people, but also you saw it at the Alt Asset Summit with some of the people and just the roadblock of I want to do this.
They got millions of dollars. There's people come up to me and go, I have $5 million in my retirement account and I don't know where to deploy the capital.
They just are hung up.
Yeah, or there's like an underwriting question or this. I think making this something we do monthly would be really, really cool.
Once a month, yeah. I was just thinking that once a month would be.
And we'll do it in Matt's house in Paradise Valley.
We could. I built a little studio in there.
All right. We can fit 30 people in there. We got standing room only here. This is amazing.
My studio and my office, we could do.
Yeah, you have a great studio
15,
in your office. We could switch it around. In our big office in Tempe, I can fit 150 people in a live audience situation. So
maybe what we do is maybe the next one we do here. And then we'll do a bigger one, maybe in like March.
All that new equipment, build that studio.
Yeah. Well, once we spend a couple $100,000 in that studio, then we could do it it's right by your house. It's like 10 minutes. You've been to my house.
Thank you.
Yeah, we'll save you some time.
I appreciate that.
You don't want to come back to Mesa. It reminds me of you.
Oh my gosh.
And there's no good food over here.
That is true. You got nothing over here.
It's true. I order freaking
red, white, and brew.
That's pretty far still, dude. When you really think about it, it's pretty far.
That's Mesa.
Mesa's pretty big. Guys, was this like a 10 out of 10 day or what? What would you, everybody in the comments, please give us a rating. What did you guys like? Give us 10s. All right.
All right.
11s.
Oh, okay.
All right. Amazing. All right, guys. Thank you so much. I'm going to prepare for my call at 5. Everybody in the Subto community, I'll see you guys on that Zoom. You guys can hear me negotiate with that seller. Matt Sorensen, what is your YouTube channel?
At Matt Sorensen with 1 T.
At Matt
Don't
Sorensen.
overdo it. Just 1 T.
Thank you, brother.
Yeah.
Appreciate you.
Okay.
Later, guys. We'll see you later.